All right, guys. I'm a little bit late. I know. I'm sorry. Non-farm employment change, Jolts report, Jerome Powell. We got a lot of stuff. Yeah, I'm up a decent amount today too. Remember, I did bought Google yesterday. I did bought Google. Average price is 133. I did bought Tesla too. Doing much better today. Nvidia up to 8 freaking 70s, man. That's crazy. Yeah, Nvidia up to 870s, man. That's crazy. We'll see if it continues. It's a crazy busy day, honestly. Like I am gonna be streaming until like late. It's gonna be a crazy busy day. Again, we've got. I'm gonna break through it all in a second, or break it down in a second. It's just a crazy busy day. So today, just to put this into perspective, so today we have. First thing is early, like pretty early. We've got. Wait. Yeah, pretty early. We've got Abercrombie and Fitch, JD.com, Foot Locker, Campbell Soup earnings. These are all dropping sometime within the next hour, really. Following that, we have what's called the ADP non-farm employment change report. That's coming out at 8:15. After that, we have. Let me make sure. Yeah, after that, we've got Jolts report. The Jolts report expected to drop right at 10 p.m. Immediately following that at 10 p.m. or at 10 a.m. as well. At 10 a.m. the Jolts report drops. Immediately following that, we got Powell testifying in front of Congress. Yeah, it's going to be a very, very, very busy stream today. We are going to be streaming for hours and hours, and I'm ready for it. I'm okay with it. Brother, how many times do you bathe in a week? I would say probably about 10 times. Or I shower or bathe at least 10 times a week, every 7 days. Like, the reason I do that is because I go to jujitsu, right? And like, listen, I go to jujitsu. Sometimes I freaking stink after jiu-jitsu. Again, not even from me. Like, there's some people that just don't wash their geese at jiu-jitsu, and everybody kind of knows them to be kind of like stinky. And so when you spar with people like that, you're gonna stink afterwards as well. And so usually what happens is, like, really, I probably shower and bathe more than that. Like, and again, it's just because I do jiu-jitsu. Like, I bathe a little bit before jiu-jitsu, just out of like courtesy. And then I fully shower and bathe once I'm done with it. So I usually kind of, honestly, man, lately I've been bathing and showering twice a day. So probably close to 15 times. But yeah, that's a weird question. But again, like it varies. But look at Nvidia, guys. Nvidia up to 870s right now. 870s. Google at 134s. The SPY at almost 510s. Let me do a poll here. Let's get the poll going on. I gotta get the music going on too. What's up, Jimmy, IV, Joseph, Beach, Roof. The Jolts report is bigger for sure. The Jolts report is bigger. Now the regular payroll numbers are bigger. We're gonna do a simple poll. Does the market break highs today? But yeah, so I'll give you that breakdown in a second. Hold on, let me fix this. I had some music up. Let me put some music up. All right. Yeah, so the biggest report today is probably Powell. Followed by the Jolts report is probably the second biggest report, followed by non-farm employment, followed by earnings. That's probably kind of, we ran out of keywords to target today. Yeah, we're gonna live stream the whole thing. Yeah, I mean, again, bathe, shower. Yeah, definitely top 3 cleanest people in the world right now. Turns into a red day. I don't know. I'm up. I'm probably gonna take a little bit off of some of the trades I bought yesterday. I'm very green on the day. I'm up like, I woke up to being up a couple $100. So that's nice. So like, look, this is me right now. This is my profit on the day so far. I'll take it. I mean, we're up $250. So that's always a nice surprise when you're up $250 as you rise in the morning. This is mostly brought by Tesla, SoFi, Google. I did bought Google yesterday. Apple. We're in Apple. We're in Google. We're in Tesla. Yeah, Abercrombie and Fitch earnings are going to be chaotic, dude. I'm honestly excited to see what they show up as. A&F, man. This has been one of the craziest meme movements I've ever seen. Like, look at a 20-day chart. This thing is up freaking 45% in the last 20 trading days. Honestly, something happened. Abercrombie and Fitch was like, again, I grew up on them. Everybody knows them. If you're a millennial, you know Abercrombie and Fitch as a company. You know what they are. They're a preppy clothing brand, for lack of a better word. I don't think they're out with numbers yet. Or maybe they're just not big. We had JD.com release earnings. So here's JD, their earnings. Historical data suggests they're putting max pressure on JP for rate cuts in an election year. Yeah, I mean, I think they're going to cut rates this year. I don't think it's going to be this month, though. Maybe he says something to change that tune. I don't know. What do you think of gold when Powell speaks? It depends on what he says. Again, like, one of the most common type of questions I get here is, like, so vague. Like, the answers are so vague. Y'all ask me, like, yo, if Jerome Powell walks out of his house and stumps his toe and then goes to the freaking FOMC meeting today and says good but bad things, where is the SPY gonna close, at 3:05 p.m. today? Like, I don't freaking know, bro. Why are y'all asking me these questions? These are the most vague, random questions. Nobody knows the answers to these questions. And, yeah, y'all are asking me. Like, think about it. Like, think about the question you're asking me before you ask it. Because there's no idea. Like, nobody is going to know. I could tell you some random answer just to kind of make you happy. But it's going to be some random answer. You know what I mean? Like, think about these questions. Yeah, for sure. If I take a 3-foot step outside my house and a mockingbird, sings a song to me, and then I walk around the corner and see, and see 2 dogs playing in the street, which way is Apple gonna close, after hours today at 7 p.m.? You know what I mean? Like, I don't freaking know. Like, what a random question. Y'all are asking me how many times I bathe, bro. Like, listen, y'all are getting intrusive really quick here this morning. 8:15 Eastern Standard Time is when we get that first data release. Yeah, I don't know. The big thing to listen to is when we cut rates and what that influence is on markets. Do we cut rates? Yeah, this is exactly right, Sarge. If you see two ants outside, how much is Tesla going to go up today? What percentage is Tesla up? I don't freaking know. Yeah, I'm going to make a Twitter post talking about the same thing. People leaving me comments on YouTube like, if Jerome Powell stubs his toe at exactly 8:23 Eastern Standard Time this morning, will the market go up or down from it? No idea. Another fun fact, how many people thought their Facebook got hacked yesterday? Like, I know I did, right? Like, I was panicking. I'm like, oh no, I can't log into Facebook, you know? How many people thought their Facebook got hacked yesterday? I certainly did. I'm deep down like, oh no. I can't log into Facebook. Oh no. Oh, dude. Over here panicking inside, running to my computer saying, oh no. And I couldn't remember my password, bro. Like, it's been so long since I created that Facebook account that I'm over here like using my 100 words per minute trying to guess. Yeah. Panicking over here, man. Just yeah. Honestly, I checked Twitter, and it looks like a lot of other people were checking Twitter, too. I checked Twitter. Everybody else was doing the same thing. I was like, good. Some dude who held Bitcoin for 14 years decided to sell it yesterday. And it catapulted Bitcoin all the way down to freaking 60K. Although Bitcoin since then, over the last like 24 hours, has risen back up to 67,000. So right back up to lifetime highs. That's resiliency in Bitcoin. Dude, I can't believe I got it right. I was about to say you think you're smart until you got to spell resiliency, but I just nailed it first try. RESILIENCY. Just first try. Top 3 spellers in the world. But yeah, no, Bitcoin bounced all the way back to 68,000, where it's sitting now, right under 68,000, 67,000. It dropped all the way down to 60K from this dude who held Bitcoin since 2010. Mined it in 2010, was dumped following the all-time high, partially contributing to today's price correction. You know, I can't even get mad, bro. People can get mad, dude, about this guy selling, right? But I think you have to understand. If you mined thousands of Bitcoin, or even just, let's see how many this dude mined. 1, 2, 3, 4, 5, 6, 7... Oh, wait. Is he selling 50 Bitcoin each? Hold on, dude. Yeah, so this dude, 50 Bitcoin. So let's see. 5, 10, 15, 20, 25, 30, or 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. I see 23. I see 230 Bitcoin. Or no, these are blocks of 50. Hold on, 23 times 50. Oof. I see over 1,150 Bitcoin at about 65,000 a piece, we'll call it. So this man just might have made $75 million. Honestly, this man is the real diamond hands if he did that, bro. Like imagine owning, like, even if Bitcoin was half the price at like 30K, right? Like imagine owning freaking $35 million worth of an asset. And again, I'm gonna speculate and say that maybe this guy didn't have that much money outside of that. Imagine having 35 million in net worth and not selling. You know, and not selling until we get up to highs. Maybe he owns more than that. Maybe it's not that much. But it looks like he's selling 50 Bitcoin, 50 Bitcoin, 50 Bitcoin, 50 Bitcoin. So $75 million. Yeah, for sure. You can't really get mad at him. Yeah, everybody's panicking about Facebook. I get it. I'm more curious about why he sold. He probably sold because he got to all-time highs. You know what I mean? Like, at a certain point, you have to say, okay, is $75 million enough? Yes. You know what I mean? Like, at a certain point, you got to say, okay, you know, I'm up $75 million in anything. Nobody needs more than $75 million to live, right? Like, okay. Again, just to show you. And again, money changes the more you make, right? So the more money you make, the less valuable it is. 100%. All right. But, like, let's look at this objectively, okay? So, again, let's say you have a 20 million net worth, or let's even boil it all the way back down to a $5 million net worth, right? What most people would consider like wealthy for sure, but not like elitist rich. You know what I mean? Maybe I'm looking at it wrong. You're going to be in the top 1% of the world with this no matter what. But say you got 5 million. Okay, now say you live off of 2 million. You know, you buy a house, say you buy like a reasonable $600,000 house, and you got like 1.5 million more or less to live off of in cash for the indefinite future, for the next 5 years. Right, for the next 5 years, or say, let's say you take $3 million. Here's an easier way to put it. Let's say you make $3 million and you live off of that for the next 10 years. 3 million, everybody should be able to live off of that for 10 years. You could take the other 2 million, right? The other $2 million, and put it in bonds right now. Put it in bonds right now. You can put it in the stock market as well, but we'll do bonds. So say you put it in bonds right now, you're going to make about 5% a year, about 4.2%, right? So 2 million times 0.042, you're going to make about $84,000 a year just on those bond payments. Every year, you're going to make $84,000 a year just on those bond payments at 8.42%, right? And the compounding effect of that, I mean, it's over time, it's going to grow. So, you know, you could stick it, and again, that's if you get guaranteed bond returns, like guaranteed bond returns off of that 2 million. Right now, that doesn't even include the other 3 million in cash that you have, or whatever it is after you buy a house. So you'll be literally make 84 grand a year just on the cash that you have. You could go even farther. Say you didn't need to buy a house at all. And say you got say you put $5 million into the same thing, right? And guaranteed bond payments, you're going to make $210,000 a year, right? Like, so over the next 10 years, every year, you're going to make $210,000 a year. And then at the end of that, you're going to get your money back. And so you could literally just live off the interest. You could literally just live off the interest. And so you don't need that much money to live really well. $210,000 is plenty of money in almost anywhere you live. Maybe if you're in Cali or New York, it's testing it a little bit. But I guess the point is you can live on so much. So the overarching point is that if you got $75 million, you're set for life. I mean, that's a very obvious thing, but still. Jerome Powell's at 10 p.m. or 10 a.m. Sorry. Yeah, y'all have to be in it for the money, man. Like, again, people that aren't in it for the money, like moral traders, are bound to be taken advantage of. You see it a lot with the AMC community. You know, you see it a lot with GameStop. You see it a lot with all of them. And again, I'm bullish in a lot of those, but they're primed to be taken advantage of, unfortunately, in a lot of those situations. We'll see what the payroll data shows. BABA up today. I'm actually green on BABA. Somehow I'm still in ARM. I don't know how. Yeah, now again, this is guaranteed bond returns. Now, over long periods of time, the stock market's the way to go, though. So if you're holding something for 10 years for the rest of your life, bro, listen, you could take 45% of that money. Take $3 million, right? 45 or 65% of the money. And multiply it. Look, you could take 60% of that money and yearly. Wait up, my math is wrong. You can make 60% of that money in the stock market, and through compounding. Man, I'm struggling with my calculator formula. There we go. So you can take 60% of that money, take $3 million, and over a 10-year period, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, turn it into almost $8 million over a 10-year period, right? If you just have $3 million, you know, so you could turn that $3 million into $8 million over a 10-year period in stock market for the most part, most likely. Now, there's always risks to this, of course, but again, S&P 500 on average will give you about 10% on average, including crashes, right? People say, well, what if we crash? This includes crash statistics. You're going to make about 10% a year, you know? And with compounding, that turns into a lot. It's one of the reasons Shohei Ohtani got a bad freaking deal with the Dodgers. It's a bad deal. A 10-year deal, pushing back getting paid the bulk of his money for 10 years is a bad deal for Shohei. Now, I think Shohei wants to win a ring, and so he wants to go to the Dodgers because he knows they might win him a ring before he has to retire. But it's a bad deal. Deferring his payments for 10 freaking years is a bad deal, because in 10 years, his $700 million contract, if you just stuck it in the S&P 500, and this is, you know, again, Shohei Ohtani got $700 million in this deal. I think he deferred, what is it? He deferred like, what? How much does he make a year? $2 million a year. So he deferred 20 million, or he makes 20 million over the next 10 years, and then he makes 680 million. So 680 million in 10 years, right? But if you use the same the same thing, you stick it in the market, and this is what the Dodgers are loving life about, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. In 10 years, that 680 million is going to be worth almost $2 billion. You know, that's why Shohei Ohtani got a bad deal. He just got a bad deal, man. It's a bad deal for him. I mean, it's $700 million. He's never going to have to work, ever, outside of baseball. But still, I think it's a bad deal. What is this, semiconductors? Yeah. NVIDIA up to freaking 870s, man. Crazy. Yeah, I don't have an iPhone, so I don't have to worry about it. What will Jerome Powell do? So Jerome Powell every year Every year, Jerome Powell does what's called the semi-annual monetary policy report to Congress, where he testifies in front of the House and the Senate. I believe today's the Senate. I'm not 100% sure. Actually, today is the House. I'm pretty sure. Today's the House. Tomorrow's the Senate. Yeah, it's called the semi-annual monetary policy report to Congress. He does it every year. I hope he's asked about rate cuts. I want to know. I'm curious. Bitcoin up to 68K. Yeah, we did dip by Google yesterday. No rate cuts coming. I think a lot of people talking about March. I don't think so. Bro, I'm watching some Karen get mad at somebody in a Boston Bruins game. Bro, she's mad that her jacket got nachos on it. Like, bro, you might as well just assume you're getting nachos on you at some point in time at a pro sports game. All right, you're getting nachos on you. I'm a big nachos connoisseur. You know, it happens. That's life. I'm gonna make a t-shirt about this. The SPY up at 509s right now. 509s is still, I think the highs, the lifetime highs are almost 415 or 514, sorry. Historical data suggests that if no rate cut, Joe will... Who? Invented nachos. You know, was nachos invented or was it just kind of always around? We just called it something different, you know? bro, you gotta be about the dumbest freaking person in the world right now to do some of the stuff I see on social media. Like, dude, this is just, some of these people are just dumb. Like, you know you're gonna get caught doing some of this stupid stuff, bro. Like, all right, chat. We got about 300 people here live. We got non-farm employment data. Let me put the timer up. And so again, non-farm employment data drops at 8:15. It is about 7. So we got about an hour and 20 minutes or so. We'll call it 19 minutes just to make sure we have ample time. Yeah, that's right. So again, we got about an hour and 19 minutes left. NVIDIA pulling back a little bit. What's up, Joseph? Yeah, where's gold at this morning? Looking at gold. Gold's been breaking highs with Bitcoin. Gold up to 2140. Hit highs yesterday at exactly 2150.50. So gold futures ripping up. Was it on yesterday? Why did the SPY dump so much? Was there some news or just market doing its thing? Yesterday we had services PMI data come out, but there's not really a reason. It was just kind of a red day in general. You can see it all mostly started at right around 10 a.m. when services PMI data came out. So it could have been from services data, but we don't really know for sure. Oh, I got a scratch on my back. Ugh. I got one of those back scratchers. Freaking need that right now. Let me do this. Ugh. Ugh. Top 3 itchiest backs in the world right now. How do you get earnings reports right away from any company? Investor relationship sites take a while. You just gotta know where to look. It depends. You know, most major news sites are going to be covering earnings, and so you just kind of build up a bunch of different sources and have them all sent to you at once. Taiwan Semiconductors, maybe. The Q up to 439s right now. Do you think the House speaking today will have a major effect on the market? Maybe. I mean, again, Powell, what's going to happen today, guys? So again, this is kind of, you see this once a year, twice a year, where you got the semi-annual monetary policy report to Congress. Again, what's going to happen is that the House is they're going to go, all the House members are going to interview Powell. And a lot of it is like political peacocking, for lack of a better word, is really what it is. Like, a lot of it really is that. Like, they'll ask questions, they'll seem really hard-nosed on different things, and like, some of them are just kind of, you know. But hopefully they'll ask Powell some hard-nosed questions. The whole thing will influence markets, and so that's the thing to understand, is that all of this will influence markets, without question. At least to a certain extent, we're going to get some market influence. So Palantir just ripped up. We're still in Palantir right now. We've been in this for a while. It's just not really moving, man. It's been pretty flat for the last couple weeks. All right, guys. So again, we got Nvidia dipping down. SPY bouncing up over the volume weighted average price. Earnings today. Again, let me know when A and F earnings come out. JD.com dropped. We covered those already. Mortgage rates came out this morning. Came in at 7.02%. Down a little bit, but basically same. Sorry, I'm looking up something about this movie. I'm trying to... Yeah, but what movie is this?
I need search.
Sorry, I'm trying to find this movie. I'm looking at it on Twitter. It's about this guy cop in the girl prison. That's how they get you. My wife and I like prison shows. We watched 60 Days In. Palantir is set to unveil 20 plus new customers and partners at its upcoming AI PC on March 7th. It has also been selected by the Army to deliver Titan next gen deep sensing capability and prototype maturation phase. CrowdStrike had their numbers come out yesterday. How did they do? Yeah, so this is why Palantir is ripping up. Look at PLTR, which is an AI stock. So look at Palantir rip up. I'm in it right now. You love to see it. It's helping AI move up some as well in tech in general. Abercrombie and Fitch is set to release their numbers sometime today. We don't know when it's going to be. And Abercrombie and Fitch has had a crazy run. They're set to drop at 7:30, so we still got about 30 minutes left. 30 minutes until Abercrombie numbers. We also had JD.com. Foot Locker is dropped about 15 minutes ago. Campbell Soup and a couple other ones. CrowdStrike. Look at Palantir fly up here. Again, this is kind of helping AI stocks. I'm for it. Yeah, what's up, Freddy? Yeah, looking at CrowdStrike. Look at Palantir rip. Here's Nvidia. I'm going to put CrowdStrike on the left chart. CrowdStrike with a huge gap up, almost a 380s. This is something that's helping the tech market as well. Again, we got Palantir up to almost 25. Oh, this is from the mayor of Kingstown, which is a great show, bro. Carol and I started it. Alright, bro. How do I mute you, sir? Let me see. Mute. Just disable sound for now. Yeah, how did Neo do? Didn't Neo have earnings? Oh yeah, Neo dropped earnings a few days ago. Early. I need someone who help me. Also, I want guide me, honestly. All right.
Do you feel comfortable with me now, Scott?
You know? All right, Palantir's still ripping up. Honestly, I was playing with OpenAI's DALL-E yesterday. All I'm going to say is it's not that good at image generation, but it did create some cool stuff. Freaking ads.
No, for sure. That you find.
I'm trying to get this quote. Let's see if ChatGPT can get it for me. All right, Palantir up to over 25, still skyrocketing. Yeah, so DALL-E couldn't give it. DALL-E couldn't get one, but that's all right. Something not right with Mara Riot Hut miners looking shaky. Well, you gotta understand the halving's coming up, Blaze. So people are gonna make 50% less from mining soon, and so the differences in price for miners versus Bitcoin probably reflects that, in which the miners are gonna be less profitable in about in a couple months, you know, and so yeah, that's something to consider as well. The miners will probably be less profitable. Yeah, JD.com is out. Palantir posted this AI news. Palantir is to unveil 20 plus. I'll put this up on screen. This is what's ripping Palantir up right now. All right, so here is the full news for Palantir. All right, so here's the news for Palantir. Palantir's flying up. We get up to 25.20s. I'm in Palantir. Powell's at 10. All right, so I bought a bunch of Google. I'll probably take a little bit off here just because I can. Yeah. All right, so we just took a piece off of Google because we can. But I like Google right now. I think it's strong. Palantir is still rising. Thanks for what? Oh, putting the news up for Palantir? Yeah, the news is right here. Powell speaks at 10. NVIDIA breaking highs again up to 872s almost. 872s. Crazy gains here for NVIDIA. Yeah, I'm kind of bummed I won't be able to go to Jiu-Jitsu today. Phil chip leader 5 left, the 10K dealer's choice. Phil Hellmuth has half a bet left and is the only person in the world that would rather bag up to end the night than play 7 more minutes of the level. That's Phil for you. Honestly, pollen's everywhere. Bro, these influencers at the gym need to stop it, dude. Honestly. Like, bro, I think social media is good and all. Like, I think the value of social media people underappreciate. Okay? Now, with that said, these influencers are just freaking, like, narcissistic. You know, like, they're just narcissistic. And again, I'm not one to overuse narcissism. You know, I joke around, and kind of my personality on stream is kind of like a trading brat who thinks he's the greatest at everything, right? It's obviously sarcasm, but people who can't identify the subtle sarcasm, especially people who maybe are struggling or whatever, get kind of weird with me and call me a narcissist. But again, understand that that's just really kind of like a personality for the stream. Like, I'm kind of like that in real life, but not to the extent at which I am on stream, of course. And I think that's pretty self-evident. But anyways, going back to these other influencers, though, man. These people filming people at the gym. People filming people at the gym is just crazy, dude. Like, getting filmed at the gym is genuinely out there. And, like, who needs to record themselves at the gym doing exercises? Right? Like, I'm not saying you can never, ever record yourself at the gym. But, like, you maybe can record yourself doing one set of exercises every 6 months to see if your form is still good, right? Like, but people going to the gym recording themselves every freaking day at the gym, you know, like, it gets kind of out there. And I get it. I like going to the gym. I go to the gym a bunch. But I'm also not one of those people who, I don't know. I think, I'm not trying to be condescending, you know, but I think people that don't have much going for them end up going to the gym and just kind of obsessing about that. And I think it's good. You know, I think it's good as long as you don't start taking a bunch of juice and steroids. But yeah, I think, I don't know, man. I just don't want to be filmed at the gym at all, you know? They making money, bro. I know, I can't really knock them. But when you're making money filming other people, I think that's where it gets turns into a problem. A gym stream? Do that with your golf swing? Dude, I got one of the top 3 greatest golf swings in the world right now. We don't allow phones when on the mat. Oh, you're talking about jiu-jitsu gym, bro. Yeah. Definitely top 3. Gym stream coming along. It's called vanity. Listen, I'm top 3 most vain, confident people in the world right now, okay? And I'm not mad at you do it sometimes. But if every time you go to the gym, you're filming yourself doing dumb workouts, like, reevaluate your life, you know? Maybe I'm just frustrated. Everybody's got cameras out at the gym. And honestly, I would go to a gym that banned phones. I really would. Hellmuth. Yeah, so JD.com reported numbers. Remember, JD.com is an overseas company, right? Overseas company. JD.com ripping up. NVIDIA just broke highs. Palantir ripping up as well. Again, all of this is probably from Palantir's AI news. Look at JD.com. Rip it up on earnings. I dropped the earnings report earlier on the stream. Let me see if I can find it. Foot Locker out, 38-cent profit per share, 32-cent expected. Revenue 2.38, expected 2.27. So beat EPS, beat rev for Foot Locker. Looking for JD.com. There's JD.com. JD.com, 75-cent profit per share. EPS revenue of 43.1 bill. They expected 41.6. So beat EPS and revenue. Announces a buyback of up to $3 billion US. I'm okay with tattoos. I like tattoos, but top 2 most humble people in the world for sure. No recession on the horizon. Why would the Fed drop rates? Yeah, I don't know. They're getting pressure. It's an election year. All right, so again, in less than an hour, we got non-farm employment change data in less than an hour. Following that, we've got the Jolts job report and Jerome Powell. So we got so much stuff dropping today. It's kind of crazy how much economic reports and stuff we have dropping. Supermicro just has a really low float that's easily... I don't think it's manipulated. I think it's just got a low float, right? A $50 million... Okay, and not a $50 million, but a $50 million float is very small. Just to give you guys some perspective here, okay? Before a lot of other stuff started squeezing, the largest short squeeze in the world happened in 2021. This is actually what grew my channel to very big. We went from getting like pre-AMC squeeze and pre-GameStop squeeze, I'm sorry. We went from getting like 300 to 400 people to thousands and thousands of people tuning in for my streams, right? So we went from streaming 200 to 300 people to freaking 2,000-3,000 people, which was the most we had ever had prior to that when GameStop started squeezing. The reason GameStop squeezed is because the float was crazy small. You know, people wondered why AMC didn't squeeze like GameStop. There's a reason why, is because AMC has a float of like 500 million or something crazy, literally 10x what GameStop's float was in 2021. But GameStop started squeezing in 2021. And again, I was one of these people who called GameStop short at $4 a share. So I was wildly wrong. Top 3 most wrong traders on GameStop ever. I eventually joined them and jumped in GameStop and made some money on the squeeze. But before that, before the squeeze started happening, I was bearish on GameStop, as was most reasonable people. GameStop was just a struggling company. It still kind of is. But I digress back to the point. GameStop started to squeeze because number one, it had 120% short float. Number two is that the float size was only like 40 or 50 million shares in the float. And so small float stocks are much more rangy. They have a much larger range. They move much more volatile. In a much more volatile way, and they have big potential. Supermicro Semiconductors, another stock that's very similar in that regard, where the float is pretty small for a semiconductor company. 50 million, 45 million in the float is a very small float. That's why you see it making crazy moves, even priced over Nvidia. Nvidia is obviously a much larger company, even though the price is less. But with Supermicro Semiconductors, you know, there's only 50 million shares in the float, give or take. And so there's not many shares in the float. And the reason, if you don't understand, since this is beginner trading, and we'll go ahead and teach you about this, I guess, the smaller the float, the more volatile and rangy the stock is going to be. The reason for that is because each individual trade is more influential over price the smaller the float, right? So if a stock has 1 million shares, a tiny float, you see a lot of penny stocks with small floats. If a stock has 1 million shares in the float and I buy 50k shares, that's going to move that stock. That's a large percentage. What did I say? 50 million and I buy 50k shares. Yeah. So if a stock has 1 million in the float and I buy 50k shares, I'm buying literally 5% of that company. I'm buying literally 5% of all the shares that are out there in the world. And so me buying those 50,000 shares is going to move the stock, right? It's going to move the stock. Like that's a big purchase, a big influence, because the float's so small. Now, if I buy Nvidia and I buy 50,000 shares of Nvidia, which has almost 3 billion in the float, it's not going to really move Nvidia much at all. It might move it a little bit. But it's not going to move it in that way as much, you know. Yeah, and it's just not going to move it. It's going to be kind of a drop in the bucket. There's so many shares out there that each individual trade is less influential. That is why float size is relevant. That's why float size matters, is because companies like Supermicro with tiny floats can be much more impacted by trades. It's again, going back to GameStop, it's what you saw with GameStop. Short float was crazy high, float was small. When a bunch of traders got together and started supporting GameStop, they could take up a large percentage of the float and ultimately cause squeezes like that. Again, it's one of the reasons you don't really see that with AMC, right? A lot of people correlate AMC with GameStop, but AMC's never had close to the small float that GameStop has. AMC still, like to this day, has how many shares? Like, isn't it like 1 billion after after they got rid of the ape divvy? Yeah, AMC float size is 262 million. So I think they've shortened their float recently. The easier way to think about it is how many shares are floating around out there. But yeah, I'm 1, 2, and 3, bro. Hertz, HTZ. Yeah, what's up, David? Extremely sad. Tried swinging the longs. Yeah, that happens, brother. That happens. Hertz. Hertz is an interesting company. You know, this one has gone kind of crazy over the last few years. So, like, what happened with Hertz is that this thing filed for Chapter 11, which is reorganizational bankruptcy, right? It's not like going out of business, sell off assets, bankruptcy. It's just reorganization. It's like, yo, our company sucks right now. We're going to file Chapter 11 and reorganize our structure and try to help the business. So anyways, Hertz filed for Chapter 11 years ago, bought up a bunch of Teslas, and gave it another shot. And they did a lot better, but they've been struggling recently as well. I don't know. I guess with rental car companies, there's a ceiling, I think, right? Like, they can only get so big versus the other competitors, right? There's a ceiling in there. And it probably has a lot to do with, like, partnerships with airports, partnerships with stuff like that. But I don't know. I think the ceiling's pretty small for rental companies like this. Do you think that CRWD will actually stay around this level today? Maybe. Palantir up to 2520s, 2520s. Starting to break highs. CrowdStrike, it just depends. Big earnings pump. So a big move up. Typically, I don't like buying up stuff like this. I'm more on the other side. Like, if a company dips a lot from earnings, I'm usually there to buy it up. I did this with Unity. I did this with CRM, Salesforce. Made a bunch of money from it and got out pretty quick. But whenever a company gaps up significantly from earnings, I'm usually less likely to play that, if that makes sense. No, I don't really watch HTZ very much. Adobe? I think Adobe could be in trouble from AI. You know, I think Adobe could be in trouble from AI. I think Adobe is going to be is going to be hurt by AI, just because people can produce a lot of things. Palantir starting to rip up, break highs here, so let's look at PLTR. Palantir getting close to the high of the day. Again, we'll put like the Q up here on the left side. I own Tesla. I'll be really happy. I ignore advice like that when their robot is being made. What? Palantir up to 2530s, 2530s. Yeah, even if Adobe has AI in their software, it's still going to make a lot of their software unnecessary. Not unnecessary. How much do you love your job? I mean, I love doing this, you know. Like, it comes with flaws. Like, it comes with problems. You know, people are weird. Social media is one of those things that a lot of people try and fail at. Right, so like a lot of people try and fail to do these things, and they just turn into weirdos afterwards. Like, they get weird at anybody that does it and succeeds. You know, I think it's really polarized, where like you tell somebody you're a social media marketer or whatever, and they either think you're unemployed, you know, they think you're freaking Logan Paul interviewing people on the streets, toxic, or they think you're a freaking genius, you know? It's just super polarized. Palantir still flying up. Look at this. Breaking highs again. Still moving up. Look at those 4 or 5 green candles. I don't know what Powell's going to do during testimony. 7 years, no advertisements. No advertisements for what? Listen, guys, listen. Just, I'm not one of those guys, like, I would never, ever, sell out for money, ever in the world, I'm here purely out of the kindness of my heart, guys. Like, listen, like, I just do this to help people, all right? I would never think about advertising anything. Like, I don't even know what advertisement is. With that said, though, guys, Apex right now has a 70% off sale. Apex is a funded account program where they give you a demo and they test your skill. If you want to day trade, do not put up thousands of dollars yourself trying to look cool. You're almost certainly going to lose money if you put up thousands of dollars yourself and try to fund your own account. It makes absolutely no sense. The futures market is meant for day traders. You can day trade short in the futures market. There's no PDT rule. You can day trade short, buy market, sell market. The patterns are very similar to stocks and blue chips like Apple, Amazon, look a lot like the Q. And you can do all that stuff in futures, no PDT restrictions. Apex is the most legit. They have paid out over $100 million to their funded traders. What they do is they give you a demo and they test your skill. And if you can pass the test, basically the base one is $25,000. You got to make $1,500 in profit. If you make $1,500 in profit while following their rules and conditions, they fund you $25K. You get to keep your first 25 grand in profit. And then after that, you get a 90% split. Genuinely useful. And again, to be fair, I think most day traders lose. I don't think it matters whether they're on Apex or not. Most day traders lose. And so again, you can either risk thousands of dollars yourself in those markets, or you can try Apex funded account program, super cheap. The base one, the 25K combine, is going to be like 30 or 40 bucks. You can also just get the 50K combine, which is the one we got funded in 3 different accounts. 3 different accounts already. I think 3. 3 different accounts in like 3 days trading with them, 4 days trading with them. Again, you can get 70% off. Remember, guys, remember to use promo code BT. You can use promo code BT. You can also use triple B, BBB. Check it out. There's the link. Check out Apex funded account programs. There's the link in chat right there. Obviously, I'm being sarcastic about plugs. Of course, I make advertisements. I'm doing this to make money. Everybody else is as well. You can't really knock me for it. If I would rather trust somebody who tells me their intentions in a transparent way than somebody that tries to pretend like they're out here out of the kindness of their heart, nonsense. Again, but with that said, I don't sell a course, don't sell a service myself, don't claim to be an expert, don't even claim to be a good trader. Although we're green this year, we made money. We were green last year on toss as well. Y'all are asking some crazy questions. I'm still friendly with them. We just kind of switched. Again, Apex, the thing I like about Apex is they've got a 25K combine, super cheap, only $1,500 in profit. I can also use Quant Tower, like we've been using Quant Tower. We're going to day trade later on today, but today's an economic reports day. But yeah, I'm still friendly with the other one. But we're just choosing to promote Apex now. Nothing against the other one. The other one's good. All right, guys, so we got over 500 people here right now. We still got 45 minutes before non-farm employment data comes out. 45 minutes. Yeah, I like Apex as well. Apex is dope. Apex is really good because of this, right? Like, if we look at Apex here, okay, and we look at their products, right? Number one, you can use Trade Evade. Trade Evade is probably the simplest platform you can use, right? They've got all these different options, 25K all the way up to freaking 300K. The other thing is they have statics. They have statics right now. Also, resets universally, I'm pretty sure, are only $35 right now. Only $35 universally for resets. So I think that makes a ton of sense, where if you want to get funded, I'm pretty sure it's universally $35 resets, which makes, like, think about it like this, right? If you buy one of the 300K ones right now, and then it only costs $35 to reset, I'm pretty sure that's the rules too. Let me make sure. But again, they also have static, right? What static means is that there's no trailing drawdown. And so your total drawdown is $625. These are the accounts, like the static accounts, in my opinion, are the ones in which, if you want to get a big withdrawal, like a big return, I think the static ones make perfect sense, because you can build up this huge cushion and take crazy risks. Like, imagine you built up like a $5,000 cushion in a funded account program. You could swing and try to make 15, 20, 30K in one trade, and then, you know, be able to take big gains out of the market. So the static ones make sense. But yeah, check out the link. They're a sponsor. I'm biased, of course. And also, remember, guys, listen, I'm going to plug this because, you know, remember, I am terrible at this stuff and have no idea what I'm talking about. I might be wildly wrong about anything and everything I say. Don't copy me. I'm not an investment professional. I'm certainly biased in sponsors' favor. And yeah, just remember that, chat. Yeah, $35 resets for any account size. That's crazy. Yeah, all right. All right, guys. Sorry, I'm back. Carol had to talk to me. My son's eyes are super swollen from allergies. Palantir ripping up again, breaking highs. Ripping up, breaking highs. Crazy. AI getting bumped up from it. Getting a big bump up in AI. Google's starting to fight its way back too. We're in Google right now. We bought the dip yesterday. Abercrombie and Fitch, I forgot, they dropped earnings. Let's see what they look like. Abercrombie and Fitch gapping down from earnings here. Honestly, this is one of the craziest meme plays ever in the world right now. Top 3 for sure. Abercrombie and Fitch, we're going to catch these earnings here. Abercrombie and Fitch posted 297. They expected 283. Better than expected EPS. Better than expected revenue. Comp sales are up 16% as well. So it looks like they did well for A&F. Look at Abercrombie and Fitch numbers right here. So it looks like they did well, but for whatever reason, they're just falling. All right, guys, Q at 439.30s here. Palantir up to 25.70s. Look at Palantir still breaking highs. Abercrombie and Fitch still breaking down here some too. Again, there's the SPY at 509.20s, 509.20s. Yeah, I might get one of the big accounts on Apex. I'm already funded in 2 or 3. I think I'm funded in a 3rd one. I just have to take a position every day in minimum of 3 trading days. So I just got to kind of wait and get my 3 trading days in that. I'll be funded in a 3rd one. But again, I think the way to do it is to get like a big account with only $35 resets. You get funded one of the big boy accounts. Palantir at 25.75. Finally pulling back some. When the market pumps after Jerome speaks, so when the resets happen, people trust them. CBDC. Adobe rushing to integrate AI. Yeah, I think they need to. I think Adobe needs to integrate AI here. I think you know, like again, like just to show you guys Chat GPT's example of this, right? So let me get rid of some of this stuff. Delete. 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 So I gotta clear out some of this old stuff. I'm on GPT-4 now. Alright. Yeah, so again, like look, so like here's DALL-E. Chat GPT-4, OpenAI. Right, I can say create me an image that shows a central bank chairman climbing or throwing money off of a Mardi Gras float. Alright. See, creating an image. Right, now these are things that you would previously use Adobe for. Right, so these are things that you would previously use Adobe for. But you don't need to use Adobe now because you can do them here, you know. Honestly, it's so good, bro. Look at this, dude. This is so good. This is so good. Look at this Chat GPT picture, bro. You love to see it, dude. Look at that. How good is that? Again, DALL-E Chat GPT just did this for me. That's so good, bro. That's so good. It looks just like him, too. That's genuinely solid, bro. I'm gonna post this. That's pretty solid. Today will Powell shock the markets? One, two, three, four, five, six. He does have six figures. Yeah, honestly, it's pretty solid though. It's pretty impressive. Like it really is kind of impressive. You know what I mean? All right, guys, so look at the SPY rip up. Q breaking highs are getting close to highs. SPY breaking highs of the day. Palantir, again, what helping the market. I bought the dip. You love to see it. I'll take it. Nice little green action this morning from Palantir, from Snapchat, from SoFi, from Tesla. Also from Baba. Yeah, for whatever reason, AI can't do fingers very well. Hey, well, that actually would be pretty dope, dude. If Adobe comes in and you can basically circle the fingers and say, hey, make it only 5. That would actually be pretty solid. I mean, I can have AI do this now. Like, watch. If you're nice to it and say please and thank you, it'll fix it. Palantir is still up there. We'll see if it continues to move. Yeah, I've heard of Sora. Sora looks really, really cool. I'm hoping it comes out sometime soon because Sora is genuinely impressive. Genuinely impressive. I'm really excited. Okay, so here's the corrected one. All right, so here's the corrected one. 1, 2, 3, 4, 5. There you go. 1, 2, 3, 4, 5. Boom, fixed it. Yeah, I've heard of OpenAI Sora. Again, we'll see. Mid-journey. All right, Palantir dipping down to 2540s. Y'all be careful. The Fed meeting is Jerome Powell testifying in front of Congress today. So again, here's A&F. We got some people yelling for it. A&F's pretty flat today. You see the previous closing price. It's right at that previous close. It just rebounded all the way back up, though. A&F's fundamentals are sound. Let's take a look. Let's take a look. All right, so here's the EPS. I mean, they're getting better. I wouldn't call them sound. The last 4 quarters were profitable, you know. So the last 4 quarters were profitable. I wouldn't really call it sound, though. I would still say it's in an early stage of rebound. Let's take a look at revenue. I mean, revenue is decreasing over time. Now it's not a big, like, scary decrease, but it is a decrease over time for A&F, right? So what we see here is we see a slowly decreasing revenue for Abercrombie. Again, I don't know how big A&F is right now. Like, are young people buying this again? Because it all has to do with young people. Like, adults are not going to be able to prop up Abercrombie. They're just not. My generation's not going to be able to prop them up. Young people have to adopt it. Yeah, I know. I don't know, man. I see a lot of people would just make bad decisions on social media. And again, I did this when I was young and stupid, like everybody else. But like when you get older, okay, here's an example. Like I grew up with some people, right? Like there's a couple people that I grew up with, right? And like you could do the whole bad boy thing when you're young, trying to look cool and hard and, you know, edgy when you're young. And like, you know, people might be into that when you're young, right? The ladies might be into it. If you're into ladies, they might be into that when you're young and when they're young, right? But when you start to get into your mid-20s, 30s, that's the opposite of what you should be. And I've got a lot of friends that just never made that transition, you know? So like if you look at what they're posting on social media, not friends, I would say they're more acquaintance. They're old friends that I haven't seen in years. But again, when you look at what some of them are posting on social media, they're just posting they're still in that kind of like, I'm a gangster phase. And most of them just end up looking dumb. on social media. And again, I couldn't imagine that it actually works. Like as a 35, 40-year-old posting like, I'm so hard, I'm such a bad A. Like, you know what I mean? On social media, I can't imagine it works. I can't imagine any female sees that and they're like, ooh, like this dude's freaking edgy, bro. Like, and again, I think it has to do with, you know, maturity, of course. But I think that's a big mistake that I see a lot of people making on social media. It's just bad decisions, you know. Top 3 worst decision makers in the world right now. But still. VLCN. I see a couple of people talking about VLCN. If it's a penny stock, I'm probably going to hate it. Yeah, I mean, this is a very low range, downtrending, barcoding penny stock. I don't like it at all. It looks terrible. Yeah, I mean, they didn't choose it. It chose them. I mean, I get it, but a lot of them grew up with me in the suburbs. So, like, they're the least gangster people in the world right now. But, you know, again, I grew up with a lot of them, like, in the suburbs. You know, like, we used to ride our bikes in the neighborhood together. So it's like, y'all aren't gangsters. Y'all know y'all aren't gangsters, you know? Y'all are suburban kids just like me. You know what I mean? Like, some of them have been to jail, so maybe they think they're gangsters now. But, like, I don't know, man. It just seems like a facade. I think some of them look silly. The old man biker gangsters, most of them are just trying to look cool, too. Like, most of them are going through midlife crises. And they're just, they want to look like some big, you know, gangster. But they're most of the time, they're just old men that don't have, you know, I don't know. Top 3 suburban kids in the world right now. Blame Eminem. Yeah, look, I'm not mad at you if you ride motorcycles. I'm really not. Like, if you want to get a Harley Davidson and ride that thing, like, I'm okay with it. Like, do your thing, live your life. But, like, as a 70-year-old man, don't come at me trying to act like you're some big gangster guy. Like, dude, you're freaking... Like, come on now. I see a lot of that, too. Maybe I'm top 3 most critical people in the world right now, but... Yeah, I guess it would be like a 3/4 life crisis. More so than that. They don't. It's bad. They don't. And the ladies they get, you don't want. You know what I mean? I've seen Sons of Anarchy, okay? You don't want those ladies. Maybe it's just dealer money that attracts them. Yeah, but even that, like, okay, like, let's break it down from a business perspective. All right, anyways, we're sitting here watching the markets. Palantir pulling back. The Q mostly uptrending. Very optimistic day. Maybe Powell's going to completely destroy all this stuff. In about 25 minutes, we get what's called the non-farm employment data coming out today. So the non-farm employment data is the prelim payroll data, the prelim NFP data. So that'll influence markets. That, again, it's called the non-farm employment data. That is expected to show up at 150K, 150,000. Now, a higher ADP employment data means more jobs, okay? That might be a negative thing right now if the market's still fearing inflation. And this will be an interesting gauge on what the market ultimately fears, whether it's fearing inflation or more so recession woes and fears. I don't think we're at recession fears, of course, but it'll show you what the market wants, whether the market wants economic growth or whether the market wants less people working and less inflation problems. Anyways, going back to the dealer mindset, like, okay, say you're a dealer. Right? It seems to be the worst thing you could ever do, right? Like, people do it to look cool, in my opinion. But, like, imagine doing something where the government can come in and take everything that you have, like all the money you make in a heartbeat, all of it's gone. Like, who cares about that? Like, why spend your time and energy doing that? Like, it's some, like, again, I'm not saying there's not real people making money that way. What I'm saying is that 95+% of the people that are doing that are just doing it to look cool. And the margins that they're making are so small, and even if they do like make a couple $1,000s, the likelihood that the government's not going to one day come in and step in and take all of that away is so low that the business just seems to be a terrible idea. I mean, water's kind of wet. Maybe it's a very self-evident thing, But I just never understood why people devote so much time and energy into that. Like, you're just gonna, like, even if you do make money, you're just gonna get it taken away from you, most likely, at a certain point. The odds are stacked against you. It just doesn't seem like a good path. It's much better to just start a legitimate business in something, you know, that you're interested in, and something that you know, you know. Something that you know well enough to create a business around. That's the better, like, path, I guess. It's a whatever I want channel system, you know. You can go watch somebody else if you want, brother. I don't want to start a legit business. Trading courses, top 3 course sellers. Al Capone, man. Al Capone actually had a really crazy life, obviously. Gold still consolidating, breaking highs though. Over the last week, highs are right around 2150. It's at 2141. We'll see if gold ends up continuing to rip. Again, most of this AI craziness is from Palantir. If you look at Nvidia here, Nvidia at 870s. John about to break 10,000 watchers at 10 a.m. Hey, we'll see, brother. I don't know, Beach Bum. I want SOAR to come out soon. Like, I want SOAR to come out soon. Who knows when it will, but I want SOAR to come out soon. I'm excited for them to announce it. What does Powell speak today? Powell speaks in what's called the semi-annual monetary policy report to Congress, where he gets interviewed by both the House today and then the Senate tomorrow, is what it is. I think it's the House today and the Senate tomorrow, I'm pretty sure. But yeah, that happens at 10 a.m. Yeah, all good, Blaze. It's all good, brother. Yeah, I'm showing it at 150, Sky, but it varies. I'm just going to call it 150 because of OCD, but... You think Powell will be dovish because of recent good data? I'm not sure. It depends. Inflation data, I wouldn't even call it good. I think it came in neutral. PCE data is what we're referring to from last week. I think it was kind of flat. It was kind of neutral. I don't think it was like some crazy good inflation report. You know, we're edging closer to 2%. You know, I think PCE data came in at what last week? Let me look. Came in like what? I think it was like as expected, right? At 2.8 or 2.9% on, was it Thursday? Yeah, so last week. Yeah, so PCE data last week came in at 2.8%, right? So core PCE, that is, came in at 2.8%. So we're getting closer to the 2% goal, of course. And we did come in a little bit lower than last time, year over year, but we did come in higher than last time, month over month. So last one, year over year, was 2.9%. We came in at 2.8%, so 0.1% lower for core PCE. The previous month-to-month reading was 0.1. We showed up at 0.4. And so the market interpreted PCE data as good, but I don't know if it was as good as like the market signaling a cut. I just don't think we're going to cut rates anytime soon. I think if we do cut rates, it's going to be in June maybe. But maybe Powell will give some insight into what might happen. You know, the next FOMC meeting is later on this month, on the 21st. So that'll be a big report and an interesting thing for sure. Yeah, we have one data release at 8:15. So again, here's the day. We got a lot of stuff, guys. So again, we got non-farm employment data at 8:15. All right, that drops at 8:15 today, in about 20 minutes or so. After that, we've got the Jolts report. And then after the Jolts report at 10 a.m., we've got Powell testifying in front of the House. I believe the House is first. Let me make sure. Yeah, it's going to be on rate cuts and inflation. Yeah, so it's the House Financial Services Committee. So yeah, so today's the House, tomorrow's the Senate. Again, it's Congress. Wholesale inventories is one of the more insignificant things. Yeah, non-farm employment change data 8:15, Jolts at 10, Powell at 10 is the schedule today. They are very worried about not taming inflation. I agree. I think that's why we're not going to have rate cuts soon. Yeah, Jolts report came in high as well. What's up, Just? What's up, Andrew? Love what you do, man. Yeah, again, my channel has kind of grown into like an economic reports channel. I'm super proud of my channel too, man. It took a long time. You know, you get haters over the years, and the haters tell you that you suck or whatever, and then I always tell them the same thing. I'm like, look, it must suck to be a hater because y'all are just gonna have to watch me keep growing on YouTube. And that's exactly what's happened. Like, we've grown from getting, on average, 200 to 300 people there to, like, even our streams where we have nothing going on, we're getting, like, 500 to 700 people. Our big streams, like NVIDIA, we had 14,000 people, concurrent viewers watching that thing. We had almost 100,000 viewers total for NVIDIA earnings. FOMC meetings, we're getting, like, 4,000 or 5,000 concurrent viewers. Jerome Powell, today, when Jerome Powell speaks, we're going to have thousands and thousands of people here, like, a lot of people here watching that. So it'll be fun as well. And I believe he does this once more this year. Again, I got to brag about my channel. I'm just proud of it. I appreciate you guys so much. Thank you so much for helping me grow the channel. It means a lot. It really goes to show that you can tell people you have no idea what you're talking about and are wildly wrong about everything and grow fast on YouTube. So thank you guys so much. Yeah, we're going to stream the whole thing, David, for sure. Yeah, a lot of stuff happening today. Really, the whole week's freaking packed busy. Like, today we've got non-farm employment, Jolts, Powell. Those are three pretty big things. You know, again, we've already got 800 people here for the non-farm data coming out at 8:15. And then Jolts will have so many people here with Jolts and Powell going on in 10. And so, yeah, and then again, tomorrow, guys, tomorrow we've got jobless claims numbers in the second Powell testimony in front of the Senate. And then Friday, we have non-farm employment. Friday we have non-farm payrolls, NFP data, and unemployment data on Friday. Just a packed week. Every day's busy now. And it'll be really, like, I'm gonna hope we can break 140,000 subs by the end of the week. That's a lot of subs, but I'm gonna hope we can break it. We'll see. Let the good times roll, Joe. Listen, being from Louisiana, I hear that quote at least 20 times a year. 20K people, you gotta wear a suit. I got a nice suit I can wear, bro. The real question is, when are you going to start playing video games? I mean, I play video games every day. If y'all want to get beat up in UFC 5, let me know, dude. I'll beat you at MLB The Show, too. You'll get struck out at MLB The Show. Just let me know. Your channel is brilliant. It's like an economic meet, chill out lounge. Hey, that's the goal. Thank you for sharing your understanding of macro and data. Hey, all good, man. Again, the market's interesting, right? Like, once you start to understand the economic machine, it becomes really addicting to, like, pay attention to the economic, machine and markets. I'll give you guys a little bit of a briefing on that economic machine, okay? So once you start understanding, you'll hear the Federal Reserve a lot. You'll hear Jerome Powell. The Federal Reserve is kind of like a bank that institute policies and kind of polices, and more than any of that, supports other smaller regional banks in each individual state, right? So you'll see, like, Federal Reserve members, and they're usually the head of different banks. Like Raphael Bostic is the head of the Federal Reserve of Atlanta, or the Fed of Atlanta Bank. And so you'll have all these members from all these regional banks in the area, in the country, that all group together to make the commission for the Federal Reserve, right? The Federal Reserve's job is to support these other banks, and they do this through a lot of different things. One of the ways they do it is through monetary policy, and their job is to keep the economic machine of the U.S. balanced, right? Like, that's really their job, is to keep the economic machine of the U.S. balanced. The ways they do that is that, like, to zoom into, like, 2020 as an example, right? We talk about this. We try to do it at least once a day, give you guys kind of like a real understanding of economics and what the Federal Reserve does. One of the ways they do that is when they've identified risks to the economy. Like 2020, the pandemic happened. A lot of people weren't working. There was a lot of crazy stuff going on. They identified risks to the economy. And so what they did was a relatively new tool that they've started doing over the last couple decades. It's called quantitative easing. What they do is what they literally do is they come in and they buy a bunch of bonds, buy a bunch of treasury bonds. This injects liquidity into the economy and allows banks to have better margins so that banks lower interest rates to consumers, right? And we can look at mortgages as the example I always use because it's the easiest to understand. Okay, so when the Federal Reserve comes in and buys a bunch of bonds and injects liquidity into the economy, banks are able to lower interest rates to consumers. And so your average consumer goes from, if they want a mortgage, they got to pay freaking, high percentages, to where if they want a mortgage, they only got to pay a couple percent. Sometimes they bring interest rates almost down to zero through this. And when the average consumer getting a loan pays less in interest, they're going to be able to spend more money on other things, right? So if you're paying $1,000 a month in a mortgage payment versus $4,000 a month, then you're going to have a lot more money to spend on other stuff, right? Thus, it stimulates the economy. It stimulates spending, which is economic growth, is spending, right? One of the consequences of that, and again, that's called quantitative easing. They can also lower, and this is what's called a dovish Fed, a Fed that's trying to stimulate the economy in that way. A dovish Fed, somebody that wants, a Fed that wants a less restrictive monetary policy. They want to stimulate the economy. They're rooting for spending growth, for economic growth in that way. They can also lower what's called the federal funds rate, which you hear rate hikes, rate cuts. This is the federal funds rate. Is basically the rate at which banks charge each other to loan money overnight is what the federal funds rate is, but that trickles in to all the other interest rates as well. So by lowering the federal funds rate, it allows banks to then, again, lower interest rates to consumers. We also had stimulus checks, right? These are quantitative easing is essentially money printing, but it's not like direct money printing like you might think. Anyways, one of the consequences of that kind of dovish Fed, a Fed in which wants economic growth and spending, that's one side where they try to help the economy, is through what's called quantitative easing. One of the consequences to that is inflation, because when people spend more, prices go up. Businesses raise prices. If I'm selling bubble gum to consumers and I sell out every day, I might bump prices up because I'm selling out every day. And when you extrapolate that over the entire economy, that happens because of quantitative easing for more spending. The Fed can then target the other side to that, because remember, their job is to make it balanced. So look at the Q breaking highs. Q breaking highs is up to 439.70s. Palantir still up there. Nvidia still at 874s. So we're still getting some runs here, specifically on the Q. Anyways, when inflation goes up and inflation's out of control, like one of the consequences of 2020 and the quantitative easing money printing that went on in 2020 was inflation. Prices went up. Rolex prices doubled. Bernard Arnault, now one of the richest people in the world. He owns Louis Vuitton, Hennessy, and all those other brands because people were spending money. You got stimulus checks. You got quantitative easing. Interest rates were low. That stimulated the economy, and a lot of spending happened. But again, because of that, inflation rose. A couple years ago, inflation almost hit 9% following 2020 and the dovish market that we had at that period of time. And so again, one of the Fed's other tools to combat inflation is the opposite of quantitative easing. It's what's called quantitative tightening, or QT. This can either be direct through, remember, quantitative easing is buying bonds. Quantitative tightening is direct. QT is selling bonds. All right, sorry, my wife's coming in here. Anyways, one of the consequences of quantitative easing is inflation. Prices go up. The Fed can combat that through raising the federal funds rate, i.e. causing banks to raise interest rates to consumers, or by either direct QT, which is directly selling bonds, or they could do what's called passive QT by basically just letting their current bond holdings mature and expire and run off their balance sheet, because quantitative tightening is reducing their balance sheet. All of these things raise interest rates to consumers, and again, when consumers are paying more money in a mortgage payment, as an example, they've got less money to spend. It pushes down spending, and that's called a hawkish Fed, when the Fed wants to push down spending. And so all these things can be good or bad. In individual markets, like right now, we're in a period of quantitative tightening after 2020. The Fed basically fears inflation. They want to discourage spending. through rate hikes is what we've got a lot over the last few years. We've now been in a period where we're pausing rates, where we're not raising rates, we're instead pausing rates. And the question is, when is the Fed going to start reducing the federal funds rate, bringing the federal funds rate down? If you want to know when interest rates, like a lot of real estate people are struggling right now because interest rates are freaking 7, 8% and nobody wants to pay that for a mortgage. If you want to know when interest rates are going to start going down, it's when the Fed's going to pivot out of quantitative tightening and go towards more rate cuts, more dovish stance. That's what we want to pay attention to here. Again, inflation is still high, objectively high. It's still almost 3%, but it's much better than it was like a year and a half ago at 9% almost, right? So we have gotten inflation a little bit more under control. The question is it under control enough for the Fed to pivot and start reducing the federal funds rate? Again, which would in turn bring interest rates down to consumers, allowing consumers to spend more. The question is whether spending is under control and inflation is really under control. And so conventionally, more spending is good, economic growth is good, higher GDP is good. But in periods like we're in right now of quantitative tightening, in which we don't necessarily want economic growth in that way, at least the Fed specifically doesn't, the market has and can react negatively to economic growth. And so that's the lens. All of this is leading into this point. That's the lens that you want to look at this economic data under, and specifically Jerome Powell, the Jolts report, non-farm employment that drops in about 8 minutes. Will more jobs be a good thing, be interpreted as a good thing? Because again, in periods of quantitative tightening and a hawkish Fed like we've been in, the market might not want more spending. And again, jobs contributes to spending. You know, we've had negative reactions to more jobs, which is against convention. You know, conventionally, more jobs is good, low unemployment is good. But in periods like now where we're fearing inflation, it might not be. And the market might react negatively to that, right? So that's the nuance of the market right now, economics-wise. And I hope that makes sense. I'm going to take a second, catch my breath since I've been talking for like 5 minutes straight. But yeah, that's the economic machine. Hope it all makes sense. All right, catch you back up on chat. Think we'll see a rate hike this year? No, not unless inflation spikes. I don't think we're going to see a rate hike. Yeah, thanks, Joe. Yeah, I hope all that makes sense. I try to break it down in an understandable way so people can kind of understand like what all these terms mean. Like there's a lot of trading and economic jargon that seems like The Big Short describes it as like they don't want people to understand it, so they just leave you alone, right? So I try to break this stuff down in like an understandable way so that people understand when you hear rate hikes, when you hear federal funds rate, when you hear basis point, when you hear all these different things, like what all of this stuff ultimately means, which is it's the Federal Reserve stimulating the economy in good and bad ways. All right, guys. Yeah, we got 5 minutes, 45 seconds left until the timer runs out. We still got about 5 minutes. Yeah, I'm also going to throw this thing in sub-only mode, guys. So if you haven't already, hit the subscribe button, hit the notification bell. We appreciate it. No rate hike. Yeah, I don't think we're going to raise rates this year. The question is, when do we cut rates? I don't think we're going to cut rates anytime soon as well. I think inflation has and can be sticky this year, and so I don't think we're going to cut rates either. June, yeah, I'm going with June as well. The timer is for non-farm employment data. Tesla dump. Is Tesla dumping down? Let's see. All right, guys. Hey, we got 4 minutes here. 4 minutes until non-farm data comes out. Again, after non-farm data, we have Jolts at 10. I'm very interested to see the market's reaction. If we don't get cuts this year, typically you think it will cause a negative reaction, but if it's a slow burn and an election year, yeah, I don't know. And again, if you haven't already checked out Apex, again, check out Apex funded account programs. They are a sponsor of mine. I'm super biased in their favor, of course. And remember, I have no idea what I'm talking about. I might be wildly wrong about anything and everything. But again, day trading is a very risky thing. Most day traders lose money in the beginning because it takes time to learn. You have to learn how to trade under pressure. Apex is the most legit funded program. What they do is they give you a demo and they test your skill. And the big benefit of Apex is that they have so many different options. Like I can select a 25K challenge. I can select a 300K challenge. And right now, guys, listen, resets are only $35. And so you can get one of these big boy accounts and reset it for $35 and get funded, again, 70% off right now. So it's 70% off of this. Very cheap. And again, they give you a demo. They test your skill. You can use Quant Tower as well with Rhythmic. If you pass the test, they fund you. If you don't pass the test, again, you're probably going to lose more money putting the money up yourself. I lost thousands of dollars in the beginning trying to day trade with a stock account. Lost thousands of dollars. Most new day traders lose. And so instead of risking thousands trying to look cool, again, try out Apex. Super cheap. In the 25K when you only got to make $1,500 on a demo account. And if you follow their rules and pass their testing, they fund you 25K with a 90% split. You can also get to keep your first $25,000 in profit as well. Tons of great resources. Just a really cool thing. And again, if you want to check it out, here's the link. They are a sponsor. Of course, I'm biased. But again, check them out. Here's the link. All right, guys, here we go. We got about 2 minutes left. Two minutes. Hit the live button next to the play button. Make sure you get fully caught up on stream. Yeah, I mean, I'm not going to say anything negative about Top Step. I'm still friendly with them. We just kind of pivoted to Apex. Yeah, I'm pretty sure you can say. I'm pretty sure you can. You just got to check with them to be sure. Again, the Apex link is right above you. You can also find it in the description. Just make sure you use my promo code if you want the discount. Promo code is BT. Beginner trading. So if you ever want to remember a promo code to use, BT, beginner trading, very easy. You can also use triple B as well. It's futures trading, and the futures market is very similar to stocks. There's no PDT rule though. That's the benefit. Anyways, the data is about to drop, guys. The data is about to drop. Lost 35K in the first 3 years. Exactly. And most day traders lose. That's why I think these funded account programs are incredibly useful, because it limits your risk. In the beginning, you still learn to trade under pressure, all that good stuff, but your risk is noticeably less, right? Like, there's a huge benefit to that. All right, here we go, guys. Here we go. Data's about to drop in 40 seconds. Hit the live button next to the play button. Make sure you're fully caught up on stream, chat. Wait. Okay, 25 seconds here, chat. All right, yeah, here we go. 10 seconds. Hit the live button next to the play button. Make sure you're fully caught up on stream chat. Gonna put all this stuff up so we can watch it. All right, here we go. 3 seconds. And 140,000, 140K is what payroll numbers. So payroll numbers came in low. So less jobs. The market so far has reacted positively to this. Again, 140K versus 149K or 150K expected. Less jobs, 140K. Again, hit the sub button. We cover this quickly. Again, we cover this fast. Market's starting to push up. We'll put the numbers up on screen. 140K versus 150K expected. Yeah, you get the max discount if you use promo code BT. Yeah, I've never said a negative word about them. Eli, come on now, don't troll, bro. Again, like I said, I'm friendly with both of them. Right now, we're just promoting Apex, you know. Sub right now. If you don't, I would never pressure you to subscribe. Like, listen, I'm not that type of guy. Like, I'm not that type of guy that will, like, put in a lot of pressure and, like, beg for subscribers. You know what I mean? Like, who does that? You know, but if you don't right now, I will hate you forever. Subscribe right now. Do it now. You know you want to. Just peer pressure. Try it one time. It might feel good. Just mosey on over. Hit that subscribe button, guys. Help me hit 130,000. Marcus, rip it up on this non-farm data here. Why would the market think less jobs is good? Listen, I spent a 5-minute breakdown into economics telling you why the market might not like more jobs, right? Again, did anybody hear my economic moment where I taught people U.S. economics and the Federal Reserve understanding, right? Again, the market might not want more jobs because the market still fears spending to a certain extent. Inflation is above targets. It's almost at 3%. They want it at 2%. Inflation fears are still high. And so opposite to convention, where conventionally the market wants economic growth and the market wants more spending, right now we're in a period of quantitative tightening and a hawkish Fed that fears inflation. And so in that regard, the market might not want more jobs because what does more jobs signal? More spending is the understanding of it. That's why. No, all good, JG. I'm just kind of messing with you, brother. It's all good, dude. Yes, you did an amazing job on your economics course. Yeah, this is probably the rippiest rip I've ever seen in markets, Craig. Top 3 biggest rips in the world right now. You know I'm gonna troll you if you get super mad about me saying rip. Alright, guys. Hey. Next, we got Jolts report at 10. We've got non-farm employment data out, came in lower than expected. Next, we got the Jolts report. Again, the interesting, look at Palantir break highs. Dare I say, ripping over highs for Palantir. Again, we need a... Hold on, there's Palantir rip up. I'm in Google. Again, I dip bought Google yesterday. You love to see it. Ripping. Top 3 rippiest rips in the world right now. Again, the Q up, Palantir breaking highs. It probably will drag the rest of the market up. Nvidia still consolidating around 874s. So Nvidia's still there. Oh, it's definitely the top 3 most sensational comment by me in the world. Yeah, I probably overused the word rip. Listen, y'all are right, I'm wrong. Y'all are smart, I'm dumb. Y'all are very handsome and I'm not attractive, okay? Palantir up to almost $26. Almost $26. Q up to 440s. Let's see if it holds. Yeah, it's all good, Code. He said RIP equals a 0.05% increase. Took me about a month to get used to disregarding RIP. Hey, you probably should. You know. How can the market go up with less jobs? Is it Billy Madison or is it Happy Gilmore? I thought it was when Happy Gilmore was apologizing to Chubbs. Is it that right or is it Billy Madison? The quote. I know it's an Adam Sandler movie. I just can't remember which one. Yeah, I thought it was Happy Gilmore. Alright, so again, Palantir ripping up. Gold bouncing over highs up to 2140s. Gold's approaching lifetime highs. Again, the Q up to 440s here. Dare I say, ripping over highs of the day right now. Yeah, I thought it was Happy Gilmore. All right, guys. Rip is a good word. Yeah. Palin's here at 2580s. Again, it's such a busy day, honestly. It's such a busy day. Like, again, stick around. We got Jerome Powell speaking at 10 a.m. We got the Jolts report. The next big report that could cause the market to rip is the Jolts report. The Jolts report coming out at 10 a.m. Okay. 8.9 million expectation. Now, again, the question is, does more job openings signal bullish or bearish market action? You know, again, more jobs might not be seen as an optimistic thing, especially if you look at the prelim ADP data that just dropped at 8:15 about 7 minutes ago. Came in lower than expected. Market ripped up. Now, the question is, what does the Jolts report do if it comes in higher than expected? If we get more jobs on the Jolts report, again, the Jolts report, I would argue, is a bigger report than the non-farm employment change data. Now, again, the non-farm data is just prelim payroll data. Payrolls come out Friday, right? So we get payrolls and unemployment on Friday. The Jolts report is arguably a bigger report than the prelim data. Now, non-farm payroll is much bigger than the Jolts report. That drops Friday at 8:30. Stick around right here. Again, we'll cover that, of course. But again, that's the question is, if Jolts comes in high, does the market go up or down? And I don't know. I think judging by at least the initial reaction to the non-farm data, the market still fears inflation. And again, we'll listen to Jerome Powell today on that same subject. You know, whether the market is going to be optimistic from this stuff, or whether the market still deeply fears inflation and wants it to come in lower than expected for jobs. Yeah, I get really trolly. It's like Jim in the office. I get really pranky when I drink, you know. Yeah, I mean, the only way to deal with trolls is to troll them back, you know? So if I sound really trolly, it's mostly because... And again, I don't think they're actually trolling. I think most of them are genuinely supportive. They're just kind of poking fun. And so I'm just trying to do it back. I'm drinking coffee. Which data is the most important? Jobs data, non-farm payroll data is going to be the biggest one, right? So for jobs... Non-farm payroll data is the biggest one. That drops Friday. Outside of that, I would probably say unemployment is underneath jobs, underneath payroll data. Underneath that is the Jolts report. Underneath that is non-farm payroll data, right? Just in terms of jobs. In terms of broad economic reports, the biggest one is probably FOMC meetings. Powell's speeches and FOMC meetings are probably the largest economic reports that we cover. Outside of the only other influential one that's bigger than any of the stuff was Nvidia earnings right now. But that's an isolated market right now where microchips are very, very relevant and influential. Outside of Nvidia earnings and Powell meetings, I would say the following one is CPI. The one that retail reacts to the most is CPI. Now, the Fed actually prefers PCE data, but the market tends to react more to CPI data. So I would say CPI is the biggest inflation metric, followed by PPI, followed by PCE. That's the biggest inflation metrics. Outside of those, you know, we have... I'm trying to think of everything else. We have GDP data, but that's kind of farther down on the list. That influences things, but not as big, I guess. And then you have earnings. There's a bunch of stuff that happens after that. But those are the most important ones, I would say. RIP is better than nuance. I say them both way too much, and that's okay. They're filler words. Yeah, Powell probably is the biggest influence. Well, PMI data is definitely not that influential. Like, we have ISM Service PMI, which is just the Institute of Supply Management, and then we have regular manufacturing PMI. But it's not the biggest, influence over markets, economic data-wise. Yeah, I speak how I speak. It's all right. I mean, listen, when you're on, like, y'all have to understand, when I'm on stream every single weekday morning for years and years, I'm going to repeat myself a bunch. That's just kind of how it goes. Like, we cover market news faster than anybody else. And so, you know, y'all be okay. I bought Alibaba, David. So I bought Baba. I'm green in Baba so far. So we've taken profit. I think we've added back on it. But yeah, I bought Baba. I bought Google yesterday. I'm green on that one. I've already taken some profit on it. I'm also in Boeing. I bought that dip. I'm down on this one, though, so I'm red. But again, right now I'm holding, these are my current holdings right now. I am holding Apple, AMC, ARM, Boeing, Baba, Citigroup, Chewy, Delta, Disney, Etsy, Ford, Gold, GameStop, Google, Home Depot, Honeywell, Coca-Cola, MGM, Microsoft, Nike, Oracle, Pfizer, Palantir, PayPal, Snapchat, Snow, SoFi, SoundHound, Tesla, Tyson Foods, Unity, Walgreens, Walmart, and ExxonMobil. Very green on this portfolio as well. We are green in, let me count how many positions we're actually green on. Green in 1, 2, 3, or hold on, let's just count the red ones. That'll be easier. We're red in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. We're red in 11 out of all of these. So 11 out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34. So 11 out of 34 positions were red on. So we're green on 23 out of 34 positions. So green in roughly 60% of them. You do you, John. We love watching you. Hey, thanks so much. I think if you look back at things, guys, most people understand that I've been pretty correct about things. A lot of people tuning in a year ago were telling me the market was going to crash, you know? And again, what you see eventually from those people is that, again, a year ago, maybe more than a year ago, in 2022, at the end of 22, so like a year and a half ago, or maybe this was 2 years ago. Time's flying by. 2 years ago, a lot of people were telling me the market was going to crash. They were making fun of me for being bullish after this big pullback, you know, right around here. A lot of people were making fun of me, trying to act like I was a perma bull or whatever it was. And what you see a lot is, like, you see people make all these big, bold, bearish predictions, and then you never see them again. Like, they make fun of you for being long, they make fun of you for being bullish, then the market rips up 24% in 2023, and then it's just kind of silence. You just don't hear from them again. Most of the time they probably create another account, they start pushing another market crash or whatever it is. But again, market crashes are not that common. I think the thing people have to understand is that crashes happen. Without question, they're gonna happen roughly every 10 years. But a lot of people would consider this at least a large correction. You know, this big 2022 drop at the end of 2022, a lot of people are at least going to consider this a large correction. You know, so when we have this big pullback, yeah, this was a year and a half ago, not 2 years. Sorry, my time was off. But when you have this big, large pullback, it's just not super likely that we're going to have another major crash or correction so soon afterwards. It's just not that common. Now, while that might be true, I'm going to give you guys the other argument here. The other argument is that AI tech is up way too much relative to where it should be. PE ratio wise, I think we're not crazy out of control in terms of PE ratios. Like, if we look at Nvidia, which is probably the one that people talk about the most, I'm sure the PE ratio is like 60 or 70. So PE ratios are objectively high relative to what would be considered good, but they're not crazy high. They're not high to where we're like, oh my gosh, it's too high. Like, it's high, But again, to look at another example, Amazon a year and a half ago was at a 60 or 70 PE ratio, and they did catch up to it. So Amazon did catch up to it. And so, yeah, if you look at NVIDIA, I'm showing a PE ratio of about 70 right now. That seems about right, about 70. But again, I think one of the risks we're in right now is an AI bubble. I think what happened in 2000 is that you had the internet boom. Like, this was when the internet was first becoming widely adopted and used for businesses. And so you had this bubble that started in the 2000s in which anything with .com at the end of it got crazy high valuations. In IPOs, they got crazy high valuations. A lot of money flowed into the internet companies. .com boom is what it was called. Eventually that bubble burst in 2000. You know, what started the burst is that a company called Netscape. Again, I've said this story, but it's a very relevant story to people predicting a market crash right now in an AI bubble. It's a relevant story. So I'm going to go over the story again. I'm going to tell you guys a story. I've said this story before on stream, but we've got a bunch of people here, so we're going to go ahead and tell the story again. So again, in 2000, we had a crash, right? One of the things that sparked this crash was earlier in the 90s, a company called Netscape changed the standard of IPOing for tech companies. Prior to Netscape, a company needed to have, I think it was around 2 years of profitability before it would really be adopted and be allowed to IPO publicly in the stock market. Not allowed, but it was kind of the standard, the unspoken standard. It needed 2 years of profits at least, right? Net profits. A company called Netscape, which was a browser company, IPO'd before that, right? And this was back at a time where browsers were used, the internet was still young, right? So people didn't really know how to use it. They didn't have all these different browsers you could choose from. And so you used to go buy the box of Netscape in the store and then install it on your computer, and it would show you how to get to different sites, different things, like all these different ways you could use the internet from these browsers, but you would pay for it. They IPO'd, you know, before they were really showing profits like that. And they had one of the most successful IPOs in history. They were worth billions of dollars after this IPO, right? And a lot of other internet companies started IPOing, and you know, at a similar time, you know, a bunch of internet companies started IPOing from mid 90s to 2000. Internet companies, .com companies just started flying up, getting crazy high valuations. Anyways, Netscape used to sell browsers. They started competing with Microsoft. Microsoft actually wanted to partner with Netscape, but Netscape said no. They didn't want to partner with Microsoft. They didn't want to do a deal with Microsoft. Netscape refused, and it created this fearsome competition between Netscape and Microsoft. Eventually, Microsoft did a genius move. Microsoft started including versions of their browser. Internet Explorer is what it's called. Everybody my age remembers Internet Explorer. Microsoft started including the Internet Explorer browser completely free with Microsoft operating systems. So anytime you bought a PC, you're going to get Internet Explorer, right? Netscape within a few years went from billions of dollars to only being worth a couple million. I think it sold it to American Online for only a couple $1 million years later, right? But what this kind of triggered was the .com crash, the internet bubble bursting. You know, a lot of companies started going bankrupt, started crashing down in stocks. Like a lot of these .com companies that had crazy valuations and unreasonable valuations to a certain extent started to pop and started to come back down. You know, so that sparked what was called the .com crash in 2000, and that was one of the longer bear markets we've seen in history. So if you look at like the NASDAQ 100 back in 2000, you can see it started here. Let me get this timer out of the way. So again, you can kind of see this is when the .com crash started. You can see crazy high valuations leading up to it. Like, look at these crazy high valuations leading up to it, like all in this area right here. And then the .com crash happened. So in April of 2000, you started to get this big dump, right? Like, look at this drop from 120 all the way down to 80. Think about the percentage drop that is. That's a 40% drop in the company. 40% drop, or no, 33% drop roughly. Yeah, so 120 minus 40 would be 33%. So a 33% drop. Basically, it lost a third of its value in only a couple, in only 3 weeks. The NASDAQ 100 lost a third of its value. This downtrend continued for a long time. We didn't get anywhere close to these highs again until, on the NASDAQ, we didn't get anywhere close to these highs again. Let me put a line here. Until 2016 was when the QQQ finally broke over the highs that it put in 2000. In 2000, it put in the highs. Now, the S&P 500, now this is a tech-heavy ETF. The Q is tech-heavy, right? So it's going to be a little bit more tech-weighted. You can put in the S&P 500 and look at a similar thing. Even the S&P 500, right? We put in crazy highs up here on the internet boom, around 1,500. We didn't see that again until 2007. Right, so it took 7 years for the S&P 500 to get back to those high levels from the dot-com boom. Again, it was one of the longer bear markets in history. We trended down. You know, again, there's only been 3 instances like this in history in which the S&P 500 trended down more than a year in a row. Right, like the S&P 500 trended down from 2000 all the way to like mid-2003. So 3.5 years of bear markets, one of the most brutal ones in history. And again, this led into 2008 and the mortgage disaster, which you can see was the mortgage crisis. Like 2008 is talked a lot because it's one of the largest one we have in recent memory, right? A lot of people forget 2000, or they just weren't. I wasn't trading in 2000, of course. But what you see from 2008 and the mortgage disaster, again, the Fed, going back to my economic stuff we were talking about earlier, in 2008 the Fed came through and did the same thing. They injected liquidity, they did quantitative easing, they brought interest rates down to almost zero, right? Stimulating the economy, allowing people to spend more, and so with this quantitative easing period, we just got a really big rebound back up, right? So we rebounded much faster from 2008 than we did from 2000, I think. Let me make sure, I might be wrong. Yeah, we rebounded much faster, but it still took some time. Like we only downtrended for about a year and a half from the 2008 crisis, and we bounced back by 2011, 2012, 2013. So it still took 7 years to rebound back to those highs from that period of time. You know, so again, if we're looking at risks market-wise, again, I talk a lot about bullish stuff here on this channel, but I think it's also important to talk about the risks here as well. The market's not just going to go straight up. We are going to get crashes. We are going to get corrections that happen. And so again, it doesn't matter as much if you're okay with holding long term. The people that lose the most in crashes are the people who get emotional and sell. Okay, they lose the most. But it depends on your specific situation. If you're somebody who is retiring imminently, you want to play very careful attention and probably be more risk averse than somebody like me who can sit in the market for the next decade and not really worry about it that much. So yeah, I hope that all makes sense. Powell's speaking GMT wise, I'm not sure. It's at 10 a.m. Eastern Standard Time. I'm a long-time 6-year NVIDIA obsessed investor, Series 7, 20 years retired, age 41. Yeah, I mean, NVIDIA's making, they're a money machine right now, bro. I agree with you in that way. But nice, Matthew. Good job, bro. Yeah. Somebody's upset, man, in chat. Come on now. Yeah, what is this guy ranting about pawn? Do you see this guy, man? He's so upset. Like, listen, bro, like, people get so mad on the internet. Again, the reality is trading's difficult and most day traders lose money. Without question, most day traders lose money, right? I think a lot of people are justifying gambling in the stock market. Because, again, I've said this before a lot. But if you're a gambling addict and you just have no discipline at all with yourself, right? You could either go to a casino and put all the money on roulette. You tell people you made 10K in roulette, they're going to look at you like a degenerate gambler. You tell people you made 10K in the market, they're going to look at you like you're some prodigy savant, genius. And so a lot of people are really gambling, and they're really gambling, but they want it to look like they're some stock market expert, right? Again, we criticize that highly here. But again, getting mad at somebody, program error, that tells you they're not an investment professional, they're not an expert, I'm not even claiming to be a good trader. We don't charge for content either. I literally tell people multiple times a day, every day, like, read the bottom of the screen. We're not an investment professional. I'm not liable if you lose. My channel is literally called beginner trading. It's literally called beginner trading. So listen. Most people are it's hard to be introspective. Like, if you lose a bunch of money in the market, most people don't have the maturity to be like, hey, I took a bunch of dumb trades. It's my fault. Completely my fault. If you lack that introspection and maturity, it might be a lot easier to be like, yo, it's John from Beginner Trading's fault, or whomever, right? But in the end, you got to be accountable to your own bad decisions. Remember, I'm terrible at this stuff. Have no idea what I'm talking about, and might be wildly wrong about anything and everything I say. Wildly, I have no idea what you're saying. Definitely top 3, no idea what I'm saying, traders in the world right now. Yeah, he speaks in front of both the House today and the Senate tomorrow, is what it is. Why are you asking if the market will break highs? I'm genuinely curious about what people think. Do you think the market's going to break highs? Well, it depends. Long-term investing, the odds are in your favor. I mean, it's still risky. You're still going to have variance. He's speaking at 10 a.m. Yeah, it's very risky to trade while he's talking. Yeah, there's Jolts report, Barry, at 10 o'clock. So we had non-farm employment data already out. We also have the Jolts job report, which shows job data coming out right at 10 a.m. when Powell speaks. So yeah, we got a lot of data coming out. All right, so we got non-farm. So we got to change our title. All right, so we're getting ready here. Sorry, guys, forgive me. We're probably gonna buy some of these dips here if we get some. I don't know, on a shorter term trade. I might be wrong. Don't copy me, of course. ADP non-farm employment change data is prelim non-farm payroll data is what it is. So every time payroll data comes out on Wednesday, typically you get prelim payroll data. That's the non-farm employment change data that came in at 140K. The actual payroll data comes out on Friday with unemployment is what it is. Yeah, but I mean, to be fair, Yair, we kind of do continue to break highs. You know, like, I know that's kind of the opposite of what you've been predicting or wanting more so, I think. And again, it's all love here, bro. It doesn't matter either way. Again, I stopped buying up a lot of stuff too because I think the market's too extended, right? But to be fair, you know, the market has been breaking highs every day. Nvidia specifically has been breaking highs every day. Nvidia up to 870s. That's the lifetime high. If we open up here, we're breaking lifetime highs. Right around lifetime highs at least. 876 is the lifetime high. So right here. So we're pretty close to lifetime highs. It's certainly not outside the realm of possibility. That's why I'm more asking it on the poll. I mean, Yair, man, the poll is just asking a question, brother. It's not making a point. We're just asking people what they think and judging sentiment from it. It's not like we're telling people to do anything. We're saying, hey, what do you think the market's going to do? And I don't think that's a bad poll to have. Again, I get it. You might not like the market going up or whatever, but the poll's just asking a question, brother. All right, let me get this ready for Powell here, man. All right, so we had payroll numbers come out. Alright, sorry, we're adjusting all this stuff. Yeah, I mean, again, it's all love, Yair, but, again, the poll is just asking a question. I don't know how we can criticize that. People, I mean, again, it's all love. It's all good. Again, market can just be super unpredictable. Again, the very famous quote is that the market can stay irrational longer than you can stay solvent. Very true. Very true. So just be smart, guys. Again, one thing that we preach here more than anything else is that trade small. Only trade with money you're okay with losing. Don't justify gambling just because it's the stock market. All right. Most day traders lose money. I would say most traders lose money. Not even day traders, just traders in general. Investing seems to have a large edge, but it's only long term, over a 10-year period or more, typically, that you get that edge to really be reliable. But yeah. Again, we do have the Jolts report, though, today, man. Just a crazy day. Honestly, crazy day. Get rid of the non-farm employment change data. So we got non-farm data out. Next, we got the Jolts report going live. All right, guys, get ready. Again, Powell getting interviewed by the House. We got Powell live. Sorry, I'm kind of editing some stuff here. Powell is speaking again at 10 a.m. Again, we got the Jolts report coming out today as well. Jolts report, I believe it's expected at 8.9 million here. I'm going to put the SPY up on the left side. There's Palantir still breaking highs. NVIDIA up to 875s almost. SPY still ripping up over highs of the day. Again, non-farm data came in at 140,000, lower than expected, less jobs. So you guys ready? All right, again, we got the Jolts report as well, man. Yeah, Powell speaks at 10. Again, he's supposed to talk about interest rates, inflation, what they think inflation's doing. So, yeah, it'll be a fun time. Let me know if you like the music. You want me to switch it up to other music. There we go. All right, we're finally catching back up. Let me see what people are saying. You hold crypto, you're smiling. Great advice, host. Powell speaking at 10 o'clock. Definitely the rippiest poll in the world. Again, I think the biggest thing people understand, like I think the biggest thing that I see here is that people think the market has to do something, right? If you think the market has to do something, you don't understand the market, right? Remember, the stock market it indirectly reflects company health, but it's more so based off of mass psychology. All right. And so I guess the point is that the market doesn't have to do anything. The market doesn't have to do anything. It can go up, down, or sideways, regardless of what you want to happen. I think confirmation bias is so strong. I think people take a bunch of risky put options, take a bunch of risky short bets, and then when the market continues to go up, they get more and more emotional over time. The reality of it is the market doesn't have to do anything, and you always have to be aware of that the market could do anything it wants. It doesn't have to do anything. Again, it's about mass psychology. Now, company health reflects it over time, and when you zoom out on a macro sense, it does reflect company health. But when you zoom in short term, and when I mean short term, I mean like over months. Like months is short term when you look at broad markets. The market can do whatever it wants to do. You know, it can go up, down, or sideways. The biggest edge is on the upside for markets as well. Like the market pushes up over time. Like over a 10-year period, the market is almost certainly going to go up. And so, in my opinion, the biggest edge is going long, but I certainly could agree we might be extended right now. But I hope I'm wrong, and I hope the market continues to rise. Because, again, that's typically the best thing for everybody is the market going up, kind of hedging against inflation. But the market goes up because of inflation to a certain extent as well. Dollars are devalued over time, and so companies earn more because people spend more because dollars are devalued over time, right? That's one of the reasons the market goes up. And again, what the stock market, the bond market, the crypto market, the real estate market, what this all does is it's a hedge against inflation. If you don't invest in something like that, you're going to lose money over time to inflation, you know? A house 10 years ago is worth, or a house 20 years ago is a better example, is worth, a 50K house 20 years ago is worth much more nowadays, because again, prices rise. You can invest in real estate. Conventionally you can get a mortgage to invest as well, because again, over time your mortgage payments, because of inflation, are going to be less influential as long as your earnings go up over time, which they should, right? But again, right now interest rates 8%, 7%. I'm not really, and most people are not necessarily interested in buying a house as we speak. And again, we'll see when the Fed decides to start ending quantitative tightening. That's usually when interest rates are going to start to go down, when the Fed starts cutting rates as well. That'll influence interest rates as well. But again, I don't think we're going to cut next month. Since people are mad about the poll, let's go ahead and end this poll, and we're going to ask a more reasonable question, I guess. Let's ask, when does the Fed cut rates? That's a question. When does the Fed cut rates? We're going to go with March, May, June, or July plus. Guys, vote on the poll. Somebody will find a way to get mad at this poll too. Yeah. Yeah, for sure, Matt. How do charts really help us? That's simply dollar cost averaging and not daily trade. We trade the run, not the daily charts. Yeah, I mean, dollar cost averaging is powerful. I mean, but the whole point of dollar cost averaging is to hedge against volatility, or not hedge, but is to protect yourself against volatility. If you don't know what DCAing is, dollar cost averaging is, it's making periodic buys of something, regardless of price in specific time intervals. So like, I'm going to buy 50 shares of Apple every month, for the next 5 years. And, regardless of price, if Apple goes up, it should profit, regardless of entries, I guess is a better way to say it. You should put a 5-minute delay for new subs to type. The haters, again, like, the haters think that they're hurting me. Most of the time, they're just giving me something to talk about. If not, I'm going to repeat myself over and over again. People are going to get mad at that. I'd rather have something to talk about than nothing. And so, in human nature, they tend to like drama sometimes. And so I embrace it. I just kind of troll them back. It turns into a fun thing for my channel. Yeah, let me put a timer up. Again, we got about an hour. We got about an hour left. So we got about 1 hour. Let's put the timer up. Here's the timer. SPY breaking highs of the day. Yeah, what I will say though, guys, is like, we got a lot of bearish traders. Okay, we tend to have a lot of bearish traders here. The only thing I'm gonna say is this, all right? Like, if you find yourself getting mad at me because I've been bullish over the last couple months while the market has been pushing up and breaking highs, again, you're most likely just emotional about your own wrong predictions. Like, you see it a lot, right? Nobody cries manipulation more than somebody that's been wildly wrong about a prediction in the stock market or markets in general. Again, you're not really mad at me. You're mad at the market. And again, you can't really knock me for it. Again, if I've been bullish and the market's gone up, what are you really mad about? Again, in the end, you want to take positions that you're not going to be super emotional about, right? So if you're taking a position that's so large that you're emotional and getting upset at random YouTubers for having an opposing view, then you're probably trading too large relative to what you should be trading. So scale down your size, guys. Like, trade small. Trade in such a way where you can laugh at the opposition towards your view, and it'd be okay, And again, I just see a lot of people that are not like that are just super emotional about it. Either way, it's all love here. It's all good. Yeah, my wife spends so much as well. My dad was always a little bit more frugal, and so if I went to the store and wanted something, I wasn't about to get it. My wife was kind of the opposite. So like, my wife ends up if I go to the store with my wife, bro, she is packing the cart super full. And like, we have the money to pay for it, but like, it's a different experience. I get stressed out. Even if I have the money to do it, I'm the type of person who gets stressed out from too much spending. I think I get it from my dad. And again, I can respect my dad because, you know, I think that's a good way to be. I think with kids, a lot of the time, you don't want to give them too much. You got to make them value money, you know. Yeah, I'm not mad at it. When do you think we're going to dump, like inflation times, when we hit rock bottom and we're in a bear market? I don't know. In theory, quantitative tightening and a hawkish Fed, reducing their balance sheet, should, in theory, cause drops in markets, right? Because we're discouraging spending, and less spending is bad in stock terms as well, because less people have money to invest in stuff. But right now we're in a period of stock market rips, so it's kind of opposite to what a lot of people thought would happen during quantitative tightening phases, in which they thought, or assumed, I guess, the market would go down in quantitative tightening, where we have a hawkish Fed trying to push everything down. Again, I think it's pretty obvious to see why the market's ripping up, though. It's mostly from AI stocks like Nvidia. You know, Nvidia has single-handedly propped up the market. AMD, Nvidia, tech stocks. So even though we're in a period of quantitative tightening and a hawkish Fed that's trying to reduce spending and lower inflation, we're still ripping up over highs and all this stuff because of AI, mostly in tech, right? So we're in this really weird market. Again, we could be in a bubble. I'm not sure. You know. Yeah, we're going to be trading on Apex today for sure. First time here, so not sure if you talk meme tokens, if you do anything you're bullish on. I don't really trade meme crypto. I've been watching Bonk, B-O-N-K, you know, Pepe a lot. Those are kind of going crazy. I'm not really a big investor in those, but I think there can be some good trades with, like, I think trades in which you're kind of risking what you invest in it for a potentially high reward. I'm not necessarily like mad at that type of stuff, and I've been watching those markets some. We have a crypto channel as well. It's called Beginner Crypto. If you want to help sub to that channel. Powell speaks at 10. We got the timer up in the top left. Yeah, I'm not going to call it a bubble. I'm saying it could be. It just depends. Again, the question is, okay. So we had these crazy Nvidia runs, right? And everybody's kind of like, oh no, you know, Nvidia's run too much or whatever. The real question is whether Nvidia's bottom line is influenced in a positive way to justify the increase in price, right? So if we look at Nvidia graph, right? So here's Nvidia's revenue graph. You know, so if we look at Nvidia's revenue graph, okay? Nvidia's revenue has been increasing significantly from AI. And so in terms of whether we're in a bubble, you got to see whether they're bringing in more money from AI, like to justify the price increases. I would say over the last 3 quarters, you've seen over 50% growth in revenue from Nvidia. So, I mean, that revenue burst is pretty significant. You know, like, that's a pretty big bounce here, of course. Like, that revenue burst is pretty significant. And so, yeah, I guess the point is, like, Nvidia has seen massive benefits from AI in terms of revenue that they're bringing in. Now, again, revenue is kind of like the ceiling. We can look at EPS if you want margins, like, to see what their margins look like in all this stuff. And again, even their EPS, which is margins, you know, EPS is earnings per share. It's how much they're making. Let me make sure this is Nvidia. Yeah, this is Nvidia. So again, margin-wise, their EPS is skyrocketed as well. So again, on their bottom line, in terms of how much money these companies are bringing in, at least NVIDIA, which is kind of the alpha AI stock, has seen a direct, huge influence from AI, you know? And so, again, I'm not saying we're not in a bubble, but what I am saying is that we have seen massive benefits from AI on NVIDIA. Now, whether they're going to catch up to the PE ratio is another story. NVIDIA just broke highs. With all that said, look at NVIDIA. Just broke highs. Up to 877s right now. 877s on NVIDIA. Just broke highs. Yeah, I'm not saying it's anything against Mandy or Sharon or anybody here. What I'm saying is that some of these people are really guys named Steve that live overseas and are just trying to, you know what I mean? Nothing against anybody. I just immediately, I don't trust anybody here. There's too many scammers out there. So again, if anybody reaches out to you being nice and flirty, asking you for money, just don't send them money, please. Like, be smart. Again, NVIDIA just broke highs, got up to almost 880s, man. When the next step, I think, is 1,000. Will NVIDIA break 1,000? Again, the PE ratio is high for NVIDIA. Now, to give you the other argument on the other side, NVIDIA is high. So the PE ratio is high, NVIDIA's up there. Yeah. Somehow we're up a bunch today. We're up like 230s, 240s. I know you're trolling a little bit, but I'm going to delete your comment anyway. Hold my. Powell speaks at 10. It might be in the title. It might be on the bottom of the screen. It also might be all over the internet. People asking what time Jerome Powell speaks. Listen, guys. Literally the title says Fed Jerome Powell testimony 10 a.m. Chat. Do better. Okay, do better. Just look at the title. All right. All right, we'll put this up. You're welcome, guys. Just read right this general area right here, okay? Can you change the title to NVIDIA? Just NVIDIA? Never met a girl my age who wasn't a professional at breaking hearts. What, so how old are you? 13, Jay? Okay, well, you might be real, Mandy. Again, I'm just saying it just in a general sense. It's all good. I appreciate you being here on the channel. All right, and my apologies for any thirsty dudes out here. But yeah. Not you specifically. I'm not, like, attacking you specifically. I'm telling... You got to understand here. Like, my daughter and I's favorite show is Catfish. Man, look at NVIDIA rip up. We're at 881s right now, still moving up. SPY up there at 510s. Again, my daughter and I's favorite show is Catfish, right? And I teach my daughter this stuff because, again, if some handsome dude messages my daughter, like, sup, you know? Like, how's the vibes in here? Is it bussin' vibes in here right now? Sup? And he says, yo, I'm 14, and, I want my daughter to be skeptical, you know? And watching the show Catfish has helped that, you know? My daughter's not going to trust anybody that messages her nowadays. She's going to think it's some dude named Bob, you know? And it might be. All right, guys. Hey, we're going to start day trading on Apex today. Again, we did get funded on Apex. I'm going to put NVIDIA up here because NVIDIA's going crazy, man. But we're also going to be day trading today. Let's have some fun. Let's try. All right. Hey, thank you, SP. Thank you, brother. I appreciate it. Yeah, I think right now with filters, bro, filters are out of control. Dude, I got like, my aunt is like 65 years old, just straight like glowing, no wrinkle face. I'm sitting there like, bro, like, come on, man. People look ridiculous on the internet nowadays, dude. People look absolutely ridiculous right now with these filters. Like, come on now. You know, I see a bunch of people I went to high school. They're glowing. They look like Edward from Twilight. Like, they look absolutely ridiculous right now. It's going out of control, to be honest. It really is getting out of control. All right, let's day trade today. Let's have some fun. Yeah, sparkling vampires. They really do. Underground says they sparkle. Vampires don't sparkle. Listen, bro, you need to research vampires. Okay, research Edward Twilight. All right, culture yourself, kid. Like, come on now. All right, guys, we're getting ready to day trade. All right, let's trade. All right, so we're in here. Or no, we might have to trade on Tradeovate today. Let me see. That's where my actual funded account is. I gotta wait a day or two or something until I get funded on the other one. Let me log in and see what's up. Hold on. Yeah, there's my rhythmic one. All right, so we're up like $100 on one of our Tradeovate funded accounts. All right. Let me pull this up. I gotta wait to get my Quant Tower one set up. We still gotta wait and take some time. Again, the Nasdaq's been flying up with all this stuff too. Here's Tradeovate. The futures market's useful, guys, because there's no PDT rule. You can day trade short and futures. That's what we're going to be day trading at the opening bell. I'm going to put up two charts instead. The SPY and NVIDIA here. Look at NVIDIA up to 881s. Again, the reason futures are useful, again, I'm always honest. Most day traders lose money. So it doesn't matter whether you day trade stocks, whether you day trade futures, whether you day trade options. You're probably going to lose money in the beginning. It's kind of necessary to have risk management. You have to feel losses. You got to have that burn sometimes. The reason futures are useful is because there's no PDT rule. So if you want to day trade stocks, you need 25 grand in a margin account to do so with freedom, to like where you can take as many trades as you want and do whatever you want. You need at least 25 grand in a margin account, which is a crazy thing. Making new traders risk 25 grand is just the dumbest thing ever. The good thing about futures though, like if I want to buy the SPY and day trade the SPY, if I do it in stocks, I need 25K plus in a margin account, but I can day trade the same price action as the SPY or the same price action as the Q in what's called the NQ in futures, the NASDAQ 100 futures contract. It's actually what the QQQ tracks. I can day trade the NASDAQ in futures, the NQ, No PDT rule. I can day trade short, buy market, sell market, all that good stuff. In futures, no PDT rule. Day trade it without restriction for the most part. And what Apex does, and again, they're a sponsor. I'm biased because they pay me money. And so, of course, I'm biased in their favor. Remember, not an investment professional. Understand this rule. I'm terrible at this stuff and have no idea what I'm talking about. Remember this, guys. Okay? Terrible. No idea what I'm talking about. Might be wildly wrong about anything and everything I say. But the reason Apex is useful is because it limits your risk. I still think most day traders are going to lose because it doesn't matter where they go. Most new day traders lose money. But it's a lot cheaper to lose on Apex. Again, they give you a demo. They test your skill with the demo account. If you can pass the test, they fund you the same amount. The base one's $25K. They give you a $25K demo account. It's only like 25 or 30 bucks right now, I think, if you use my link and if you use my coupon code specifically, which is BT. It's like 20 or 30 bucks right, something 25, 30 bucks right now. And it's the best of both worlds. If you lose, you're out 30 bucks, 35 bucks, whatever it is. Not the end of the world. But if you're good enough to pass it, like the base one, you make 25, you take the 25K demo and you make 1,500 in profit while following their rules and conditions. They fund you 25 grand with a 90% split. So you're keeping most of your money anyway. It's similar to putting the money up yourself. There's just noticeably less risk. And I think that makes a lot of sense. Again, I'm biased, of course, because they pay me money. I'm biased. They're a sponsor. But again, I think it makes obvious sense. You know, I just think it makes sense. And again, if you want to check it out, you can use promo code BT. Get 70% off. Check out the link right here. Shameless plug for a sponsor of mine. I think everyone says for an inflection point in May, but I also don't expect the Fed to react until after there's some real problems. Yeah, what I will say is watch inflation data. What's up, Tiny? Hope you're doing good, Tiny. Hey, thanks, Tiny. Small caps. I don't really like small caps. Yeah, sponsors keep the stream going. Again, I plug sponsors in about the most reasonable way anybody would want. You know, I tell people I'm not an expert. I tell people I'm biased. I tell people I'm, you know, all that good stuff. And so I think that's the best way to do this. You know, like if you're gonna do this, you might as well tell people you're biased. You know what I mean? So that's what we try to do. Time to turn off World of Warcraft. Hey, we got 11 minutes. The code is BT, Life of Gabe, BT. Beginner Trading, BT. You can also use triple B, BBB. But yeah, that's my code, BT, Beginner Trading. Yeah, definitely top 3 plugs in the world right now. Most reasonable plugs too. You know, top 3 most reasonable sponsor advertisements. We got Big Papa Jerome Powell coming out later. We're also going to do a day trading stream after that, I think. Wait, does my when I plug it to chat, can people see the? Let me see. I gotta make sure people can see. Yeah, BT for discount. Trying to help someone overseas right now, a friend, and sending money overseas is kind of a pain. That's why crypto is useful, brother. Yeah, Bitcoin. A lot of people, like, I hear the argument, like, what does Bitcoin do? It's not a real currency or whatever it is. But, like, there's a huge argument for crypto. We talked about it yesterday. The argument for Bitcoin is that it allows you to send money anywhere easily and fast. You know, you try to use PayPal, you know, struggles. Yeah, I agree with that deletion, Pawn. Sorry, bro. Too controversial. Imagine you send 10K and by the time it reaches him, it's 9.8K. Yeah, but that's what PayPal is too, bro. You try to send 10K, they're going to take a couple $100 at least. Again, I've done it. Like, it happens. Wires are not any better. Powell speaks at 10 a.m. with the Jolts report also at 10 a.m. So we got a lot of stuff happening, but that's the big things. Powell and then the Jolts report. I'm pretty sure you can hook TradeEvade up to TradingView, but I'm not sure. With Apex, I know you can, but with Rhythmic, I like using Quant Tower. So So that's our funded one. All right, here's the opening bell, guys. We got 7 minutes. I'm completely neutral. It'll be a volatile day. Again, the Jolts report at 10 in about 35 minutes. Powell at 10. Just a crazy busy day, honestly. Just super busy, to be honest. On Apex, they show fees of $167. You got to use my promo code at checkout, Natalie, and you'll get the 70% off. So use promo code BT for beginner trading. If you ever need a promo code, it's super easy to remember. Just BT, beginner trading. All right, guys, we got 6 minutes left. 6 minutes left. Y'all ready? Let me look at our poll. We asked people when we're going to cut rates. July plus. I tend to think we're going to be in June. So we got almost 730 votes. I tend to think we're going to be in June, but I'm not 100% sure here, to be honest. Again, I'm gonna reiterate this joke I made earlier, but this joke is absolutely true. I posted it on Twitter. People leaving me chat messages like, "Hey John, if Jerome Powell stubs his toe at exactly 8:23 a.m. Eastern Standard Time, does the market go up or down from it?" I don't freaking know. You know, again, if the rooster crows when I walk out the door and then take 3 steps to the left and then see a fire truck roll by, does Nvidia break highs today? I don't freaking know. Paladin's here up to $26 a share. We'll see if it holds. Again, Nvidia breaking highs right now. Speaking of Nvidia breaking highs, I guess the answer is yes. I guess the answer is yes. Because, honestly, market's going crazy. We got the Jolts report coming out today as well, guys. Remember, the Jolts report going live today, too. I like girls who wear Abercrombie and Fitch. Abercrombie and Fitch is going crazy, honestly, too. Look at this. So, again, there's the NASDAQ breaking highs up to 18.1K. Here's Abercrombie and Fitch up to 145s right now, 145s. What a crazy run. Tesla bouncing back a little bit today also. NVIDIA 882s, almost 883s. Let me put the SPY up here as well. 510s, breaking highs also. All right, guys, here we go. We got 2 minutes here, team. 2 minutes. Oh, man, as someone who was alt in high school, I hated AF. You were emo, weren't you? You know you were emo. My wife was emo. I make fun of her all the time about it. You know, she loves My Chemical Romance. You know, she tries to make me listen to Black Parade at least once, or at least a few times every year. I'm not even mad. Listen, I kind of got into some of the music. I never dressed that way. Like, I was never an emo kid, like, in terms of how I dressed. Again, I dressed in what the girls liked, right? So I'm dressing preppy, you know, polo shirts or whatever. Again, I say it all the time. If girls like pink bunny suits, I would have worn it. But I listen to emo music. Like, I like The Used. I listen to a lot of The Used. I listen to AFI. Like, I listen to, like, a bunch of that music is just good music, man. You know, listen to Brand New. Love Brand New. Brand New is probably my favorite band. Emo band, that is. Not my favorite band, but my favorite emo band. So I'm not judging you. You know, I like it, kind of. Hey, I'm not judging you, Kay. Like, it's all love here, it really is. All right, team, here we go. 30 seconds. Yeah, Buried Myself Alive is good, Mickey. The Used. Whichever one that goes, I can't think of what it's called. I know I gotta look it up. All right, guys, here's the opening bell. Here, we'll look it up later. NVIDIA pulling back to 880s. SPY up to 510s. Ding, ding, ding. There's the opening bell. The NASDAQ shooting up at the opening bell. Got up to 18.21s. Dare I say, ripping up. Let's see if it retraces back. But so far, we're getting some gains at the opening bell. Tesla has gone all the way to green on the day now. Tesla up to 181s. Technically green on the day as we speak right now. Technically green on Tesla so far. Gold is almost to highs. Apple falling down pretty drastically at the opening bell, though. Yeah, the music's just good music, though, some of it. So Echo, it depends on what you're trying to do. If you're trying to use a funded account program, again, I would use, oh, the 99, I mean, yeah, it depends on which one you're using, brother. Remember, today alone, $35 reset, or not today alone, but $35 resets. Pretty cheap reset-wise. So I think the move is to get a big, expensive one and then reset it for 35 bucks until you get funded. I think that makes a lot of sense. NASDAQ ripping up, breaking highs here. Ripping up, breaking highs. Apple's still looking kind of weak, giving back some of the gains it made on the day. Tesla turning back down as well. Do I want to buy this dip? My sizing is way too big here. Let me fix this. Big turnaround here. We might short. I'm going to let things settle here first. Big retracement back up, honestly. Nvidia's testing that 200 EMA now. I'm short. See if we can make a little bit. All right, so we're trying to build up a cushion. We just made 35 bucks shorting the NASDAQ. I got out of it quick because I'm watching Nvidia. If Nvidia starts to make another run back, that would punish short. So we got out of it quickly here. All right, so Nvidia back over the VWAP here. Let's see if it holds that level. I'm gonna short this. I'm short right now. I want to see if Nvidia rejects this level here. I'm going to cut this pretty small. I don't like the fact that Nvidia is still starting to move up. It might be a choppy day heading into Powell, too. It really might be. But Nvidia's starting to head up there here. Apple breaking down. So Apple's looking weak. Nvidia's starting to head back up, though. Look at Apple breaking under lows, or breaking under lows of market hours, and also technically red on the day. Tesla is as well now. I think I gotta short this, right? I don't know, man. I'm waiting. Don't copy me, guys. I have no idea what I'm talking about. I might be wildly wrong about everything. Meta's flying up to over $500 a share. And Nvidia looks green. I'm gonna buy this down here, I guess. Come on, give it to me. Kind of flat on the trade. Ugh. It gave it to me, all right. We're gonna have to cut that now too. We'll try to win the money back, but I don't want to take too much risks leading to Powell. I see Meta flushing down too. I think we got to take a larger risk here and scale into a larger trade and see if we get a breakdown. Flat on the trade. All right, we took half off there, locked it in. See if we reject here, which is what we want. We want a rejection. Boom. All right, so we just made most of it back. We got $110 down on the day. If we get another little pop back up, we'll short into that as well. Watching Meta a lot. Meta's bouncing right at 500. Big breakdown flush. We could have held it. Here's the timer on the top left. Look at this big bounce up here too. Nvidia just broke highs. That's what's dragging the market up right now. I'm gonna probably move to maybe trade micros here, I think. I think micros I'm gonna be a little bit more comfortable with. I can take larger size and try to build up a cushion first. I don't like this at all. I'm gonna short this. 4 contracts, 8 contracts. And try to scale in. There we go. All right, we took half off, locked a little bit of profit in there, I think. Maybe not. There we go. All right, took half off there. Grinding it up. Took that off. Let me fix this so we can actually see. Yeah, there we go. All right, we're in 1 contract here. We're mostly flat on the day now. We're going to go ahead and get out at the lows. We're mostly flat. We're down like 20 bucks. So we're kind of slowly grinding our way back here. I do think this all looks weak. And so I'll probably start targeting a scale in here on micros. Try to scale into a position of like 4 contracts or so. There we go. Took half off there. Locked it in. Almost green on the day. We only got 3 contracts now. I'm kind of flat on this trade. It's kind of taking too long though for my taste. I got the option of either adding to it or I'm going to add to this a little bit more, see if we can catch some better movement here with 5 contracts, but I like the sizing. I like micros better, and I can take a bunch of micros on Apex. One of the big reasons I like Apex is because I can take up to like 100 micros or something, and so I can trade smaller, and this is like a much more reasonable size. The regular NASDAQ moves so quick that it's hard to capitalize on it. Flush. Yeah, this is taking too long. We're going to have to cut this. All right, so going back and forth, not the end of the world. We'll get ready to scale in. I like those 2 contract intervals. Watching Nvidia very closely here to see if it flushes too. Apple and Tesla now looking weak on the day. Yeah, but I'm trading futures, Matthew, and so I'm day trading futures. I'm mostly shorting the market into Powell. Kind of losing on those last few trades. But see, the only way, I wish there was a way to get out of these positions. Oh crap, I just took double the size. Or no, okay, I got out, good. I was about to say. We'll wait and see if we get some better movement. I don't know what's going to happen in the NASDAQ. Yeah, we're going to stream the entire Powell speech. We also have Jolts coming through today. Nvidia very flat. Apple's still looking kind of weak, and so is Tesla, but Meta's ripping up today. Palantir's doing well. Nvidia's starting to rise up, though. Let's see if Nvidia does like this cup and handle breakout type of move. SPY right at the 200 EMA as well. Yeah, I don't know if I like... I mean, we're watching NVIDIA closely here. What you have to watch for it is, like, if NVIDIA starts to rip up, then it's probably going to drag the rest of this stuff up with it. Like, here's NVIDIA. But NVIDIA, very stagnant, very sideways. Look at NVIDIA here on the bottom right chart. Just still moving. Yeah, I would be very careful holding anything through this speech, chat. I'd be very, very careful. Meta, up to 501s. All right, guys, we got 20 minutes before Powell here as well. 20 minutes. We will be streaming the entire speech for Powell, the entire testimony for Powell live, like we always do here, chat. So remember, we will be streaming Powell's speech live. It's a testifying in front of the House today is what this is. NVIDIA just ripped over highs, 884s right now, chat. 884s. Pull this down. Let me get this out of the way. NVIDIA's starting to fly up. I don't think we're going to hold. I think we're going to go flat, and so I'm going to bet that NVIDIA is going to go down. But I might just be wildly wrong here. It's a risky bet. But we're not taking big size. We're trading 3 contracts in micros. Alright, scaling out. We were correct about the choppy action here. Alright, so we're out. So we were right about the choppiness. This is all lo-fi music. Very worried about this pump. NVIDIA still ripping up, breaking highs right now. Look at that. 884s is the new lifetime high for NVIDIA. We're about to break over it. It looks like again. Might as well play with this. 884s. We're going long now for a small trade here. Just see if NVIDIA keeps rising up and it drags the markets up with us. We'll see. Again, NVIDIA breaking highs. Still going. Apple and Tesla are what's breaking down today, dragging the market down. Palantir's still doing okay. Yeah, we were hoping that NVIDIA would help the market enough, but NVIDIA just ripping over highs. And market mostly flat. Again, I'm going to start to limit my trades. And we'll trade a little bit more during the actual Powell speech. But yeah. Again, we're going to stream the entire thing live, team. You guys ready? All right, look at NVIDIA, rip it up, breaking highs. Again, the Jolts report drops at 10 a.m. as well, team, so just be ready. Guys, the Jolts report drops at 10. You still got 14 minutes here, chat, 14 minutes. 888. See, I was right about this trade too, but again, just getting chopped out of it. Super micro semiconductors. Meta getting close to lifetime highs as well. Super micros is pretty flat. Palantir ripping up though. All right, guys. So again, we will be streaming the entire Jerome Powell. The full house testimony. We're going to put this up on screen. Man, we'll see how far NVIDIA can go. You guys ready? We got 14 minutes. The Jolts report is whoa, look at the market dip here, guys. So we're covering a lot of this stuff. Canadian Bank of Canada rate decision 5% versus 5% expected. Again, we do have the Jolts report going live at 10 a.m. and then Powell going live. Again, Jolts report goes live at 10 o'clock. The only real way to trade this market is to range trade it, I think, but we're going to take 2 contracts and just kind of play with this. Maybe add if it gets closer to the bottom of the range, but I guess we could add to it, but I don't know, man. I want to range trade it because I think the market might be choppy on the Powell speech. But we're also kind of betting in that way that NVIDIA is going to bounce. So we'll try it. Again, we're trading micros because the Powell speech is coming out. We're only down about $200 today, less than that now. But let's see if we bounce at the lows. There's a little bit. All right, so we're basically flat on this one. I could have gotten a better average here, but it's all right. I'm going to limit my risk, cut size a little bit more just to protect it. Give it a little bit more time to see if we come right back up. Again, a lot of the time during these big economic reports, we're flat and sideways. So I'll take half off, lock that in, still rising. Take another half off and we'll let the last contract work. All right, guys, Powell coming out soon in about 11 minutes here, chat. 11 minutes. We'll add back here, see if we run. Alright, we're kind of profiting from this chop that you guys see. Go ahead and get out there. We've made a bunch of money on the chop over the last 5 minutes. Alright, guys, Powell in 10 minutes here, team. 10 minutes, about 9.5 minutes. You don't see how Powell in Congress can have any effect on markets? Really? I mean, listen. It's Powell. He's going to be speaking about inflation rates, cuts, like economics. And this is not one of those nonsense interviews. Like, he's going to be talking about markets. Anytime Powell speaks about markets, it influences him. Now, how much it influences him, we don't know. But anytime he speaks about markets, it influences him. I don't know if it's going to be good or bad, though. I really don't. Yeah, we're down like $120 on the day. Kind of small. I think ICT has some good concepts. You know, a lot of people use ICT concepts, and they're not super like unique to ICT. Like, range breaks are always kind of powerful, and they always have been. But I think they're gonna do a good job of explaining them. All right, guys, we got a dip here. Again, we got 9 minutes left. I'm going to switch my headphones out to make sure we got the correct headphones here. We're waiting here. We're going to put the stream up soon. All right, bear with me, chat. Wait, hold on. Let me make sure y'all can hear. All right, so we should be in here. What's the crystal ball say? Yeah, I don't know. There we go. Can y'all hear the music right now? You should be able to. I just want to make sure. I'll try to do a little short position here ahead of this report. 2 contracts. We'll take profits quick. We're kind of just scalping this move. Three. Take 4. Scalp. And then get out there, scalp. All right, so yeah, we're doing okay. We're kind of slowly making money back. We got about 1,800 people here live. And again, if you want to day trade like this, I'm trading on a platform called Apex. Apex is a funded account program in futures in which they give you a demo and they test their skill. If you pass the test, they fund you. If you don't pass the test, your risk is limited. That's the biggest thing to understand. There's no PDT rule in futures. The patterns on this are very something like the patterns on Apple or Amazon or Google. There's just no PDT rule in futures, and Apex has paid out over 100 million. And what they do is they give you a demo, they test your skill. Again, with the demo, and if you lose, it's not the end of the world. Most day traders lose money, and so you can either risk thousands putting the money up yourself and probably lose, or you could try out Apex's funded account program. They have combines all the way down from $25,000 combines, so they give you a 25K demo. The 25K when I think you only got to make $1,500 in profit, and if you follow their rules, they fund you 25K. I think it's like $30 to try the challenge. You still have some pressure since you're still risking something, but it's not the full extent of risking thousands of dollars. Your risk is limited. They're a sponsor of mine, of course. I'm biased in their favor because they pay me money. Of course, they're a sponsor of mine, but incredibly useful for traders in terms of like limiting your risk. I think it's powerful to limit your risk in trading. And once you're funded, you get to keep your first 25K in profit and 90% afterwards. So it's similar to putting the money up yourself, just the risk is noticeably less. Again, Apex is the most legit one. And again, right now it's only $35 to reset, which is crazy cheap because again, you can get the $300,000 one where if you pass it, you get $300,000 in funding. And reset it for $35. So save a ton of money doing that. And right now they also have static accounts as well, where there's no trailing drawdown. It's static. It stays still. So if you build profit up on those accounts, that's when you can really have some big gains. Now, again, they are a sponsor. I'm biased. If you want to check the link out, there it is right there. Great way to help support your boy here on this channel. We got 6 minutes left. 6 minutes. We got about 2,000 people here live. The PDT rule stands for the pattern day trading rule. I'm pretty sure it's available to a lot of places outside, David. Just check with them. Click the link I give you. Always use promo code BT, beginner trading. BT, one word, or 2 letters. BT, beginner trading. Super easy to remember. Again, it's the futures market, guys. There's no PDT in futures. Patterns are very similar to stocks. All right, guys. Hey, we got 2,000 people here live. Over 2,000 people here. We got 5 minutes left. Apple bounced it all the way back up here. I'm going to put a different chart up right now, though. So we're going to put the Tosh chart up here. So what symbols do you want while Jerome Powell speaks? I'll probably put it like this. And then put it something like this. And then put like... Here, I'm going to mute. Y'all can hear the music, correct? Apex just has tons of different options. They have 25K, 300K. They're cheap. Again, they have static options where the trailing drawdown is static. You know, there's just a lot of good options with them. Nice. Again, link is in the description if you want to check any of this stuff out. Again, I'm going to put up the Q in NVIDIA, or the SPY in NVIDIA probably here. There we go. I think this works beautifully. Okay, can y'all hear the music? Yes? Music is perfect. Yeah, so we're going to switch out of the music. That's why I'm asking, because the conference is going to start soon. Right, so we're going to put this up here. See if I can make it larger. I'd love for it to be a little bit bigger here. Yeah, there we go. That's good enough. Alright, so we got this up. I'm going to mute the music for a second so we can make sure. Again, still waiting for it to start. I'll let you guys know when it does start. Actually, I think the easier way to do this would be to do something like this. Put the SPY up here. I'll put the Q up instead. We can put the SPY up. Here's the Q, though. I think I'd rather the Q up. And then we'll put it all the way right here. And then we'll put like another chart going through the bottom here. I'm trying to figure out how to design the screen for you guys. Would y'all rather Bitcoin or Nvidia up at the bottom chart? Bitcoin or Nvidia? We're trying to get the stream ready. Bitcoin or Nvidia chart at the bottom chat. Let me know. What do you guys think? Like, you're not going to be able to see the whole thing anyway, but Bitcoin? Okay. Here we go. It's about as good as I can get it, guys. About as clean as I can get it. What do you guys think? Is that clean enough? There we go. All right, we're ready. Let me go ahead and exit out the music. Here's the Q. We're zooming in on the Q right now. All right, guys. We got 2 minutes left. 2 minutes. The Jolts report drops at 10 o'clock. So what we're going to do is we're going to cover the Jolts report as soon as it comes out, right? As soon as it drops. Expectations are 8.8 million to 8.9 million. We're going to cover that as soon as it comes out. And then pivot over to Jerome Powell. We're going to cover Jerome Powell too, but we're going to report it and then immediately go to the poll. Or the press conference with Powell in the top left. Because I'm in Central Time. I'm in Central Standard Time. All right, guys, we got about a minute left. I'm going to get rid of the timer. We got about a minute left. Okay, it's hit the live button next to the play button. Make sure you're fully caught up on stream as well, chat. Again, if you want to check out my sponsor, Apex, if you want to try to get funded in futures with limited risk, try out a funded account program. Apex, the most legit. They have 25K combines all the way up to 300K static, all that good stuff. They've done over 100 million in payouts. They're a prop firm. They give you a demo, test your skill. If you can pass it, they fund you. Check them out before we get started. Let's get ready for the Jolts report as well here, chat. Jolts report coming out live soon. Again, hit the live button next to the play button. Make sure you're fully caught up on stream. Hit the live button next to the play button to make sure there's no delay. And then the Jolts report going live right now. 10 seconds, chat. 10 seconds before Jolts. 8.8 million is what's expected. Let's see what he says. And here goes the report. 3 seconds, 2 seconds, 1 second. Live. Jolts report. Waiting for it. Wholesale inventories are out. The Q hasn't really dropped much. Jolts report 8.86, higher than expected. More jobs than expected. 8.86, more than expected, higher than expected. All right, so they haven't started yet here, chat. They haven't started yet. They're a little bit delayed. The house in general is a little bit delayed, but that's okay. You can watch them right here. We're waiting for the stream to start. So again, you can watch them live right here. We're waiting for it to start. The Jolts report's negatively affecting the market. More jobs opened up than expected. Again, we're waiting for it to start. We're completely live here, waiting for him to start, chat. You can see the timer. We're past 10, so they're a little bit late. There he goes. All right. I'm going to do a sound check. Sound check. They're not really saying anything. You can't hear anything. But make sure to let me know if the sound works when they start talking. Okay, so look, I guess they went back. So they're still waiting for Powell to come out. You know, if you guys don't know these Powell press conferences, Powell has been haunted by environmental protesters. They're lurking in the shadows waiting for Powell to speak so that they can yell environmental protests at Powell. They've been showing up to every single Powell press conference over the last year, except for the FOMC meetings. But every press conference, they've been showing up, yelling a bunch of stuff, and then getting kicked out. Powell even cursed one time, funny enough. So here we go. Get ready. Waiting for them to speak. Again, they haven't started yet. Still waiting. Yeah, so it was forecast at 8.8 on my end. We came in at 8.86. So I can hear him kind of talking in the background. They just haven't started yet, chat. So we're just waiting. You can hear him talking. They haven't started yet. So again, we're just kind of sitting on standby. Can y'all hear him talking in the background? If y'all can hear that, that's a great sign. It's very slight. It's very light. We got volume up all the way, but I can kind of hear the crowd talking, which is a good sign, which means that I can hear him. Yeah, I mean, it's mostly flat. Yeah, I mean, it's not loud at all. Like, it's a very, very slight. Okay, I hear room noise. Okay, yeah, that's what I'm referring to. They're not saying anything. It's just room noise. It's good to know. Yeah, the crazy thing right now is for Apex $35 resets. What we're probably going to do after this stream is do a day trading stream where we try to get funded on one of the large ones. We're just going to go ahead and splurge for it and then try to get funded on one of the large ones. Because again, I can get the 300K combine. Hey, my guy Barry, thanks so much. He says you always have good advice to interact with the chat. Hey, thank you so much. I appreciate it. But yeah, so stick around after the stream. Again, we're going to be doing a day trading stream in which I try to get funded on the 300K combine is, I guess, what I'm going to go for. Let me see how much my discount is on that. My discount. All right, so the 300K combine is 657 minus 70%. So it's $200, right? But I can pay $200 and then it's only $35 to reset. And so that's the goal. We're just going to reset until we get funded after this. So we should have 300K in funding, is what we're going to go for. And again, if you want to join that with me, check out the link in the description. We're still waiting on them to start, guys. I can hear the room noise. They're not saying anything yet. And again, sometimes these meetings are delayed. Apex is futures. Again, if you want to check out, link is in the description as well as the promo code. If you don't see it in the description, just reset. Yeah, I've checked multiple rooms and all of them are not started yet. So we're just kind of sitting around waiting for them to start. We got 6,000 people here live. Welcome so much. Please stop spamming. It's cheaper to reset if you have a larger account Daydreams. So, right, so like again, after this stream, we're going to day trade. I'm going to get the 300K one, which costs about $200 if you use my 70% discount link with using promo code BT. BT on Apex, use promo code BT. But it'll only be $35 to reset it afterwards. So we can kind of keep swinging, only reset it for $35. That's going to be much cheaper than buying a new one for $200. You know what I mean? So just remember promo code BT. And you'll get the $35 reset when you do it. I think that makes tons of sense. And so that's what we're going to try to do afterwards. And again, if you want to check it out, promo code BT, beginner trading, I'll put the link up. But yeah, you can also use promo code triple B, BBB. Still waiting for them to start, man. I don't know what they're doing. Yeah, I'm going to put this up. I'm going to pin it to the top of the chat so people can see it. Yeah, that's just me clicking buttons on my computer. My bad. Here we go. I think they're about to start.
Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time.
All right, sound
The
check.
hearing is titled The Federal Reserve's Semi-Annual Monetary Policy Report. An inventive title we use semi-annually here on the committee. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I will note at the outset that this hearing has a hard stop at 1 p.m., which will be strictly observed. I see Chairman Powell smile. It's just 3 hours. I'll now recognize myself for 4 minutes to give an opening statement, and welcome back, Chair Powell. Since you last appeared before the committee in June of 2023, the conversation in Washington surrounding inflation has shifted significantly. To be clear, it's not because the inflationary fire has been extinguished. From the most recent data available, food costs are up 21% since President Biden took office. Energy costs are up nearly 32%. Shelter costs are up more than 19%. And you'll pay 37% more for a dozen eggs in America today. As you stated in January, people are still paying more for the basics of life, and the prices they're paying are still high. Families aren't happy about it, as you know, and as our colleagues know. But according to the Biden administration, many of my Democrat colleagues, they should be thrilled. In an attempt to score political points, many in Washington have decided the best strategy is to tell people what they're feeling isn't actually accurate. They claim Bidenomics has brought down costs, and their partisan so-called American Rescue Plan put our economy back on the right track. Of course, we know the opposite is true, since inflation skyrocketed soon after the American Rescue Plan was enacted, which was predicted by several former Obama administration economic officials. Instead of working to solve the underlying issues causing high prices, the administration has played the blame game, citing corporate greed and so-called shrinkflation. Some Democrats have even trained fire on you, Chair Powell, blaming interest rate hikes, which were necessitated by Democrat spending, for the high cost and brazenly calling you to make cuts prematurely. It's highly inappropriate for lawmakers to attempt to influence monetary policy. Chairman Powell, I have faith that you will not allow politics to cloud your judgment in the fight to tackle inflation. As I have always said, you are a steady hand, and I believe you are committed to the Federal Reserve's independence, as am I. Just as you have rejected the outside pressures of politically motivated agendas, I hope you will be just as attuned to the threats of politicization when the calling is coming from inside the House. Vice Chairman Michael Barr's so-called holistic review of capital requirements and the fatally flawed Basel III endgame proposal represent a concerning trend of partisan proposals taking priority over supervision. This has real-world impacts, as we saw 1 year ago this month when the supervision and regulation arm of the Fed was late catching up to the effects of the acceleration of interest rates on the banking system. Americans were understandably shaken by last year's banking turbulence. As we continue to monitor potential instability, including bank exposure to commercial real estate, it's critical that the Fed keep its eye on the ball. This does not include enacting new, far-reaching, and ultimately harmful regulatory policy, though. As you know, members on both sides of the aisle, on this committee and in Congress, have made clear that the Basel III endgame proposal would be catastrophic for families, communities, and small businesses. Regulators should withdraw it and start over. I think that's the proper course with something as deeply flawed as the current proposal. Additionally, given that other significant proposals would have to fit holistically together, regulators cannot simply proceed with them as separate modules or using a cut and paste approach. Most importantly, as the Basel III endgame proposal is discarded or altered, I strongly urge you and other regulators not to finalize the long-term debt proposal. Instead, Chairman Powell, I would encourage you to stick to the task at hand and follow the data. The stakes are way too high to put politics over sound policy. With that, I yield back, and I'll now recognize the ranking member of the full committee.
Thank you very much, Mr. Chairman. Good morning, everyone. Welcome back, Chair Powell. While I am pleased by the progress the Fed and the Biden administration have made to tackle inflation, we're not out of the woods yet. In fact, even though my Republican colleagues refuse to acknowledge this fact, housing, is still the #1 driver of inflation. Based on the latest data, housing costs continue to make up nearly 70% of overall price increases, outpacing modest wage gains. This means that until we address the underlying housing supply shortage, Americans will continue to pay an increasing share of their income on housing. The affordability crisis will worsen, and inflation will remain too high. With that said, it's hard to understand why Republicans feign concern about the economy when they're unwilling to address the key driver of inflation, housing. In fact, Republicans have only put forward legislation that makes things worse for millions of Americans, including moving legislation to slash funding for federal housing programs, including in rural America, where homelessness is rising. This abysmal record on housing is par for the course for Republicans. Since they have been in the majority, they have convened only 6 hearings on housing, on top of launching baseless impeachment efforts, censoring members, and pushing our government to the brink of multiple government shutdowns. It's clear that Republicans are too focused on drama and chaos to deliver anything for the American people. That's not how Democrats roll. When I was chair of the committee during the 116th and 117th Congress, not only did we hold 55 hearings on housing, but I and my fellow Democrats enacted 12 critical housing bills into law in the last Congress alone that helped stymie a tsunami of evictions, foreclosures, and homelessness, keeping millions of people stably housed during and after the pandemic. Unlike Republicans, we don't just talk about the issue. Democrats make law. As House Republicans continue to disappoint, committee Democrats are offering evidence-based solutions to keep a fair and affordable housing agenda at the top priority in Congress. That's why I and my Democratic colleagues reintroduced 3 groundbreaking bills to address the housing crisis and bring down inflation once and for all. This includes Housing Crisis Response Act, the Ending Homelessness Act, and the Down Payment Toward Equity Act. Together, these bills would create nearly 1.4 million affordable, accessible, and resilient homes, reduce housing costs in homelessness, and revive the American dream of home ownership for all. So, when my Republican colleagues are ready to get serious about our nation's economy and inflation, Democrats are ready to work with you to pass the bills into law. In fact, tomorrow at noon, I, committee Democrats, and more than 30 housing advocates will join together at a press conference to share just how important ending the affordable housing crisis is to the state of our union. And so I invite all of my Republican colleagues who say they care about this issue to come on and join us. I look forward to discussing this critical issue with Chair Powell today. And, Mr. Chairman, I yield back my time.
The chair recognizes Mr. Barr, Chairman of the Subcommittee on Financial Institutions and Monetary Policy, for 1 minute.
Welcome, Chairman Powell. Runaway inflation and increased interest rates still have Americans reeling. And while the rate of price increases have come down thanks to monetary tightening, the overall level of prices remain high. The toothpaste is out of the tube, and Americans, the average American family, still is paying about $15,000 more for the same goods and services that they were purchasing just 3 years ago before the Biden administration. So Americans have suffered years of eroding purchasing power in their paychecks. And while I'm pleased the Fed is resolved in getting inflation back under control, I'm not pleased by the numerous recent unjustified, politicized, and underanalyzed regulatory proposals. The Fed needs to withdraw and repropose the irredeemably flawed Basel III endgame proposal, especially given that 97% of public comments across the ideological spectrum expressed disapproval of the proposal. Chair Powell, I urge you to listen to the American people, withdraw the Basel III endgame proposal, and tell us today what the Fed's plans are moving forward. I yield.
The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair Powell, for being here today. And I had a chance to actually read the monetary policy report from cover to cover, thanks to an exceptionally long airport delay, going back home last weekend. And the feeling I got again and again is that things are fairly well recovered from COVID and getting back to normal, that we're in the range where ordinary monetary policy and fiscal policy will allow us to satisfy your dual mandate. Today, unemployment remains near historic lows. Core PCE inflation is down to 2.8% year over year compared to a peak of 5.6% in 2022. And the major stock indices are hovering around record highs. GDP growth continues to beat expectations, and the U.S. economy has added more than 14 million jobs since President Biden took office. The GDP itself is pretty much back on the trajectory that it would have been pre-COVID. U.S. manufacturers alone have added nearly 800,000 jobs, employing more workers now than any point since 2008. And so my lesson from that is that the fiscal response that we engaged in was appropriately tailored, and the soft landing is within sight. So thank you. I yield back.
Gentleman yields back. Today, we welcome the testimony of Jerome Powell, Chair of the Federal Reserve's Board of Governors. As you know, you'll be recognized for 5 minutes for a summary of an oral presentation of your testimony. Without objection, your written testimony will be made a part of the record. Chair Powell, we're now recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped to narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We've also continued to shrink our balance sheet at a brisk pace and in a predictable manner. A restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman Powell. And I should have noted this at the outset, but this is your 25th testimony before the U.S. Congress as Chair of the Federal Reserve, and we thank you for your service and your commitment to congressional oversight. Very much appreciated. I'll now recognize myself for 5 minutes for the purposes of questions. Let's begin with what's top of mind. We have two issues that are top of mind with the Fed: regulatory policy, with the Barr proposal, the Michael Barr proposal on capital, and interest rates. We're in a political year, and the lens of a political year falls heavily on all government, all parts of government. There's a lot of debate about the past 3 years of high inflation and the impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates. Some say that it's going to be a lot of rate cutting this year. Some say none. What say you?
I say that really it will depend on the path of the economy. Our focus is on maximum employment and price stability, and the incoming data as they affect the outlook, and those are the things we'll be looking at. I can go further if you'd like.
So at what point will the Fed be forced to cut rates? What does the data, what kind of data would you point to, and do you have any updates there?
What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We have some confidence of that. Inflation, headline inflation has moved down more than 3 full percentage points now to 2.4%, as I mentioned in my remarks. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy.
Well, let's pivot to regulatory policy. Chair Powell, as you know, there have been serious concerns expressed on both sides of the aisle and across America and across industries about the Basel III endgame proposal that Vice Chair Michael Barr has proposed and that the Fed is taking up. The concern is on both process, meaning how the proposed rule was developed, analyzed, and released for comment, the general concern of a lack of economic justification for these actions, but also on the substance. The proposal goes much further than the Basel III committee recommended on capital requirements, putting us at a great disadvantage internationally, potentially. So my first question is on substance. Is the Fed listening to these comments that have been nearly unanimous in opposition to this rule? Is the Fed listening to these comments on the impact the rule will have on everyday Americans? And what is the status on rulemaking, and what is the plan moving forward?
So you're right, we've received voluminous and very substantive comments, as well as the quantitative impact study that we put out. We got those responses in mid-January, and we're carefully analyzing them. We had asked for very specific, detailed, data-based comments, and I'm happy to say that we did get that. So we're just now reaching the stage where we can begin to make decisions about how to proceed. We really haven't made any decisions yet, but I think I can say a few things. First, we do hear the concerns, and I do expect that there will be broad and material changes to the proposal. I'll add that I'm confident that the final product will be one that does have broad support both at the Fed and in the broader world. As far as process is concerned, we're really not at the stage of making decisions about that. That's down the road at least a bit. I will say the question we get is reproposal, and I will say that we haven't made that decision, but if when we get to that point that turns out to be the appropriate thing, we won't hesitate to do it.
You won't rule that out? You would not rule that out at this stage of the game, reproposal?
Not at all. No, I think it's a very plausible option. It will depend on how things lie at the time when we reach that point.
Okay. And there's a lot of concern about the interplay between different parts of the rule. And if you change one, what does the economic analysis look like for the new proposal? So it is good to hear that you'll be methodical and the Fed will do its traditional role of building consensus around the substantive changes. And that is your intention.
That is right. I said this would be a thoughtful, deliberative process. It's more important that we get this right than that we do it fast. We understand that. This is an important rulemaking, and it's going to have potential implications for the economy and the people we serve. We're going to take our time and do it right.
Thank you, Chairman Powell. The ranking member, Ms. Waters, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I want to talk to you about housing, but before I get there, let me address the issue of mergers. Last week, I led a letter along with 15 committee Democrats to you as well as DOJ, OCC, and FDIC, expressing my strong concern about the lack of progress you have made in updating your bank merger review procedures. This is critical now that we just learned of another mega merger involving Capital One and Discover, which would create the 6th largest U.S. commercial bank with a major role in the credit card market. For far too long, experts have raised alarm that there is a rubber stamping process of bank mergers where virtually all applications are approved. All the while, unbridled market consolidation poses great risk to consumers and entrepreneurs. What is the status of your updates to the merger review process? And does the Fed plan to convene public hearings on the Capital One and Discover merger?
So I believe we're in regular contact with the Justice Department on what's going on with their review of merger practices. We're looking at that and considering. I think on the potential merger with that you mentioned, we haven't received an application, so there's really not much to say yet. It's early days. When we do get that application, though, we're going to evaluate that merger as always under the factors laid out under the law, and that's our commitment.
So you do believe that your bank merger procedures are ready to do the work that's necessary when you evaluate this possible merger?
I do.
And are you supportive of organizing community hearings on this merger?
I haven't talked about that with anybody. I will say this: we've done that in many large mergers, but that's not a conversation we've had yet. We literally don't even have an application for the merger yet.
Thank you. We'll stay in touch with you on that. So turning to the national affordable housing and homelessness crisis, where we've seen steady increases year after year in home prices and rent costs, which are a symptom of the chronic undersupply of affordable housing. Indeed, more renters and homeowners are now spending more of their income than ever on housing costs. And as you know, housing costs continue to be a primary driver of inflation. Do you think the Fed has sufficiently emphasized the role that housing costs play in keeping us from your 2% inflation goal? Do you think it's reasonable to believe that monetary policy can accomplish this goal without a fiscal policy response? And if you do, how long will it take to get there?
Housing services inflation is one of the three components that we look at that make up the core PCE and, index, and it has been coming down from its heights of a couple of years back. It's part of the story. I think the overall story is that goods price inflation has turned negative. Goods prices are actually coming down a bit. Housing services inflation, you can see from currently entered into leases that as leases turn over, the increases are going to be smaller. So in our forecast and in everyone's forecast, housing services inflation comes down.
It's
And
been
that leaves
reported that the
non-housing services.
methodology used to assess housing costs as an indicator of inflation is imperfect. Namely, because it considers costs based on both new and old rent, including for owner-occupied housing on a month-to-month basis. This results in stale data since families' housing costs typically do not change unless they move or their lease is up for renewal. So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease rents, which is referred to as new tenant repeat rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so, what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
Thank you, and I yield back.
Gentlelady yields back. The Vice Chair, Mr. Barr, I'm sorry.
Wrong Vice Chair.
Wrong Vice Chair. The gentleman from Arkansas, the Vice Chair of the full committee, Mr. Hill is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III Endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics, and you all discuss the interactivity of that rule with other rules. So if you were to repropose the Basel III Endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III Endgame might be?
So we haven't made the first decision yet, so it's hard, I couldn't say definitively. But yeah, that's a question we'd be asking ourselves is what would be the implication for other rules, including the long-term debt?
Well, and is the Fed considering changes to the requirement for regional banks to issue long-term debt? Right now, it's stated to be issued at 6% of risk-weighted assets in abundance of caution in case there needs to be a resolution, obviously. We know the logic for it. But as I understand it, it's being required at both the holding company level and down at the bank level, and that seems redundant to me. Are you aware of that, and have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended a little while back, and so once again, we're in the process of evaluating the comments. There will be a thoughtful, deliberative process around that. We welcome comments on these kinds of things. They're very important implications for the banks that are affected. We want to understand the effects, make sure we understand them correctly so that we can evaluate, what a final rule should look like.
Good. Let me turn to the monetary policy outlook. As the chairman noted, consumer prices are 17% higher for American households since President Biden was inaugurated back in January of 21. And yet, in spite of that 17% increase in cost, real wages have actually fallen 2% over that period. So there's no doubt that inflation is the biggest issue facing American households. And in my view, there's three principal causes. Certainly, we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable. But we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then, but it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at, but the bigger question really is that change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time, and policy was always very close to the effective lower bound, so there wasn't any firepower for central banks. And so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period. The pandemic really may have changed that in a sustained way. We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next year.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I think I want to pick up a little bit right where we are. 2019, 2020, the entire world was under the unprecedented pandemic with COVID rate. Is that correct?
Yes.
At the time. And that changed a lot of things with reference because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains were disrupted. In fact, I can remember many Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
And so, I would say then that some of the other countries of the world maybe should have looked at the policies that we put in place thereafter so that they could get out of it, so that they could have a labor market that is strong, where the unemployment rate is near a 50-year low. And as you've stated, inflation is also now coming down faster than any place else on the planet, just about. Is that not correct?
I think that's right, yeah.
And I think that you also recognize a mismatch between the strength of the economy. That's what we're talking about in the field. And I think that Ranking Member Waters touched on one of those big issues of housing, of which is now, we're still trying to get that under control. And I think the Ranking Member has some ideas on how we can do that, and that may be something that you need to consider so that we can further get down the inflation rate. And the other would be the commodity markets, because the cost of food is too high and people. So that's something else that we need to get in control. Is that not correct?
Yes.
And let me just ask this. Can you say that there's a connection, for example, between conflicts in other areas of the world, like Russia's war against Ukraine and or the turmoil in the Middle East and the economic pressures that the United States feels? Does that not also go into the reason why the cost of commodities can be still higher? Is there a connection therein, Mr. Chairman?
Certainly, the war in Ukraine caused commodity prices to move up sharply.
So, could you tell you what is the what would the connection lead you to believe that there is an urgent need for us? I would think for and we're running out of time, for us to do everything that is in our power in Congress to support Ukraine, so that we can make sure that and other strategic partners, that we can help the commodities market, and that would help lower the cost of some of the commodities, bringing food prices down, if we would just be able to pass certain things that's going to help Ukraine right here in the United States Congress. Is that correct?
Here's where it gets outside of our jurisdiction. So I wouldn't have an opinion on Ukraine funding.
But if we had more grain that was going through, it wasn't blocked by Russia, things of that nature, that generally just, says that helps bring the cost down. Cost is higher because of the disruption in the Black Sea that's happened because of this war. So that would help bring the cost down. That is not necessarily the policies just here in the United States, but that's the policy because of what's going on in Russia, and we need to make sure that we do something to prevent that if we really are serious about bringing inflation down. Is that not correct?
I think it's correct that a full supply of grain would help with commodity prices.
And so, instead of us playing politics with this and acting like it is your fault or anyone else's fault that we had to go and do what we did because of the unprecedented pandemic, what we did was save the economy then, knowing we got some problems that we had now, and now we are recovering quicker and better than any other country on this planet as a result of your policies and the policies of Joe Biden.
Expired. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. When you were before this committee a year ago, I cautioned against raising capital requirements on commodity derivatives that our agricultural and energy producers use back home to keep prices of food and power stable for consumers. At the time, you said that was a very specific concern and you weren't sure the proposal would even address commodity derivatives. And in fairness, that was before the Basel proposal was officially published. Unfortunately, we now know that the proposal does impact commodity derivatives, and in fact, they are among the most penalized financial products that banks offer. And I would note for just a moment, I very much appreciate your comments and responses to Chairman McHenry about the nature of the overall proposal. Congress wanted end users to be able to secure their hedges without posting margin to keep the derivatives markets affordable. But I've seen estimates that some of these types of transactions for end users could face 10 times the capital requirement. Chairman Powell, make me feel a little better. Ease my concerns here. Will you and the Fed work to fix this?
Let me start by saying I want to echo the fact that our commodity markets and our capital markets are a huge national asset, and we need them to be functioning well and with as little friction as possible. I now understand that what you're referring to is the things that were done to increase capital requirements for various kinds of derivative activities. And I'll just say that's an area we're aware of the concerns, and it's an area that we're taking a very close look at.
I appreciate that. I was a member of the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, farmers, ranchers, small businesses. This had broad bipartisan support then and still does today. Unfortunately, the Fed could undermine this longstanding work done by Congress. I'd like to enter a few letters into the record, Mr. Chairman, that discuss the detrimental impact to end users. First, a joint Agricultural Trade Association letter from the American Farm Bureau Federation, the National Cattlemen's Beef Association, among 7 others. Next, a joint Energy Trade Association letter from the American Gas Association and 4 others. And lastly, a letter from the American Public Power Association and the National Rural Electric Cooperative Association.
Without objection.
Thank you, Mr. Chairman. Chairman Powell, I'd now like to focus on how the proposal is set to significantly disincentivize banks from offering clearing services. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. The number of banks that can clear derivatives for end users has reduced over time, making it harder for end users to find a bank to offer this service. There are some estimates that the Fed's proposal will increase capital for this activity by 80%. I'm worried that this will make it even harder for end users to find a bank to clear their hedges. This also comes at a time when the SEC, our friends at the Securities and Exchange Commission, has just finalized a rule in December that will increase clearing in cost in Treasury markets. This will have a real impact on market access and liquidity, not just in commodities, but the $26 trillion Treasury market that plays a critical role in the world economy. Will you work with the CFTC to address this problem?
Again, I'll say that we're aware of those concerns, and we're prepared to work with other agencies and also to make sure that our capital proposal appropriately addresses them.
The strength of central clearing is entirely dependent on banks' willingness to participate, and problems with the Basel endgame warrant a full reproposal to give us time to appreciate their consequences. And there are real consequences, as you and I both know, Mr. Chairman. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman, and welcome again, Mr. Powell. It's an honor to have you before us today. I always enjoy hearing your commentary. As you know, recession and inflation, these are buzzwords, and they are used in some circumstances to cast a dim light on perhaps the Fed and others who are working to end some of these troubling circumstances we're dealing with. Are you now at a point where you believe that there will not be a recession? There was much talk about recession, and many people worried that we would find ourselves having to negotiate our way out of a recession. What is your position currently on a recession?
So U.S. growth last year was in excess of 3%. What we're seeing so far this year is continued solid growth. My expectation, and that of other forecasters and of my colleagues, is that we'll see continued growth at a solid pace. I will say, so there's no evidence or no reason to think that the U.S. economy is in or in some kind of short-term risk of falling into recession. Having said that, though, there's always a possibility, a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
Thank you. I appreciate your saying this because we want to, at some point, eliminate the great deal of fear associated with just the term recession. Next point, the December FOMC projections showcase a slightly lower unemployment rate than last June's projections and slightly higher GDP, suggesting a soft landing remains likely. Are you of the opinion that we're headed to a soft landing, Mr. Powell?
I'll just say that what we've seen so far is an economy that's growing at a solid pace. We're seeing a labor market that is still tight, still strong. Wages are moving up, but the labor market's coming into better balance between supply and demand, and inflation has come down sharply, really, since the middle of last year. So those are the conditions we see. They're very attractive conditions, and we're trying to use our policies to keep that growth going and to keep that labor market strong while also achieving further progress on inflation. That's our goal. And do I think there's a possibility we can achieve all of that while keeping the labor market strong and the economy growing? Yes, I think there is a possibility. Indeed, that is what we're trying to achieve.
A soft landing can be difficult to identify. We could possibly have a soft landing and miss the point at which the landing took place. How do you define the soft landing such that a member of the public, a layperson, would understand that we have indeed had a soft landing?
So we really think about it in the terms I just discussed, which is we want to keep the economy growing, we want the labor market to remain strong. 3.7% unemployment is pretty near 50-year historical lows. And we want inflation to continue to move down closer and closer to that 2% objective. And we've made quite good progress on that over just the past year. So we want to continue those conditions. And I don't want to put the label on it. Other people can do that. But I would just say we're using our tools to keep a strong labor market and strong growth while making further progress on getting inflation down to 2% for the benefit of the public. That's the economy that we're trying to achieve, and I think there's we're on a good path so far to be able to get there.
Well, I concur, but I would ask this as my last question. Will there be some announcement at some point that we've had a soft landing? Because we have people who are continually indicating that we're not having a soft landing, there's a possibility of a recession. So will there ever be some official statement that would give people some comfort?
I don't think by us, no. I think we're just going to keep our heads down and do our jobs and try to deliver what the public is expecting from us. We wouldn't be declaring victory like that, but
The gentleman's time has expired.
Thank you, Mr. Chair.
thank
The
you.
gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. Chairman, welcome back. I think we enjoy this. I hope you do too. I know there's some bit of trepidation about all the things that are available to us and you to answer. I learned a long time ago on a campaign trail, every problem can be solved on a campaign. Reality's a little bit different. Welcome back despite all that. Looking at the Monetary Policy Report, March 1st, 2024. And as I review this, I would like to focus on the term that I would say high prices are here to stay. Because what I've heard you say today in this report really go to is you got everything under control, but we're going to keep the high prices. And I think the high prices really take a toll on the American people, as you're hearing from our colleagues, no matter whether they be Republican or Democrat. Page 7 of your report, you don't have to go focus on it. It says, while current services, core service price inflation has been slowing, but remains elevated. It does. Labor costs, as you know, and energy costs are a driver to your monetary policy. The question that I have is, because you began referencing policy, 2 weeks ago or so, the president announced that he was going to slow down the gifting of opportunities in Texas for natural gas to be able to continue the exploration. And this in Texas is a $1 trillion answer problem to us, because if we do not constantly go find through these new finds, but also through the permitting process, we're in trouble. But we're also putting in trouble our contracts that we have with Germany and a lot of other countries. This is going to mean also that business in America continues to have high prices because, as you know, wages are already high and now energy is high. There's no resiliency to continue this and see the American people win. You talked about policy, so what's your advice to policy about energy and what this administration is doing on a policy perspective?
We have, broad, significant, important responsibilities, but we're really not responsible for energy policy, and we try to avoid commenting on.
But it
things that
has
we're
a
not
huge
responsible for.
impact on this report. It arbitrarily keeps prices high. It arbitrarily means that business is not, while they're making money, and while households, people do buy that, it's diminishing their long-term advantages to make progress. So you're just going to leave that alone?
Really not appropriate for us to comment, on, if I'm commenting on energy policy, I should comment on everything.
Well,
we have a mandate which is maximum employment and price stability. We take decisions by the legislature and by the administration as a given. We're not in charge of second guessing them. It's just not our job.
Okay, well, all right, let's say we're not going to second guess them. I will. I believe that the energy policies that this president and the Democratic Party have supported are causing a huge boom in prices staying high. They will not come down. A boom in attacking the energy industry, jobs that are associated with it, our foreign policy as it relates to contracts that we have signed with foreign countries, giving up the natural gas market almost entirely on a world market to Qatar. It has a huge impact on whether we are going to keep prices high or control these prices. It has a huge impact on, I think, your monetary report about how many houses get built, how many jobs get filled, whether we have jobs in place, whether we continue to have more jobs available than workers that are there, because over-regulation is having a lot to do with the nervousness, not only on this panel, but also by the American people. It would be my hope that you would pass some sort of a memo and tell them you have no opinion, but you want them to see what the impact is. I want to thank you for being here. Thank you, Mr. Chairman. I yield back my time.
Gentleman yields back. The gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell, thanks for being with us today. I have a question, but I want to start by acknowledging, not celebrating, but acknowledging what has been a really remarkable soft landing in our economy. And I'm not celebrating because the American people, consumers, are still feeling the effects of high prices. Wages haven't caught up with prices in some instances. But I think that it would be fair to say that observers would never have predicted the conduct of this economy. You yourself said it in the final press conference of 2023 when you said a very high proportion of forecasters predicted very weak growth or a recession. Not only did that not happen, we actually had a very strong year. So I want to acknowledge that and acknowledge your commitment to independent monetary policy. And because I'm still burdened with this idea that truth and facts matter, I want to point out, especially having listened to my good friend Mr. Sessions talk about the energy market, truth and facts matter. We are producing more oil and natural gas today than any other country on the planet. We are the world's #1 energy producer. I could spend my entire 5 minutes sort of pointing out facts. The fact I want to point out here, and this comes right out of the report, is that the premise that inflation is Joe Biden's fault, is fiscal policy's fault, first is faulty because half the fiscal stimulus that occurred in the face of the pandemic happened under the previous president, Donald Trump, and it has faded. And this report makes the case. Core, and I quote from it, core goods prices have been declining as supply bottlenecks ease and import price inflation falls. So, Mr. Chairman, I don't want you to comment on that because it gets a little bit political, but I do think it's important that we keep some foot on the plane of facts. I do want to ask you a question, though, Mr. Chairman, because I always worry about risks that we see and risks that we don't see. And I want to use the remainder of my time to talk about a risk you're very conscious of, which is the overhang in the commercial real estate market. As you know, the Financial Stability Oversight Council identified commercial real estate as perhaps The most salient risk to the financial system, $6 trillion roughly in loans, half of that on bank balance sheets. In a 60 Minutes interview a few weeks ago, you characterized distress in the commercial real estate market as sizable but manageable. Do you still feel like that risk is manageable? Do you feel like you've got the visibility and the transparency and the tools to address it? It makes me nervous because this has echoes of 2008, 2009, when vacancy rates were declined relatively rapidly. We're not seeing that right now. So how do you feel? Does that risk continue to be manageable, and do you have the tools to manage it?
Yeah, I would say yes to that. I think it is manageable, and we've been, working hard to management for some time now, really. And what it really is it's a lot of downtown real estate where there's too much office supply because of work from home, and also the kind of downtown retail that is no longer as profitable, and things like that are really at the heart of it. So what we've done is we've looked at banks that have significant concentrations, and we've been in touch with them to make sure that they have a plan to deal with that. There will be losses by some banks. It isn't really the big banks, it's really medium and small-sized banks that have these higher concentrations. It's going to be with us as a problem we'll be working through, I think, for several years. And the idea is you've got to have enough capital, enough liquidity, and a plan to take the losses that you're probably going to take. And so that's what we're doing. We're very active in this space with small, medium-sized.
So let me ask you about that. Sorry to interrupt, but let me ask you about that. Silicon Valley Bank, wild irresponsibility inside the bank, egregious irresponsibility on the part of corporate treasurers who put so much on deposit. The Fed also had some self-examination to do because the examiners and the supervisors of the bank, quite frankly, were not doing what they should have been. So we might be forgiven for being a bit skeptical of claims of being on this. What has changed in the context of Silicon Valley Bank that gives you the confidence that the supervisors and the examiners will be on top of this?
I see it with my own eyes, but frankly, there's a risk that we would overreact to something as significant as that. It's not like we wouldn't have reacted very, very strongly to what happened with Silicon Valley Bank, and we have. So I know that our supervisors are out there, and we're hearing back from media reports that we have been engaged with medium and small-sized banks principally on this. So I am confident that we're doing the right things there, and I do believe it's a manageable problem. If that changes, then I'll say so.
Thank you, Mr. Chairman. Yield back.
The gentleman from Missouri, Mr. Lukemire, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Powell, for being here today. I'd like to associate my remarks, or myself, with Mr. Hill's remarks earlier with regards to FDIC proposed long-term debt requirements that are based on the risk weighting of assets. I think it's an ill-thought-out proposal, and hopefully your position on FSOC, you'll be able to advise them and hopefully guide them that this is going to be held up until we actually get a Basel III rule. In October 2023, the board issued a proposal to update the debit interchange fee cap and regulation II. This is very concerning, given the data from both the GAO and Fed's own studies show that Reg II has significantly harmed access to free checking and other banking services for the country's poorest citizens. Yesterday, I introduced the Secure Payments Act, which would prohibit final rulemaking until the Fed, among other things, studies the impact of the board's proposed rule, completes a quantitative impact analysis specifically as it relates to affordable banking services for low-income Americans, and reports those findings to Congress. I understand the Fed acted here because you feel you're facing litigation, but I urge the board to proceed with extreme caution with any type of price control proposals, especially since the first iteration was so clearly harmful. Chairman Powell, knowing of the hardship caused by this policy on low-income consumers, does it give you any pause to continue down this road?
As you know, this rule is out for comment. We extended the comment period to May 12, so we don't have all the comments yet. We'll evaluate them carefully and make an assessment. I mean, the law does assign us a specific job, which is to assess whether an interchange fee received by a large debit issuer for processing a debit card transaction is reasonable and proportional to issuer costs. This is the obligation that Congress has bestowed upon us, not something we thought we sought, but that's our obligation under the law, and we don't know what else to do than to keep doing it for as long as that's our assignment. That's all we think we're doing, but I think that the concerns that have been raised will be things that we.
Well, hopefully you'll study this and understand that from the previous types of rules along this line, they were very detrimental to a lot of low-income, middle-income folks. As you know, the price reductions that were promised during the Durbin Amendment, for instance, the added profits actually went to the largest retailers rather than go to the consumers as they were talked about. 98% was one of the studies that showed that the retailers kept all the money instead of lowering prices as they were telling us that were going to happen. So I'm very concerned about that. So what's the legal basis for updating your regulation? You've talked about it a little bit. You believe that there is something in the law that says that you need to be doing this updating all the time, or should you be studying it before you actually propose a rule and make all these things more appropriate?
Well, again, I think our reading of the law is that it's not something you do once and leave it there. It's supposed to be reasonable and proportionable to certain identified issue or costs. The implication being there, if those costs change, then this should change. So that's our reading. I think we do a lot of work. We waited a long time to change it. It's been many years since we did change it, but we do quite a bit of work to make this assessment, and we'll review the comments and the data that we get.
One of the things I hope that you consider is the fact that even though it's supposed to be on $10 billion and up, stuff all rolls downhill, and as the last study showed, the smaller banks, the community banks, are also feeling effects of this. So be sure and consider that when you start talking and thinking about this. I appreciate that. One of the things, yesterday I had two different foreign banker CEOs in my office, and one of them brought up the subject to me, which is very concerning with regards to artificial intelligence being able to impact financial institutions in this country and our banking system. And I tell people, I said, think about this for a second. You find some individual who is a well-known individual, perhaps Larry Kudlow, Dave Ramsey, Bloomberg, somebody who has got credibility, and suddenly you see an artificially produced advertisement or Facebook post, and this person says, look here, we've got 100 banks that have got a problem today. Now, that individual didn't do this. It's artificially produced. I've seen a commercial already with individual. You couldn't tell the difference between that individual and the real thing. We have just come through the Silicon Valley situation. And if you have real-time payments, FedNow, where you can instantaneously transfer money, and you have people scared to death by some well-known individual through an artificial intelligence situation, and I can tell you China is watching this like a hawk. They are ready to pounce on this situation. To me, I've got some bills that actually would solve the problem. Do you think there's some issues here we need to be taking a look at?
Yeah, I think we're very focused on AI, many government agencies and law enforcement agencies in particular. It's very challenging. You paint one picture, there are lots of pictures.
Gentleman's time has expired.
It's interesting because the foreign banks actually are watching this. Thank you.
We'll now go to the gentlewoman from Texas, Ms. Garcia, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell, thank you for being with us this morning. It's always a delight to have you before us. Chair Powell, the February Congressional Budget Office report estimated that the U.S. economy will grow an estimated $7 trillion over the next decade, thanks to, in large part, to the surge in immigration, creating a larger labor force. Immigration also increases demand for goods and services. I know you mentioned in your report that that the growth sometime during COVID was held down due to some restrictions in COVID and restrictions on immigration. Can you detail how immigrants have been fueling our national growth, and did you consider this report from the CBO in this current report?
So I am very familiar with the CBO report. I've read the demographic projections and I've read the economic projections, so I do understand what they did. And
so you do agree with a $7 trillion growth in the next decade? I
have no judgment on that. I haven't tried to make a parallel assessment, but I'm familiar with the assessment. What they're doing is they're saying more people working, bigger economy, and it makes the economy bigger. It's just arithmetic. If you say that if you add a couple million people to an economy, a percentage of them will work, then there will be more output, and that's what they're showing. I just want to be very, very clear, though, that we don't make immigration policy. We don't comment on immigration policy indirectly or directly.
Yeah, well, I'm not asking you to do that, but, Mr. Chairman, I'm simply asking if you agree that the immigration surge has added to our strong labor force, which is necessary. I think you said that we expect a continued growth at a solid pace. So to be able to continue on a solid pace, then we need that labor force. Wouldn't you agree?
Well, so last year we got a big increase in workers, and it came from two sources. One was participation increased from people who were already here, and in addition, we got a significant increase in immigration, and many of those people take part in the working economy, and so there was a big increase in labor supply. That will have increased output. It will have made more people. It will have all kinds of economic effects. I'm just reporting the facts there.
Right.
I'm not going to say anything is needed for the future or good policy, or indirectly or directly, but I mean, I think it's just reporting the facts to say that immigration and labor force participation both contributed to the very strong economic output growth that we had last year.
Right. Is it possible for the Fed to conduct a formal assessment into the positive impact immigrants have on our economy and report back to Congress?
Not really, no. I think that's a job for the CBO. We don't, that's precisely what the Congressional Budget Office does, not what we do.
All right, but the other question that you've not addressed is, did you consider the CBO's assessment that the growth in the next 10 years would be $7 trillion and about $1 trillion in added revenues? Was that considered in this report? Because that was the February report, and this, I believe, is through February 29th.
So I think that the answer to your question is 10-year growth projections by CBO don't have big implications. They don't have any implications really for the current stance of monetary policy. But I will say that the immigration that we saw was a notable factor of the 2023 and 2024 economic outcomes. And of course, we're aware of that, and it plays a role in our thinking about appropriate policy and the path of the economy.
Okay, well, thank you for that. And related to that, I know that the last time that you were here, you and I talked about diversity and diversity inclusion efforts, both at the Fed, and I applauded you and applauded the president for his appointment of Dr. Adriana Kubler. I expect to visit with her this week. What other strategies and programs are you using in the Fed, not only in here, but in all the branches to ensure that there is diversity and inclusion?
So in terms of intake of people, when we go to hire when the reserve banks go to hire a new president, those processes are very focused on having a diverse applicant pool, and you see the results of that more and more over the years. That happens. We don't have any role in appointments of governors, so that's not our job. The administration does that. In terms of, I'll just say internally, we're very focused on having an open and inclusive place to work. And also in hiring, we work hard to have diverse.
Gentlelady's time
Thank
is
you.
expired. The
Thank you, Mr.
gentleman from
Chairman.
Michigan, Mr. Heising, is now recognized for 5 minutes.
Chairman Powell, good to see you in person. Mr. Chairman, I've got to make a comment here. It's stunning to me that equating an underground economy, which is very different and not a healthy alternative to the regular economy, and basing that on an illegal workforce that's not legally able to work, ultimately will fail. That is not a strategy to my colleagues on the other side. So just ask any farmer who's going to then have a regulator come in and fine them for employing people who are not legally allowed to be here in the country. That is one of their greatest fears. So that's just a fallacy of growth within this economy that is not sustainable. Chair Powell, last fall I sent Vice Chairman Barr a letter expressing my concern over the cumulative impact pending rulemakings governing products and services will have on consumers. This morning, there's been a fair amount of time spent on Basel III, but among the agencies, and here I'm including Fed, FDIC, OCC, CFPB, and the number of pending or final rules is frankly just staggering. Regulators last year finalized new rules for the Community Reinvestment Act. The Fed is also looking at Reg II, which in my opinion would unintentionally undermine recent significant progress in bringing low and moderate income consumers into the mainstream banking system. And just yesterday, the CFPB unveiled a rule that would cap late fees for banks. And I just literally walked out of a meeting with my credit unions who are very concerned about those things that may be in their future as well. So I think it's critical that we don't look at any of these rules in a vacuum, and we need to consider their total impact and full scope on that. So I'm going to ask you a question I've asked some of the other regulators. How much do you, as the Fed, and you personally, consult with other agencies on their own rulemaking agenda? Do you coordinate? Do you talk?
So I don't lead that area of our business, but I know there's a lot of talking. Coordination, I'm not sure there is coordination.
We're in government. There's always a lot of talking. I'm concerned about the coordinating. All right, well, let me ask you this way. When a rule is finalized under another regulator, are you mandated or have any kind of policy to go back and look at your other pending rules under your purview and see if changes need to be made because of these other agencies' rule makings?
There's no mandate like that. I think where it made sense to do that, though, we would do it.
But you genuinely have some sort of review of that. It's conscious.
I don't think there is a formal review.
Okay.
No.
I've heard repeatedly that elements of Basel III overlap with the Fed's annual stress tests. What are you going to do to address that overlap?
So we're in the middle of just at the beginning, actually, of deciding what to do about Basel III. And part of that may be the interaction with the stress test. So I haven't got anything for you on that today, but that's certainly an issue that presents itself.
We'd like to continue that conversation. I do want to touch on the bank failures of last year very quickly. Do you think that the banks that ultimately needed the government bailout lacked sufficient capital, or was it more of a management problem?
So with Silicon Valley Bank, it wasn't really, could they have used more capital? I mean, they were actually raising capital. It was a capital raise that they announced that triggered the run and everything. So you can argue that it needed more capital, but I wouldn't say that that was the proximate cause, really. It was a funding structure that was all about too much concentration of
Well, many of us are, I'm asking the question because many of us are very concerned that those failures are being used as an excuse to raise capital standards across the board. And because the SEC just released its climate disclosure rule this morning, I'm going to touch on the climate-related question for you. FSOC, the FSOC chair has repeatedly stated that climate change is, quote, an existential threat. Presumably a threat that is existential affects banks and financial institutions of all sizes. Why then have FSOC member regulatory agencies, including the Fed, limited their guidance on climate-related risks only to large financial institutions? Why not everybody?
Well, it's a new thing, and we are not.
It's a heck of a new thing. Yes.
We're not climate change policymakers. It's this is
Neither is
something that
the
needs to
SEC,
be
I might
handled
add.
by elected representatives, and so we're starting this very carefully with large institutions who are already doing it. By the way, the things that we're doing, they're doing this because to remain active internationally, they have to be doing it. So we started with them because they understand it. Imposing it on smaller banks, it's not something I'm for.
Yep.
Gentleman's time has expired.
We'll
The
be
gentleman-
following up on the Taylor rule. So.
The gentlelady from Michigan is recognized for 5 minutes. Ms. Salib.
Thank you so much, Chairman. Thank you, Chair Powell, for being here. Do you agree with the April Federal Reserve report that compensation incentives contributed to Silicon Valley's bank failure?
I'm sorry, did I didn't
So the April Federal Reserve report, it said that compensation incentives contributed to the Silicon Valley Bank's failure. Do you agree with that?
I would say it's at best a tertiary factor, but it probably had something to do with it. For me, not a major.
So that's no?
That's very small.
Okay, so it did. Okay. So do you agree the appropriate rules on incentive compensation could have reduced the likelihood of Silicon Valley's failure? Maybe? If they didn't take all
No,
that
I
money.
really don't think so. I mean,
So if they
I don't
didn't take
think
all that money?
I don't think it's a first-order question for Silicon Valley. A lot went wrong there.
Yeah.
Incentive comp would be
They actually blame
way
you
down the
guys.
list.
They
Sorry?
blame the oversight, even though they didn't respond to your
That's part of it.
correspondences.
We took our medicine.
Yeah. Do you think it also has something to do with the fact that Section 956 of the Dodd-Frank rule hasn't been finalized by you?
No, I don't.
You don't think it's the reason?
I don't.
You don't think it's because people made money off of the failure?
I think nothing.
You don't think money drove them to do what they did?
I didn't say that. What I said, there are lots
So
of.
they made money from it. They actually, it was a lottery
I
for
do not
them,
think
right?
that incentive compensation arrangements were at the heart of the Silicon Valley Bank failure. No.
Okay. Do you support a robust rulemaking for executive compensation, Chairman?
I know that the.
Oh, you don't?
I'm sorry?
Oh, do you support robust rulemaking for executive compensation? Do you believe in Section 956?
Section 956 is the law. As I understand it, the agencies are looking at doing something. It's been 12 or 13 years, right?
Yeah, multiple
Nothing has
agencies.
happened.
Yeah.
It's been hard to get it done. I lived through the last episodes of trying
Yeah.
to get it done.
So do you believe in a robust
I
rulemaking
believe-
process for executive compensation?
I do, yeah.
Oh, great. Oh, that's awesome. Will you commit to helping finalize the Dodd-Frank section of 956 this year?
I wouldn't
It's been
say
12 years, Chairman.
Yeah, no, I
It
want.
played a role in the bank failure, Chairman.
If I can answer, what I would like to do is
So
understand.
you don't want to do it this year? I mean, I'm being serious. You're saying no?
If the member will allow the witness to answer the question, we've had a good day today, and the gentleman's trying to answer the question.
I would like to understand the problem we're solving, and then I would like to see a proposal that addresses that problem.
Okay. Do you believe people should profit off of bank failure? The executives that made those decisions?
No, not the
They should not
executives.
profit.
Well, I would say executives who are responsible for a failed bank should not profit from the failure. Absolutely not.
So they get to walk away with compensation based on their failure?
Well, you're asking,
It's
are you
true, it
asking about
happened.
a different rule that would have clawback and things like that?
Yeah.
Yeah, so that's something I know you've been looking at for a while.
Yeah.
That's certainly an appropriate thing to look at.
Yeah, because it's just going to continue to happen, is my opinion. It doesn't have to be yours, but it sure the heck could have helped here if they knew they were going to walk away, if they could walk away with not the bonuses, the compensation. I mean, they made money, a significant amount of money for their bank failure. Last question, Chair Powell. Do you believe that the impacts of climate change pose a risk? Have you been talking about that more?
I certainly believe that climate change is real and poses risks over the longer term, sure.
So there have been some that say, higher interest rates actually makes it more difficult to build out the renewable energy projects and other investments required to prevent climate impacts. Do you believe that to be true?
It's not I believe that we need to do our job that you've assigned us, which is maximum employment and price stability, and we do it through interest rates. It's not our job to consider the effect on climate change of that, and I think any effect on climate change of that would be kind of minuscule.
Okay. Last question, Chair Powell. Who do you see as the major winners and losers from high interest rates in terms of income groups, age groups, and racial or other demographics?
So the point of high interest rates in the current environment is to bring inflation under control. The people who are hurt the most by inflation, as you know, are people who are on a fixed income, who right away are in trouble when the cost of transportation, food, energy, and when those things go up, they don't have financial resources to deal with it.
Have you looked
We're
at the-
accountable to provide price stability to the American people. Those people benefit the most over time from stable prices.
Gentlelady's time's expired. We'll go to the gentlelady from Missouri, Ms. Wagner, for 5 minutes.
I thank you, Mr. Chairman, and I thank you, Chair Powell, for your service. I want to associate myself with the comments of my colleague, Mr. Himes. I am concerned about banks' commercial real estate exposure, and I do hope that the Fed is doing everything it can to ensure that the exposure that these banks have will continue to be, in your words, manageable, because this is a looming crisis out there, given the workplace changes and dynamics. Chair Powell, In remarks on Bloomberg, Larry Summers, former Treasury Secretary during the Obama administration, stated that, and I quote, "It would be much more productive for our central bank to be focused on the question of real estate portfolios in the banks they supervise than, quote, some of the more abstract and politically driven arguments that about various kinds of capital charges on the largest banks." Do you agree, sir, that it would be more productive for Fed supervisors and regulators to keep their eye on the ball, in this case, commercial real estate and other real estate investments?
I absolutely think we need to keep our eye on the ball on commercial real estate, and I think we're doing that.
I hope so. According to your semi-annual report, the median of members on your Monetary Policy Committee estimate that your target overnight interest rate will average 4.1% in 2024. Does that mean that the median number of members anticipate that you will be cutting interest rates sometime this year by as much or more than a full percentage point?
No, it doesn't mean that. Actually, the Summary of Economic Projections showed a median of, this is in the December FOMC, so this is now 3 months old, showed 3 rate cuts this year. So that would be 75 basis points, 3/4 of 1 percentage point. You were quoting the next year's number, so you would add that on. That was through 2025, I believe.
So are you anticipating that there would be more cuts here coming?
It's not, the way I would say it is, we're making economic projections. And so we write down a path of growth, what's happening in the labor market, what happens with inflation, and what goes with those forecasts is an appropriate monetary policy, appropriate interest rates. So we expect inflation to come down, the economy to keep growing, the labor market to remain strong. And if that's the case, it will be appropriate for interest rates to come down, significantly over the coming years.
Good.
What will really happen, though, it's not a plan. What will happen is actually what the economy needs. The economy will do something different from that, and that's what will actually happen.
Chairman Powell, 15 members of Congress, including myself, Ranking Member Sherman, Chairman Barr, and Ranking Member Foster, sent a letter to the prudential regulators regarding the impact that Basel will have on U.S. capital markets activities. The letter highlighted critical areas of our U.S. markets, including securities underwriting, securitization, and derivatives that will be severely impacted by the Basel proposal. This was also a common theme represented throughout the comment file on the Basel proposal, over 95% of them. Considering that 75% of financing in the U.S. is done through our capital markets, which are the deepest and most liquid in the world, why would the Fed continue to pursue this flawed proposal instead of re-proposing a rule that would not have such a drastic impact on the U.S. economy?
Well, in fact, the capital markets concerns you raised are among those that I raised myself in our open board meeting when we put this out for comment.
You said you wanted broad support, and obviously there is dissent among some of your governors, the FDIC, others. So how are we coming on this, and how are we
we're working our way through the comments, and we're coming to the point where it'll be appropriate for us to begin to evaluate what changes are appropriate. I've said I think those changes will be broad and material, and that's where that is. But we haven't made any decisions yet. We just got the comments.
In my role as chairman of the Capital Markets Subcommittee, I have seen SEC Chair Gensler push the envelope in terms of rules and regulations that go well beyond the congressional mandate, even encroaching on the jurisdiction of other financial regulators. What is the Fed's response to another agency encroaching on its jurisdiction?
We do not comment on other agencies' regulation. However, if they were actually, to take your hypothetical at face value, if they were to come into our jurisdiction.
Oh, it's more than a hypothetical.
And we would react.
Good. Well, I hope you do. I yield back.
Gentlelady from New York, Ms. Velasquez is recognized for 5 minutes.
Thank you, Mr. Chairman. Right here.
Hi.
Hi. Thank you for being here, Chairman Powell. Property insurance rates are becoming prohibitively expensive or inaccessible for homeowners and developers in my community. The FSOC's annual report identifies property insurance rates as an increasing risk and I recently raised this issue with Secretary Yellen. Is the Fed monitoring the rising cost of insurance and its impact on macroeconomic?
Well, if we'll pause the clock, you can have staff take a look at the microphone.
We
The
need to
clock being frozen is out of respect for Ms.
Stop it.
Velasquez, or out of good luck, I'm not sure.
the clock.
But we'll get staff to listen. We'll just suspend for a moment.
We need to invest in infrastructure for this committee.
Yes. Well, we're trying to do electronic voting, and
Not voting.
no, it's hard enough to just get the microphones to work. Madam Clerk, thank you. Thanks. So all the photographers have left, so the awkward photos for Trish will be less awkward. We're good. Any luck? We're getting a new mic. It may not be better, but it's a different one. Let's just restore our time. Not quite yet.
Oh, this one's back. Now this one's back. Okay, great. Doesn't want to be replaced. Okay. So,
All right, we'll start over. We're going to restore the clock. Thanks for members' indulgence. Ms. Velasquez, you're recognized for 5 minutes.
So, Mr. Chairman, I was asking you about the property insurance rates are becoming prohibitively expensive or inaccessible for homeowners and developers in our community. The FSOC's annual report identifies property insurance rates as an increasing risk. And I recently raised this issue with Secretary Yellen. Is the Fed monitoring the rising cost of insurance and its impact on macroeconomy?
so yes, we are very much aware of increases in insurance, including property insurance, and it's been adding meaningfully to inflation. It's not something we have any control or authority over. Same is true of auto insurance. They're just insurance generally prices have gone up a lot.
So when we talk about the lack of affordability when it comes to housing, the insurance, the rising cost of insurance is an important factor that is affecting the availability of affordable housing in our communities. And I hope that there are some discussions among the Fed because it is an increasing risk and it's going to have a direct impact on our economy. Chairman Powell, I know you spoke with Chairman McHenry a little bit on inflation and interest rates. Can you explain what evidence you're looking for before inflation has returned to 2% and interest rates can be cut?
Sure. So we're not looking for inflation to go all the way down to 2%. That's not what we're looking for. What we want is just more evidence that will give us more confidence that inflation is on a path down to 2% sustainably. So that will come in the form of good inflation readings, really. We want to see, just a bit more evidence so that we can be confident. We don't want to have a situation where it turns out that the 6 months of good inflation data we had last year, that didn't turn out to be an accurate signal of where underlying inflation is. So we're just being careful, and because the economy is so strong and the labor market's so strong, we think we can and should be careful as we approach that decision.
And when you say evidence, what evidence? If there's anything?
So just more, we'd like to see more good, relatively low inflation readings. We're not looking for better inflation readings than we've had. We're just looking for more of them. And what will happen is that as we go forward, the 12-month inflation will continue to drop because it'll be lower than early last year.
Thank you. Mr. Chairman, I would like to pick up on where Ms. Tlaib left off and reiterate the importance of the rulemaking on Section 956. This is an issue that I also raised with Vice Chair Barr, Chairman Grunberg, Acting Comptroller Sue, and I told them when they came before this committee that I will be asking for a status update on the rulemaking at every future hearing because it's well past time, 12, 13, 14 years. If you are employed in a company and you are given a task, I will think that you will be fired if you don't get it done, and it has taken 12 long years. So you are the chairman of the Fed. How is the Fed working with other agencies to propose the rule?
So there's a lot going on in regulation at the Fed right now. My understanding on 956 is that there have been discussions between the regulatory agencies, and I think it's not 3, I think it's more like 6 agencies that have to agree.
I know.
I have not seen a proposal. I think something is under consideration, but it's not something that's gotten to me yet.
I will ask the next time, and believe me, I'll be here.
Great.
Thank you.
Gentleman yields back. Gentleman from Kentucky, Mr. Barr is now recognized for 5 minutes.
Mr. Chairman, good to see you. You have said numerous times that the capital framework is about right and that banks are well capitalized. Do you still believe this?
I do.
Given that you believe that, and given the fact that the Basel III Endgame proposal dramatically increases capital requirements on banks, would a reproposal that implemented Basel III in a capital neutral way, could it do so without jeopardizing financial stability?
Could. I mean, hypothetically, yeah.
Okay. According to Latham and Watkins, 97% of the comment letters either opposed, called for a reproposal, or expressed substantial concerns about the Basel III Endgame proposal. And those negative comments came from across the ideological spectrum and from various interests. Without objection, I would ask the chair to include that report into the record. Without objection, I'd ask the chair to include that report.
Without objection.
Thank you. And Mr. Chairman, did you see that report?
I did.
Does that concern you, that 97% of the comments were negative?
So we didn't do our own count, so I can't make an assessment, but I would say it's unlike anything I've seen.
The Basel III comment period ended on the same day as the Fed's data collection on the proposal, which is an odd process since the data should have been collected far earlier, analyzed, and the results should have been available for the public to comment on before the comment period ended. Why did the Federal Reserve choose to do a quantitative impact study during the comment period for the proposal, foreclosing any ability by the public to comment on the results of the study?
Well, I mean, the movie's not over. We are where we are, and Vice Chair Barr did commit to putting the QIS out for comment. We will receive those comments, and those comments will be taken into consideration as we think about the path ahead.
Well, speaking of process, you've got your excellent general counsel right behind you there, and I don't want to get into privilege here, but have the lawyers at the Fed raised any process concerns or Administrative Procedure Act issues with the board?
Let me just say that we're committed to doing transparent and reasonable and data-based rulemaking in compliance with the Administrative Procedure Act.
Well, of course, giving the public the ability to comment on the quantitative data that has been provided obviously is consistent with good process. Sir, Governors Bowman and Waller, Vice Chair Hill, and Director McKernan all dissented on the proposal, and Vice Chair Jefferson expressed concerns with it during his statement. Under your tenure as chair, can you identify any other regulatory proposal which has elicited this much dissent?
No.
Have you in the past acknowledged in front of this committee that you will not move forward with proposals without consensus? Or you have acknowledged that in the past, and we appreciate that commitment to consensus. Have you achieved consensus yet on the Basel proposal?
Let me say I am confident that we will, but that's a process that we're as I mentioned, we're evaluating the comments. We're just coming to the place where we're going to start talking about the path ahead. And I am confident that we'll achieve very broad support on the board.
Mr. Chairman, do you agree that the heterogeneity and business model diversity within the banking sector contributes to system-wide financial stability?
I strongly do.
And do you agree that a concentrated business model in the banking sector would present a potentially systemic risk?
Potentially, yeah.
And this is one of my major concerns with the proposal, Mr. Chairman, because by de facto repealing regulatory tailoring, subjecting Category 3 and 4 regional banks to one-size-fits-all standards that currently only apply to large GSIBs, discouraging securitization, which is the private sector solution for dispersing risk, eliminating the use of internal risk models, and transitioning the industry and regulators toward only a standardized framework, actually would push the industry into a smaller and more concentrated looking industry, and as a result would, in my view, actually increase systemic risk and decrease market competition. Do you share that concern?
I think it's a real concern. And again, I think that's part of what goes into my thinking, certainly about the proposal and where it needs to go.
Well, given all of these concerns, we hope that you can commit to reproposing the Basel III endgame, and we strongly urge you to take that into consideration. With that, Mr. Chairman, I
Gentleman from
appreciate the
Massachusetts,
time.
Mr. Lynch, is recognized for 5 minutes.
Good morning, Mr. Chairman. Welcome. Good to see you again. I want to go a little deeper into the commercial real estate issue and the potential impact on regional banks. This morning, Scott Rector, who's a member of the New York Fed Board of Directors, released a white paper on CNBC this morning describing the trillions of dollars in commercial real estate loans that will come due over the next couple of years. He described it as a, quote, slow-moving train wreck, close quote, and for our regional banks. He went on to predict that it will force a little over 500 banks, thereabouts, to either fail or consolidate. He also described what he termed as a doom loop where, similar to Silicon Valley Bank, when people lose confidence, when depositors lose confidence in the bank, they pull their money out and we end up in a bad situation. Now, I don't believe everything that I read or hear, but in Congress we do tend to repeat it. And I just wanted to get a sense from you. I am seeing in my own city of Boston, we've got 20% vacancy rates in office space. We rely on that for a lot of the tax revenues for the city. But I'm just wondering your thoughts on that issue. Is there a systemic concern here, or is this isolated? And might lowering the interest rates help some of those banks? Because I hear from my developers in our area that no one's lending. So, you crack at it?
Sure. So I haven't seen that report, so I can't comment on it, but I can comment on commercial real estate. So we've had a secular change in the economy, which has left office rentals in many places, office buildings. The demand for them is significantly lower, at least temporarily and perhaps for a long time. And also the same is true for downtown, in some places, downtown retail that's associated with office workers. So it's a shock to the system, and we've known this for some time, and we've gone through the commercial banks in the United States, and so have the other regulators. We've done it jointly, and identified the ones that have high concentration and are going to need to deal with that. And so we've been in contact with those banks and talking to them about how they're going to deal with this, how are they going to absorb these losses, do they have enough capital, do they have the liquidity, do they have a plan to do this, and is it consistent with their lending practices and that kind of thing. So it's going to be something we work through over a period of years. I do think it's slow moving. I think that part of it is right. You ask about 500 banks. I have no idea about that number. But certainly there would be some banks, probably smaller ones, that have these high concentrations. It's not the very large banks. It's really a manageable thing at the large banks. So I think that's what it's going to be, and it's a serious problem, and more serious in some locations and jurisdictions than with some banks than others. But it's one we'll be working through, and I think that's how I would think about it.
Does the Silicon Valley Bank situation, Signature, the money moves so quickly in those cases. It was instantaneous now. The velocity of money moving out of those banks really, I think, in some ways contributed to their failures. Are we looking at anything technologically that might be able to address some of that or mitigate it?
Sure. So we also, after Silicon Valley Bank, we got in contact with and worked with financial institutions that had high concentrations of uninsured deposits, and many of them have greatly improved their liquidity position. So that's the thing that we're working on. Okay. As you probably know, we're also working on some liquidity rules which will strengthen our framework of liquidity rules. But that's something we haven't proposed yet.
Let me ask you something off topic. So we know that Russia has about $300 billion in U.S. We've frozen assets, Russian assets of about $300 billion between U.S. and European banks. You want to comment on that? What I'd like to see is us give that to Ukraine, to be honest with you. I know that's a very simplistic idea, but I'm just wondering if there's any historic example that we could look to if Congress has to take the necessary steps to redirect that money to Ukraine so they can feed their people and fight that war.
This whole area of sanctions and foreign assets and things like that is really controlled and directed by the administration, by the elected branch of government. All we are is just a technical seat around, in the back row to help. We don't make those decisions, and I wouldn't comment.
I know you're big on history. I was just wondering if there was any examples out there that we might provide guidance to us.
Gentleman's time's expired. The gentleman from Texas, Mr. Williams, now recognized for 5 minutes.
Mr. Chairman, thank you for being here. When I'm back in my district in Texas, I'm constantly hearing concerns surrounding the fundamentally flawed Basel III. We've talked at length about that today, endgame proposal. These concerns are not only coming from my banking industry, but also from farmers, ranchers, small business owners who are concerned about how this proposal will impact the ability to access capital in the future. And to all of us, did it not raise alarms? And we've heard about the 97% today of public comments on this proposal, and they all came out negative. And Americans across all sectors are worried about the disastrous implications that will follow this proposal and have tried to make that known to banking regulators who continue to ignore them. It is time for federal regulators to take these concerns seriously and, quite frankly, just, I believe, start over. So I urge you and your colleagues to rethink the misguided policy and do what is best for American people, small business, Main Street America, and withdraw the Basel III proposal. Now, Chairman Powell, given the concerns raised by financial institutions, again, farmers, ranchers, et cetera, and other communities across the country, can you elaborate on how the Federal Reserve is responding to and addressing these comments that are mostly negative and request modification, delay, or complete withdrawal of the proposal of Basel?
Yes, I will. So we're in the process of reviewing the comments. They were quite voluminous. They were very detailed, a lot of data, a lot of analysis, and that's just what we wanted. So we got those, and now it's a lot. It's hundreds of them, and we're going through them, and we're just at the point where we're about to begin then turning to the question of what changes should we make to the proposal. We haven't made any decisions. We haven't really gotten to that stage yet, but we're getting, remember, we only got the comments less than 2 months ago, so it's just we're at that stage. So we're looking at it. As I've mentioned, My own view is that there will be material and broad changes to the proposal as we go forward, and we haven't really made decisions yet, though. It's just a little bit early for that.
We're glad you're looking at it. I want to bring up the long-term debt proposal rule, which would require banks to issue enough long-term debt to cover capital losses. Now, Congress worked to pass legislation requiring the tailoring of regulations to the size of a financial institution. This is meant to protect banks of all sizes and allow for families and businesses in my district to have options to meet their lending needs. So the Fed's long-term debt proposal would undo any sort of regulatory tailoring and puts into place a new long-term debt issuance requirements on regional banks, which require these banks to issue long-term debt both at the parent holding company level and the IDI level. Now, these regional banks will face increased costs when they are already facing towering regulatory burdens from this administration, and those are the banks that people do business with. So, Mr. Chairman, do you believe that this proposal rule goes against the requirements of S. 2155, the Economic Growth, Regulatory Relief, and Consumer Protection Act, and will you commit to exploring this issue further with your colleagues?
So we're committed to implementing 2155. We believe that the regulatory and regulation and supervision of banks needs to reflect their size and activities, and that's something we'll be considering as we go forward with this.
Okay. Short time I got left. Americans continue to feel the pain from runaway inflation created by the Biden administration as everyday costs continue to stay expensive. As you know, I'm in the car business, and inflation is just running rampant in my industry. And the irresponsible and partisan American Rescue Plan forced through Congress by Democrats only made inflation more of a problem. And now American families and businesses have been forced to deal with runaway inflation for 3 full years now, which has caused some major hardships. So quickly, the ARPA injected nearly $2 trillion of deficit spending to our already struggling economy. And how does this type of inflated spending, combined with economic headwinds like supply chain shortages, impact the economy? And doesn't this kind of reckless spending actually fuel the pressures of inflation?
I think there are a lot of causes of the inflation we've seen. We saw this inflation everywhere in the world. So the reopening of the economy after with very strong demand and constrained supply, you saw inflation in all the advanced economies. It was a little sharper here at the beginning. I think there's a role for monetary policy in that. There's a role for fiscal policy. There's a role for the pandemic, a starring role for the pandemic. Our job is to deal with it, and that's what we've been doing.
Well, thank you for always keeping small business in Main Street America in your calculations. And with that, Mr. Chairman, I yield back.
Gentleman yields back. Gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Mr. Chairman, I want to thank you for recognizing in your opening statement the importance of immigrants in keeping costs down. And I want to thank you and the administration for what has been an excellent 2023 economic report. We've got 3.1% economic growth, by far the best in the developed world. Headline inflation, 2.4%. And that's not a little blip, a 1-month number. That's for the whole of 2023 and compares very favorably with the pre-pandemic portion of the Trump administration when we had inflation of 3.5%. My goal here is to convince you to cut more and sooner because for a number of reasons. The first is that I know, if you ask a constituent, they want zero inflation and zero unemployment. You know that we can't have that and have concluded that the economy works best with a 2% inflation rate target. But I've looked at the history of that 2% number. It seems to come from Auckland from the 1980s. And there's a lot of arguments that your target should be just a little bit higher. Larry Summers recently produced a study arguing that the cost of money is part of the cost of living. So we have this weird paradox where you're trying to keep the cost of groceries down by raising interest rates, but as the ranking member points out, the big issue is housing. And your measure of inflation seems to treat all Americans as renters, even though 2/3 are homeowners. And so when interest rates go up, that's an increase in the cost of living for anyone with an adjustable rate mortgage, anybody looking to buy a house, anybody with a home equity loan. Obviously, we would cut interest rates a little sooner and a little more if your target was something closer to 2.3%. So I'll ask you, is there substantial economic analysis that argues that your target rate and the economy would work better if we had a slightly higher target than 2%?
Not really, no. What's happened is, you pointed out New Zealand, but what's happened is that 2% has become the global standard. It's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation. You know, we're at 2.4% right now, headline inflation.
I would ask leave to add to the transcript of this hearing numerous articles that argue for something between 2.3 and even 3%. I'm not arguing for as high as 3%. Let's look at Basel. There's nothing free here. If the standards are too high, we lose economic growth. If they're too low, we have bailouts and bankruptcies. But I think everybody agrees that the standard should be well crafted. You've got a system where everybody drafting this is well dressed and focused on Wall Street, and you've got Basel rules that discriminate against Main Street and for Wall Street. I'll give you some examples. 65 basis, it's 65% if you're a publicly traded company and make a loan to a publicly traded company. You make a loan to CalPERS, they're not publicly traded, without objection, I'd like to put in their article into the record. And so they're, in effect, going to have a tougher time getting a loan. The local pizzeria is going to have a tougher time getting a loan. You've got, in Basel III, ignoring mortgage insurance, which obviously makes the loan more prudentially sound for the bank and is very necessary for first-time home buyers. And you've got a system where if you make investments in long-term bonds on Wall Street and you put them in the hold-to-maturity category, you don't have to recognize the losses and mark to market. So there, I hope you'll look at these in terms of the competition between Wayne Street and Wall Street for bank loans. Finally, we go to clean energy investment. Can I count on you to personally look at the paradox where Basel III treats clean energy tax credits much more harshly than low-income housing tax credits for no ascertainable reason?
Yes.
Thank you.
Gentleman's time has expired. The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Well, thank you, Mr. Chairman. Mr. Powell, thank you for being here today. I'm concerned with the small dollar credit for businesses. As a former business owner for over 20 years, I can attest that as the small dollar business credit becomes more expensive and less convenient, businesses are going to turn to credit cards and other alternative financing for business purchases. These inevitably result in even higher costs, which goes down to the consumer, which means that they're going to pay more for the services or the products. But in February of this year, total credit card debt reached a record of $1.7 trillion. According to Intuit's Small Business Index annual report, average monthly credit card balances were 27% higher in 2023 than they were in 2019. What do you view as the driving force behind these record high levels of credit card debt?
Part of it would be growth in the economy, so that'll be part of it, just that it's a bigger economy and a bigger number. I'm not sure what that is. You know, as you know, people had lots of extra cash during the pandemic from forced savings. They've spent that down, now they're borrowing. I'm not sure.
So if there was a rule to force banks to tighten lending, do you think the rule would drive businesses and consumers to alternative forms of credit?
I do. I think, you know, if you raise lending costs for banks, then at the margin that will make non-bank lenders, you know, they'll get some of that business.
And if it becomes more complex or less convenient, then businesses will turn to these alternative forms like credit card. I can tell you that from experience. Yes. Well, I've called for the withdrawal of the Basel III endgame proposal entirely. Will you commit to an analysis of how bank capital proposals like Basel affect small business credit access and the small dollar lending before finalizing such proposals?
I commit to that. Let me look into that. I don't want to make a commitment that I'll undertake some big study, but we'll look at the issue.
But do you feel it's important that we do have an understanding the effect it's going to have on folks? Small businesses, the backbone, it's the bloodline of our
and they create the
economies.
jobs. That's
Yes.
right. I do agree. Yeah.
Okay. The chairman asked you for your thoughts on withdrawing or reproposing the Basel III endgame proposal. Have you specifically discussed withdrawing the proposal with Vice Chairman Michael Barr or the other governors?
So I don't want to get into our internal, doings, but I will say that I understand it is a live option. Again, we're not at a stage of being able to even have that discussion yet because we're not really, we've got to decide first what changes do we think are appropriate, and that'll take a little time. And then the question will be reproposal. What I said is, when we get to that point, if reproposal is the right thing to do, we're not going to hesitate at all. It's a perfectly live option.
All right. In the current environment we have in politics in this country, there's not a lot that you find bipartisan agreement on, but I think you could find some agreement in withdrawing that proposal. Can you explain the importance of broad consensus at the Fed on proposals like B3E? Are you concerned with recent trends of disagreement among board members related to major proposals?
So I think we're going to get to broad consensus at the Fed. I do. I think it's very important. This has been our culture that we try to find common ground, and we've been able to do that in the regulatory space, and I expect we will be here as well. And I'm committed to that.
Could it be that we're seeing this level of disagreement because of extreme measures that are being taken now that may not have been taken in the past? I mean, a total difference of opinion and understanding and philosophy regarding a free market economy.
I won't speculate, but I will point out that 4 of the 7 governors during the open board meeting at which we put it out for comment expressed real concerns, very specific concerns about the proposal, and said we would look at the comments when they came in, and that's what we're doing.
All right. Do you feel that they have validity in their concerns?
I was one of the 4, so yes.
All right. With the few seconds I have remaining, there's a recent report of FinCEN working with financial institutions to query legal purchases made by American citizens. Has the Federal Reserve been instructed within the past 3 years by Treasury or anyone else to search Americans' legal transactions?
Not that I know of, no.
Okay, thank you. I yield back.
Gentleman from Illinois, Mr. Foster is recognized for 5 minutes.
Thank you, Mr. Chair, and thank you for being here. As Ben remarked, there's a near-term emergency to get the $60 billion in military assistance to Ukraine. And separate from that, there remains a longer-term need for reconstruction assistance to Ukraine, which the World Bank estimates is somewhere north of $400 billion. Now, at the start of the Russian invasion, the free democracies of the world froze roughly $300 billion in Russian currency assets, primarily at European banks and financial institutions. And the Biden administration and many of our allies have recently taken the stance that those assets should be leveraged somehow to provide reconstruction resources to Ukraine. I support this concept, and I believe that additional action should be taken to ensure that we hold Russia accountable. But there are real concerns on the impact that this might have on central banking system, on the primacy of the dollar, the euro, and so on. And so my question is, have you seen just the act of freezing these assets and not seizing them, but simply freezing them? Have you seen deleterious effects on the primacy of the dollar, the confidence in the central banking system? Is there any visible downside from the act of freezing that's visible so far in the 2 years since we've done it?
I can't point to any. I can't point to any.
Okay, so that's an interesting observation when we think of taking the additional step of actually seizing them, that at least so far, because, to my mind, having them frozen is as violent as and as violent as seizing them outright. And so that's interesting that so far we haven't seen that. Now, in terms of the Basel III and so on, there is there's a frustration I've had over the fact that directionally the effects of these are clear, but the magnitude of effects are not. You know, for example, if you talk about the effect on the prices seen by derivative end users of increased capital requirement, directionally it's clear. If you raise capital requirements, banks will withdraw from these markets to some extent. Other players will step in partly and take up part of the slack, and the spreads will increase and so on. Is the data that you've collected enough for you to actually estimate the magnitude of these effects instead of simply the direction?
I think it's really hard to get down to the micro level and try to assess that, because you're right, there would be multiple effects. But you do know that you know the direction, you know what the sign is.
That's right, but you know, if you can avoid financial crises with a microscopic increase in prices seen by end users, that's one thing. If it's a very large difference in the price, so that the magnitude matters a lot when you're doing these balancing things. And a lot of it depends on, actually, you need a model for how the different market players will react. And is that really not going to be in the scope of the analysis that you anticipate from the quantitative?
I believe we have done some work on that, and I think the banks and other participants have done work on that as well, and come up with a range of answers. But you know, this is I mean, there are just an awful lot of variables in these equations, so it's hard to say with any confidence. I mean, that's why it's hard to, the job of deciding the precise level of appropriate capital is a hard one.
Yeah. And now with, you know, with 10 years, we've had two major crises with both a fiscal and a monetary response. Are there the lessons that you can learn now that, you know, I believe, and it seems like your testimony indicates that we're kind of approaching back to normal now? And we've seen in the crisis of 15 years ago, we saw what many people thought was an inadequate fiscal response, that the fiscal response was, you know, less than half of the output gap. And we limited by political, you know, political will to do things. And then, of course, you were limited by the zero bound in what you could do for most of a decade, and we had a long recovery. And the comparison, you know, to the COVID recovery has been very sharp, and it's quite remarkably put us right back on that track. Are there any lessons that you've sort of drawn about the importance of the getting the right balance of fiscal and monetary response to these shocks?
So we think about that a lot, and I think I have to start by saying it's too soon to really tell, because the answers you would give today, the picture looks very different than what it looked like a year ago. And so, and a year from now, we'll be looking back going and saying, we've learned so much more. So I think the pandemic is still writing the story of our economy right now, and we should just be prepared to be surprised with the next chapter, as we were with 2023, the very strong growth, the sharp decline in inflation while the labor market remained very strong. Very few forecasters had that, but we can talk about it.
Gentleman's time has expired. We'll now go to the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you for being here today and for your testimony. I'd like to start off, first of all, by completely echoing everything Congressman Barr said. A lot of us have talked about Basel III endgame. I think Congressman Barr kind of nailed the thought process. I do hope you'll kind of withdraw that and take the comments you've heard from here and from so many others about the hazards with the current approach. But I'd also like to address one of the other practices by the Federal Reserve, and it's the practice of paying interest on excess reserve balances held with the Fed accounts. It's my strong belief that rewarding banks with returns for taking no market risk actually harms our economy, and it discourages financial institutions from lending money into the economy. Instead, they park it at the Fed. This has little to no impact on very large corporations, but it can have a crippling impact on small and mid-market firms. And we especially saw this in the long recovery as Dodd-Frank was implemented in the Obama years, transition to the Trump years. We changed some of that mindset with a lot of other policies, but we saw a strong surging economy. So our countrymen pay a price for this market distortion by the Fed in two ways. First, they're unable to obtain loans at competitive rates because the money's sucked out of the market. Frankly, a lot of them don't even have access to lending except through bank capital. So it forces them into other forms of capital, equity capital, and others. Second, they ultimately pay higher rates whenever they have these alternative means of capital. And so today I've introduced a prohibition on the IOER Act, which would prohibit the Federal Reserve from paying interest on excess reserves. By eliminating IOER, we can begin to return our economy to the undistorted free market economy it's supposed to have. You know, the alternative is you could simply raise requirements. We see some of those moral hazards when you do it across the board with approach like Basel. So what's your case for why you should keep paying interest on excess reserves?
Well, as you know, we don't see the downsides that you're talking about. You know, banks have a cost of funds and they have what they can earn, and that's what really matters is the spread.
And if they wanted to do it, they could simply buy treasuries on their own, and they could do that independently. I suppose they can independently keep it at the Fed, but they don't have to buy. They don't even have to put it on their own balance sheets in the same way. They've got immediate liquidity with Fed overnight account. So I don't see how that's different than what they could already do.
What I was going to say was, you know, banks can earn a much bigger spread by lending to corporates. So their incentive to lend is the same as it always was. This doesn't affect that. You know, really, it's they have a cost of funds and they have the ability to have reserves, but you know that's not going to. They're not earning a profit on that. So, or a big one. They can earn a much bigger profit by lending to small corporates.
Well, speaking of profit, I mean, the Federal Reserve isn't officially supposed to be a for-profit corporation, but you are supposed to pay for your operating costs off of positive cash flow. And right now, the Fed doesn't have positive cash flow. In fact, the Fed has negative cash flow. So it's not entirely unrelated that the Federal Reserve operated at a $114.3 billion loss in 2023 and currently is carrying a $133 billion loss on its balance sheet this year. So it's, you know, not the right approach, I think, to be paying essentially that much out in excess reserves to banks that are holding capital in the Fed when they could be deploying it into the market. So right now, the interest you're paying banks and money market funds exceeds the income you're getting on the $7.6 trillion balance sheet assets that you have, to the tune of $133 billion asset. So, you know, effectively, the Fed is operating at an operating loss. So what's the path back to cash flow positivity for the Fed?
As you know, for many years during the QE large balance sheet period, we've contributed way over $1 trillion in net earnings to the bank, which to the Treasury Department. So you can't look at the loss without mentioning that we've been giving effectively $100 billion a year in profits every year to the Treasury Department. So the other side of that is when we raise rates to do the job you've assigned us to get inflation under control, when we do that, we absorb paper losses. It has no effect on our operating, the way we operate the Fed. And you know, if we retained all the earnings we have, then it wouldn't be a problem. But we don't do that. We give that money to Treasury.
Thank you. And I think the last thing is I just encourage you to halt any effort to develop a central bank digital currency. It doesn't need designed, developed, and it certainly doesn't need established. I yield.
The gentlewoman from Ohio, Ms. Beatty. Mrs. Beatty is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our ranking member, and thank you, Director Powell, for being here. Let me start by saying thank you for the monetary report. I've had a chance to try to peruse it, and there are headings in there that says the labor market remains strong. You'd probably agree to that, your report.
I would.
Let that say that's a yes. Also, it talks about unemployment rates being low by historical standards. You'd agree with that? It also states that the global pandemic played a huge role with the inflation rate, and inflation rates are on the decline. It's reported in several charts in here, and also substantiated by the Federal Reserve of New York and Michigan surveys that I've read. It also talks about job gains and uses the word robust jobs. So I want to thank you for educating us on that. And Mr. Chairman, I'd like the record to show that all of this also resulted during the Biden-Harris administration of making sure. So often we hear in this committee and other committees about what the administration is not doing and what our economy and jobs look like. Now let me move on to something that's very dear to me, and want to thank our ranking member for bringing it up, and that's the lack of affordable housing, which is one of the primary things that I hear about when I'm back home. I'm on more panels to try to explain what you do, what we do, or oftentimes what we don't do and why we have this. While I know that interest rate hikes have successfully brought down the inflation, rising rates have also had an adverse effect on the cost and the pace of housing construction and costs. Are you concerned about the effects that interest rate hikes are having on the cost of financing new construction? And the second part, how do you expect to control for long-term housing inflation that might have a potential rate cuts, how it might affect that?
So our policy to bring inflation down is to raise interest rates, and that works through several channels. One of them is probably the most important, is interest-sensitive spending, and within that you have housing and durable goods and things like that. So, you know, during the early days of the pandemic, the housing industry was about to all go bankrupt, and all of the facilities that we did really supported that industry through their critical time. When we're going in the other direction, when we're raising rates, housing is definitely affected. We understand that. It's not something we want to have happen, just it is the reality that housing will slow a lot when you raise interest rates. We've done that, and we're doing it for the longer run benefit of the people we serve to restore price stability, which is beyond value for people to have price stability. We get it that in the near term, that's higher rates, that's fewer sales, people are locked into low-rate mortgages, we get all that, but we got to do this because it'll benefit the country and people in the longer run.
And I have a great appreciation for that, but also when I go back home to the district, what I hear a lot from agencies and individuals who work with advocacy groups, that the effects of interest rate hikes are not borne equally to all American households. So we hear that, and there's no doubt that low-income and minority communities are hit the highest or the hardest by these monetary policy changes. Black households and business owners have historically faced challenges with home ownership and access to capital, and they're disproportionately impacted by the rate hikes. Does the Fed, do you have anything that you could help me with this dilemma and how we can better achieve economic goals in a more precise and equitable manner?
So I think it's working. You see inflation coming down, and that's why I do think it's likely at some time this year, if the economy, proceeds along the path we expect, that we will begin to reduce rates. So that's really the path that we're on, and I do hope it works out that way.
And when you say, I don't have a lot of time, but when you say economy, what does that mean? Helping poor people and Black people get more jobs, more money?
So our forecast is for continued strong growth, a continued strong labor market with wages going up and also with inflation coming down. So that kind of an economy.
Okay, my time is up. I yield back. Thank you.
Yeah, John left.
Gentleman
I'm not
from
here.
Tennessee, Mr. Rose is now recognized for 5 minutes.
This is
Thank
AI
you, Chairman
John.
McHenry and Ranking Member Waters for holding this hearing, and thank you, Chair Powell, for being with us today. I'd like to start by discussing the Independent Automated Teller Machine Owners or Operators section of the Bank Secrecy Act Examination Manual. I want to ensure that financial institutions will not be discouraged from providing banking services to the independently owned ATM industry. In 2021, you made it clear that the industry does not automatically present a higher risk for illicit finance. I'd like to know what efforts have been made by the Federal Reserve to fully communicate that position to financial institutions across the country.
I will have to get back to you on that one.
All right. Thank you. Well, and so I might just add, listening to independent ATM operators over the time that I've served in Congress, I've come to understand that unfortunately, and it was in the bank examiner's manual up until just about a couple years ago, these operators were identified as being extraordinarily risky, and that was causing them to be debanked in many cases. So I do hope that you'll take a look at that and make sure that we're communicating that to financial institutions and, most importantly, to the regulators. Chair Powell, Tennessee is home to over 1,000 foreign-based businesses that have chosen to invest in our state and create more than 160,000 jobs. These jobs are reliant upon cross-border financing provided by global banks, including foreign banking organizations. The Federal Reserve has long maintained the principles of national treatment and equality of competitive opportunity when regulating foreign banks and assessing them based on their U.S. operations. Are you still committed to these principles?
Yes.
And how will these principles be reflected as you move to finalize the Basel Endgame proposal?
So we have received a whole separate set of comments from the foreign banks, and we'll look at those, very much in that spirit and make appropriate changes.
Thank you. Chair Powell, the Basel III Endgame will incentivize firms to transfer credit risks off their balance sheets. One avenue for such a transfer is synthetic securitization, the framework of which must be approved by the Federal Reserve. However, it is my understanding that there is a substantial backlog of reviews and approvals of these securitization frameworks. It is concerning that the Federal Reserve is directing the risk transfer, yet also impeding it, in my view. Can you comment or can you commit to reviewing this approval process and taking steps to reduce the backlog of pending securitization applications?
So as I understand it, these transactions are becoming popular right now. There's a lot of appetite to do them, and we're not stopping them. We're just being careful because there were similar things that happened about credit risk transfer during the global financial crisis that didn't actually work out. So we want to make sure that these structures really do actually durably transfer, and we think that they do, but we just need to be careful because the last experience with these was difficult back in the last crisis. So it's just something that we're not intending to slow these down, and I think we'll try to get through it.
Is it a lack of available resources to apply to the approval process, or is it an intentional slow walking to make sure that every I is dotted, every T crossed?
I don't actually know, but I do. What I heard was, what I've been told is, we're not stopping these, but we're going to be careful with them and just be absolutely careful that they really do transfer credit risk in a durable, kind of sustained way. And that's the thing. And I don't think it's an intention to go slow or to have a backlog. It's just, and so I don't know what the staffing issue is. We'll check.
All right, thank you. As the Federal Reserve continues to consider proposals designed and debated in Europe, such as Basel III, has the Federal Reserve's Supervisory Climate Committee or the Financial Stability Committee had any discussions regarding the adoption of ESG risks in capital requirements?
I don't know.
Has there been any discussion in other committees regarding the adoption of ESG risks in capital requirements?
Any discussion, I really don't know. Let me say that's not something we're considering, but when you ask me any discussion, I don't know.
It's not a priority in
to
capital requirements.
To put it mildly, yeah.
Okay. Thank you. I see my time is running out. I appreciate your answers, and any further light you can shed on those matters, I'd appreciate. I yield back, Mr. Chairman.
The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, for being here today. I want to start then just with following up on the exchange you had with Mr. Sherman. As I think you know, I led a letter with 106 of my colleagues with concerns about specifically the clean energy tax equity provisions in Basel. I appreciate your commitment to look at that. I wonder if I could just put a little bit of a sharper point on it. Can you look at that before the rule is finalized and potentially issue some sort of an addendum to the rule? The concern I have is the number of banks who are a little bit frozen right now, waiting for some clarity on that, and I'd prefer we not slow down the rate of clean energy investing in our country if we don't have to.
I don't know. I mean, I think there's a proposal, and we're well aware of the commentary, and we're going to react appropriately. I don't know that we can pull one thing out of line and deal with it But this is, we're making good progress, and I think we'll be back reasonably soon with some answers.
Okay, well, time is of the essence. Appreciate anything you can do. Second thing, good thing about going late here, you get to follow up. I want to follow up on your discussion with Congresswoman Garcia here. I really appreciated your comments in the 60 Minutes interview last month when you mentioned that immigration is a big part of the story of the labor market coming back into balance. Now, generally, and correct me if I'm wrong, more immigration is generally going to ease inflationary pressure. Is that all else equal? Is that a safe characterization?
It's probably closer to neutral, actually, because people come in, they also spend, so it's not clear that immigrants coming in, they add to GDP.
Okay, so either we're going to get economic growth and or downward pressure on wages.
More workers, so that wages might go up a little bit less, but at the same time, they're also spending. So we had this conversation. It depends on what you assume, but I think it's better to just assume it's sort of broadly neutral from an inflation standpoint.
So I guess, and maybe you've answered the second question, but given as you all are using the Census Bureau data that is more conservative than the CBO data, and obviously we're all making estimates in the future, can you speak at all to whether your forward views on economic growth and inflation, how sensitive are they to your assumptions about that census versus CBO data on what the actual level of immigration is to the country right now?
I think the CBO assumptions are meaningfully higher and would affect growth and would be part of the explanation why growth was strong last year and would be a reason to expect. I mean, it's not the main reason, but it would definitely add to growth this year. And I wouldn't say that we accept one version of the other. We study the CBO numbers carefully. We're just trying to get to the right answer. But I think the CBO shows, and they say so, stronger growth, higher growth, more people. I don't know the per capita growth goes up, but the absolute level of growth goes up.
Okay. Last question. I think there's a lot of good news in the monetary report that you all just issued around wage growth. We've seen, the lower quartile of earners starting to close some of those historic gaps. We've seen minority groups and women start to close some of those gaps. What I didn't see, and I don't know if this is because you all haven't done it or I just didn't read closely enough, have you seen any gaps regionally within the U.S.? Are there parts of the country that are seeing stronger wage growth than others?
There are. I don't have that off the top of my head. I want to go back and if I can just, when I talked about immigration, I think that the immigration story for last year was part of the positive supply shock and was part of the reason why inflation came down. I was really asking the question over the longer run.
Fair enough.
And there, I think it's more of be neutral.
I appreciate that. I want to just close on this regional piece because the Atlanta Fed, which is the best I could find that looks to do at least some by census regions, that as I look through, there's and you look at which regions are consistently running above. I think that New England and the West are consistently showing wage increase above average. And the West, South, Central, Texas, Oklahoma, Arkansas, Louisiana are consistently, I think going back to like July of 2022, consistently seeing wage growth below average. And I appreciate you're not going to wade into a political question here, but those are all right to work states where it's harder to unionize, where it's harder to organize. And what I'm wondering is, without asking you to opine on policy, have you all at the Fed done any analysis that says, as we look at when there are gains in labor productivity, does that gain in labor productivity, is it more likely to accrue to workers in those states where there's a stronger union presence, easier to organize, and more bargaining power for labor as opposed to capital?
My guess is there's plenty of research around that area, not necessarily at the Fed, but we'll take a look and come back to you.
Okay. All right. Thank you. I yield back.
Gentleman's time has expired. Now go to the gentleman from South Carolina, Mr. Timmons, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. We continue to appreciate your work and the work of the Federal Reserve on behalf of the American people. In August of 2023, the Federal Reserve, FDIC, and OCC released the NPR requiring the issuance of long-term debt for Category 2, 3, and 4 banks. As you may know, I, along with many of my colleagues, authored a letter to each agency expressing concerns regarding the lack of tailoring in the proposal and shortcomings in estimating the actual cost of the proposed rules. I'm concerned that these shortfalls will negatively impact lending in my district, and when combined with the other ongoing regulatory proposals, could cause further consolidation of the banking industry. It appears that the Federal Reserve has primarily deferred to the FDIC concerning the proposal. Could you shed light on the Federal Reserve's role within the rulemaking process concerning the long-term debt proposal? And have you provided input regarding the proposal's interplay with Basel III Endgame?
You know, I think we're one of the proposers of the rule, just like the other agencies are. And, you know, right now we're looking at the comments that we've gotten. That comment period, I believe, has closed, yeah. And so we're very much in reading those comments as the law.
You're in the middle of it,
do.
fair to
We
say.
are.
Okay, thank you. I'm concerned that the long-term debt proposal's lack of tailoring contradicts the statutory requirements of the Economic Growth, Regulatory Relief, and Consumer Protection Act. Instead of applying tailoring principles, this proposal creates Category 2, 3, and 4 financial institutions identically for the purposes of long-term debt issuances. Additionally, the proposal unduly burdens Category 2, 3, and 4 banks by requiring them to issue long-term debt at both the parent holding company and bank level, which actually could be viewed as reverse tailoring, considering GSIBs are only required to issue debt at the parent company level. What is the underlying rationale behind this dual requirement, particularly when such a mandate is not imposed on our largest banks? And do you believe that this represents a tailored approach as required by the statute?
So that tailoring question is one of the questions we'll be asking ourselves as part of our review of the comments.
Thank you. It's my understanding that Category 4 banks were not included in the original advance notice of proposed rulemaking for the long-term debt rule released in the fall of 2022. Is that your understanding as well?
I didn't catch that.
Did the advance notice that was released in the fall of 22 include Category 4 banks? It's my understanding that it did not.
I can't confirm that, to be honest.
Well, I think that's something that you should take into account because the Category 2 and 3 banks have had an additional year to foresee this challenge. And so Category 4 banks are really behind the 8 ball. And yeah, so I guess my next question is, do you believe regulatory agencies should provide smaller regional banks longer than the 3-year phase-in period to meet any final long-term debt requirements?
It's a good question. That's one of the comments we've gotten, and we'll be looking at that.
I just think if we're going to impose these new regulations, giving everyone the same opportunity to comply with them is something worth considering. I guess one final question. If these proposed regulatory changes had been in effect prior to the fall of SVB and Signature, do you believe the outcome would have been different? Because honestly, I don't think anything would have changed.
You know, it's a hypothetical. I'm tempted to say that if there had been more long-term debt there that was specifically there to absorb losses.
They were nowhere near being solvent. But I guess that's something I think y'all should take into account, whether if these proposed changes to our system that are designed to make it more resilient would have actually caused SVB and Signature to have a different outcome. Because again, it just seems that my colleagues across the aisle let no crisis go to waste. And these are changes that would not have, in fact, prevented the calamity that they are justifying the changes based on. Thank you for being here today. And with that, Mr. Chairman, I yield back.
Gentleman yields back. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you. Due to the Fed's aggressive interest rate hikes, mortgage rates have surpassed 7%, rising to 20-year highs, leaving many creditworthy and mortgage-ready homebuyers without a path to homeownership. This is a problem for everyone. It's an urban issue, it's a suburban issue, it's a rural issue. Chairman Powell, I welcome the decision of the Fed to pause rates at the end of last year. But for families in my district and across the country, that is not enough. We need the Fed to start cutting because, like the rent, interest rates are too damn high. Chairman Powell, you've previously indicated that the Fed may cut rates this year. What would you expect the impact of lowering interest rates to be on the housing market specifically, including the rental, purchase, and construction market?
So we know that higher rates, of course, have slowed down the rate of activity. So if at such time as we start to lower interest rates, housing market will pick up broadly across new home construction and new home sales. The number, as you know, many households are in very low rate mortgages and they really can't sell because they'd have to refinance into a high rate mortgage. That'll go away over time. So ideally, the housing market would go back into a more normal phase, but one with lower inflation in the broader economy.
Right, so just to further reiterate that, interest rate cuts would have a great benefit. Just yesterday, actually, I met with a number of representatives from state housing finance agencies from throughout the country, and they were talking about the barriers to affordable housing projects given the current interest rate environment. Obviously, higher interest rates have raised costs for affordable housing developers, and many of them have chosen to slow down or halt construction entirely. So fewer homes are being built, which means fewer people are being housed. So given that we already, would you agree? So given that we already had a massive shortage of affordable housing supply prior to the pandemic, when interest rates were below 2%, the current rate, 5.5% rate, has been devastating. And the price of homes across the country have remained stubbornly high. It's clear that the current state of our housing market is impacting everyone and disproportionately hurting those who need stability the most. Does this concern you?
So our job is to do price stability and maximum employment. We don't target the housing market. And we're doing our jobs. That's what we're doing. It's not something we want to see, but
does this
is
impact
the
on the
path to
housing market?
restoring price stability.
But does it concern you, Chairman Powell?
Does it concern me?
Yes.
It would
Fewer homes are being built, so fewer people are being housed.
This is the job we've taken on.
All right. Well, it concerns me greatly. Chairman Powell, the Fed's interest rate hikes have not been sufficient in addressing housing inflation. Do you agree that we need a more robust fiscal response to increase the supply of affordable housing and to lower costs nationwide?
So we don't take opinion, we don't express opinions on things like that. I will say that there is a structural housing shortage in the United States, and that's really the longer run problem. The problem with high interest rates is a short run problem. The longer run problem is lack of supply.
Well, that's why it is critical that Congress pass legislation and appropriation bills that will make those necessary investments in housing for all. Given the way that Ranking Member Waters fought for a $150 billion investment in housing and Build Back Better, I know on this side of the aisle that my colleagues and I are ready and waiting for the Republican majority to take housing inflation seriously. Housing affordability is the #1 issue I'm hearing about from my constituents. Families in my district and throughout this country need relief now. I truly hope the Fed will listen to them and cut interest rates. Thank you. I yield.
Gentlelady yields back. The gentleman from South Carolina, Mr. Norm, is recognized for 5 minutes.
Thank you, Chairman Powell. I think other people have noted about the crisis in the office building market across this country. That's a line of work we're in. I can tell you it's real. I can tell you the buildings that are effectively vacant, it's going to have an effect on the taxes paid. It's going to have an effect on rents. As far as affordability in housing, the rates are one thing, but my good friends on the other side of the aisle don't realize that housing has got over 200 components to it. One of the biggest is gas prices. And as long as we're buying gas from countries that hate America and don't manufacture our own, housing isn't coming down. I don't know how you define affordable anyway. It's going to continue a downward slide. And I'm from a state in South Carolina that people are moving in. And we're not going to have the housing starts that we should have because of the policies of the Biden administration, which is train wrecking this entire economy. On regulations, on Regulation 2, which is has the guardrails for credit card fees, how do you answer and I know the caps you're looking at adjusting that. How do you answer the charge that this is really should not be, you're getting in the way of banks charging fees according to what their costs are? How does the regulations affect that, particularly Regulation 2?
Is this a Fed regulation we're talking about,
Yes,
or is this the CFPB regulation?
No, this is, for my record, it's the Federal Reserve has finalized the routing restrictions and proposed tighter and adjusting the price caps that currently exist. Is that not right?
It doesn't ring a bell with me. It may well be right. I'm not familiar
If you
with
could
that.
look at that, I know
will.
that all the credit unions and banks have got some concerns on that.
I will come back to you on that.
Okay, I appreciate it. Do you need a letter from us, or?
No, we'll come back to you.
Okay, thank you. CRA, for those of us who have been involved with banking for a long time, the regulations, having a clear set of standards that we abide by and know where to put the money to, when should we have regulations out that we can read about what's going to be acceptable and what's not?
Sorry, I didn't get your question.
The regulations on, the changes in regulations for CRA.
Right. What about it? I'm sorry, I missed your question.
When are the regulations going to be out that we'll know, the banks will know what's acceptable for CRA and what's not acceptable?
So the final rule, of course, is out. I think we're working on, there's a lot of work to do. The requirements don't really kick in, most of them for a couple of years at least. So I think we're working on the follow-up regulations.
Okay, that's real important for all the banks, because they want to make sure they qualify, and where the dollars are spent, they need to make sure that it's going at the right spot, because the credits won't be applied unless that's it. The Fed now, where the Federal, I think, Reserve launched and is operating this now, how is the participation rate going with that?
Slow, real slow. It's early days. There are network effects. These things they go slow until they don't. And it was the same way with ACH. You may remember back in the day.
Right.
So we're at fewer than 500 banks are in there now. We're working away at it. We expect it'll take some time, but it's there, and we think it'll be beneficial. We had a lot of support from smaller banks to build it, as you know.
Is the pricing below cost?
I don't believe so, no, not longer run cost.
Okay. Okay, that's all the questions I have. Thank you for being here.
Gentleman yields back. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
I want to thank the chairman and the ranking member for this hearing, and to you, Chair Powell, for appearing before the committee to discuss the recently published monetary policy report. As we continue our work on behalf of the American people, we have to keep in mind that our mission here is to grow the economy from the bottom up and the middle out. It seems as if there has been a constant series of shocks to the economy, both domestically and globally, and yet we can all see just how resilient the labor market has been as it has maintained its strength. With a robust gain of 353,000 jobs, the January numbers are a continuation of the trend that Democrats in Congress delivered through historic investments in our workforce, putting people over politics. In light of this relative economic strength, I really want to implore the Federal Reserve to take stock of the holistic economic picture before making decisions on monetary policy, and to pay particular attention to those communities that have been historically left behind during times of accelerated recovery. I want to add to the questions from my colleague, Congresswoman Presley, Chair Powell. At a time where it has become increasingly difficult for working people and people of color in particular to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a home provides. So what actions, if any, is the Federal Reserve considering to better understand and to mitigate the impacts that your Basel III proposal may have on minority borrowers who disproportionately rely on high LTV mortgages due to the generational wealth gap that persist?
We've received comments, including many, on the mortgage changes, and we understand the concerns, and we're looking very carefully at that. Haven't made any decisions, but we will announce them when we have.
Are you concerned that these shifts in risk weights will reinforce the decade-long retreat of banks from the mortgage market and push more originations to non-bank institutions?
That's a question that people are raising, and it's something we take very seriously, and we'll be taking that into consideration as we decide about that change, that recommended change.
Could you discuss why you feel it is necessary to include new requirements around operational risk in Basel III in light of recent claims that it will significantly increase the cost of or prevent banks from offering altogether necessary services such as underwriting, investment advisory, or insurance?
That is one of the concerns that's been articulated about the proposed changes to operating risk. We take those concerns seriously. As I mentioned, we're in the middle of looking at these things, and then we'll soon, in the process of turning to the question of what changes to make.
Well, I just would underscore the sense of urgency, because the longer there's uncertainty in the market, it creates really negative effects to end users, which are all of our constituents who are looking to see these costs come down. Let me shift. This Congress, under the leadership of Ranking Member Waters and former CBC Chair Joyce Beatty, I've made it a focus of my efforts to educate my colleagues and the public at large on the far-reaching benefits of increased diversity in the workplace, in our boardrooms, and in society as a whole. Despite the efforts by some on the other side to take away the very tools of economic opportunity that create inclusive work environments and improve performance, there has been a really misguided assault on everything from diversity, equity, and inclusion to other programs following the aftermath of the Supreme Court's ruling on affirmative action. So Chairman Powell, as you know, your Office of Minority and Women Inclusion has a focus on this. So as we anticipate the upcoming release of your annual report on inclusion, would you be able to speak to the necessity of collecting this data that minority and women-owned businesses are included in the board's contracting and acquisition opportunities?
I do believe we collect that data, and we monitor that very carefully.
And why is it important?
Well, I think diversity in the workplace is an important thing, and you won't know how you're doing unless you measure it.
And just as the McKinsey Institute released in their Diversity Matters Even More report, companies that have more diverse management teams actually outperform companies that don't. That goes to the bottom line of our economy, and I wish my colleagues on the other side would stop their assault on diversity, equity, and inclusion and actually work with us to grow the economy
Gentleman's time
for
to
everyone.
expire. The gentleman from Wisconsin, Mr. Stiles, now recognized for 5 minutes.
Thank you very much, Mr. Chair. Thank you for being here, Chairman Powell. Appreciate it. You're navigating a difficult situation where we've had stimulative economic policies from the Biden administration, in particular, excessive government spending, investment in infrastructure, specific tax credits. At the same time, we're seeing a regulatory environment from the administration that's also restricting economic growth. We've heard a lot about the Basel III endgame, which you have a chair of. In your opening remarks, you noted that high interest rates are impacting business investment in a negative way. High interest rates are also negatively impacting the housing market. As we look at Basel III endgame, I've heard from a wide array of stakeholders, from those that are commenting on increase in bank capital standards, the negative impact that would have on the housing market, as well as from the business community, the impact that would have on their ability to invest in capital infrastructure and increase employment. Does the broad diversity of voices who hold concerns on the Basel III endgame concern you?
I would say that I've articulated concerns, and we're reading those comments, and we're very much in the process of assessing what we need to do to address them.
Thank you. I appreciate your time on that. Shifting gears slightly, as you may know, the Securities and Exchange Commission held an open meeting today to approve the final climate change rule. It's a significant regulation that I think would have a significant impact on the economy. Can you comment how the Fed thinks about the economic impact of this new regulation or regulations more broadly, and in particular their impact on both inflation and on employment?
We don't comment on regulations of other agencies, sorry.
And you'll review that if it's put in place, or you'll review the economic impact as the empirical data comes forward?
We're not in the business of scoring, CBO does that. They'll look at this and make a careful assessment of the economic impacts and budgetary impacts and that kind of thing.
Thank you. I'll shift gears again. One of your two mandates is to maximize employment in addition to maintaining price stability. And as you know, government hiring has accounted for a large share of total job creation. More than 600,000 public sector jobs were created last year, and the federal government now employs nearly 3 million workers. So when you're examining employment data, how does the Fed view the impact of the public sector employment growth relative to private sector economic growth? In other words, how do the two data points factor into your assessment of how the broader economy is performing?
So the jobs are jobs, right? But I think we would tend to look at private sector jobs to get a better assessment. Private sector job creation is a better indicator of kind of the private sector momentum in the economy. But we look at both. I mean, they both count.
Does the dramatic increase in the private sector number of jobs give you any pause or concern as it relates to?
You mean in the public sector?
In the public sector. Sorry if I misspoke. Yes, the public sector.
The truth is the public sector was unable to hire at the beginning because wages went up a lot in the private sector at the beginning of the pandemic inflation, and public sector can't respond to that. So there's some catch-up hiring going on there now. Now that things are settling down to normal, I think there's some catch-up hiring. I'm not sure it's an issue we're concerned about.
Okay, I'll shift gears in my final minute just to talk a little bit to get your perspective on the macroeconomic developments that are having an impact on our monetary policy, specifically as we think about the potential for a productivity boom from AI to work at home to other factors. The data is probably too early to tell whether or not we're having a true productivity view, but how does the Fed view the adoption of some of these new technologies, in particular AI, as it relates to labor productivity?
So everyone's looking at AI for that question, and it's hard to say, actually. We've had really nice productivity in the last year or so, but it's probably still very much affected by the post-pandemic factors that we're seeing. I think we need to see more to understand whether there is a longer-term boom. AI certainly has the capacity to either augment labor or to replace labor, and that's a key question. We really don't know which of the two it will do. Tons of money being invested in it, and so it's likely to drive significant productivity. I would say right now technology, but also higher labor mobility. A lot of people quitting during the really tight labor market, and also the rise in startups. There were a lot of people started companies during the pandemic. Those are the kind of things that do add up to higher productivity over time. So there is hope that we'll see some productivity out of this.
Thanks for your comments today, Mr. Chair. I yield back.
Gentleman yields back. We'll go to the last questioner of the day, the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. Mr. Chair, I have several questions about some of the most common complaints that I've heard about Basel III Endgame. I have an open mind on the subject, but I want to hear your response to some of the arguments that have been leveled against it. First, the Fed has repeatedly reassured the public that the banking system is well capitalized. Yet the Fed is advancing Basel III on the assumption that the banking system is undercapitalized. So the first question is, how do you reconcile the Fed's repeat assurances about a well-capitalized banking system with Basel III's assumption of an undercapitalized banking system? The second question, if the purpose of Basel III is to align U.S. banks with their banking peers elsewhere in the world, why is the Fed imposing requirements that are more stringent than those prescribed by Basel III? In other words, why is the Fed, quote unquote, gold plating? The third question is, how do you reconcile Basel III's recommendation for standardization with Congress's statutory requirement for tailoring? Standardization would seem to be in conflict or in tension with regulatory tailoring. And the fourth and final question, do you think that Basel III could have the unintended consequence of reinforcing the trend toward shadow banking, which would mean less regulation, not more? Is there a sense in which we are transferring risk from the regulated sector of the financial system to the deregulated sector? So I bombarded you with 4 questions, and I'll give you the time you need to answer them.
I'm going to have a hard time reading my handwriting here, but I'll start with yes to the fourth one. I'll give you that one because that is clearly a risk. We've seen intermediation activity moving out of the regulated system, and this has the risk of doing more of that. So what was, in a word or two, what was the one again?
Just you said, you testified and
capital, yeah.
repeat reassurances about the capitalization of the bank.
So I addressed this in my remarks in the open board meeting. Higher capital is always going to add to safety and soundness, but there's a cost.
Right.
And so identifying the precise right level is very, very difficult. Hard to do it objectively. I've said for years in these rooms that I thought that the level of capital in the U.S. banking system was about right. So I posed, and I voted for all these increases during Dodd-Frank, so I think it's a very fair question. We'll be looking at that. The second one was
The concern about gold plating.
about,
Gold plating?
oh, gold plating, yeah, no, it is, and I said this in my public remarks, that we're exceeding the minimums with this proposal, and we also exceeded what the other big jurisdictions are doing, and so that's a question. That's a good question. I'll agree.
Okay, great.
And the third?
And the third is, I think you more or less, and standardization versus tailoring.
Standardization of, it was something.
Yeah, so Congress passed a statute
Oh, you
requiring
meant
regulatory tailoring.
No, that's an
And do you
excellent
think
question.
Basel III is in compliance with that
I addressed that in my
statute?
comments too. I think you're right. We do need to take on board the lessons of Silicon Valley Bank as it relates to the smaller, large banks. But we don't need to throw away the tailoring that's required by the law, but also that is appropriate if we're going to have a diverse banking system.
You know, the collapse of SVB was largely a story about liquidity risk and interest rate risk, yet the focal points of Basel III are credit risk, market rate risk, and operational risk. Like, what is your response to the criticism that the Fed should focus its energies on addressing the forms of risk that were responsible for the SVB bank failure rather than focusing on forms of risk that were largely unrelated to it?
So I agree with that, but I would say we are working on a package of liquidity measures which directly addresses the Silicon Valley Bank situation. We've also taken a lot of supervisory actions with other medium and small-sized banks that had a lot of uninsured deposits and a lot of real estate risk and things like that. So we've been doing quite a lot on the supervisory section that it doesn't require new rules.
And then finally, as you know, the crippling cost of housing accounts for a third of inflation. One of the most powerful tools for producing and preserving affordable housing is the low-income housing tax credit, which has financed nearly 4 million units of affordable housing. The banking system accounts for 85% of LIHTC investments, and there's a concern that Basel III, in its present form, would diminish the availability of LIHTC and the amount of affordable housing development. And so I'm just curious, is that on your radar, and is that something you're willing to examine?
Yes, it is.
So with that, I'll leave it at that. Thank you.
Gentleman yields back. That's the final questioning of the day. We committed to the chair that would be done with a hard stop by 1 p.m.
Done.
It's nice when we can honor our commitments. So I'd
Get him,
like
bow
to
tie.
thank Chair Powell for his testimony today. Without objection, all members will have 5 legislative days in which to submit additional written questions for the witness to the chair. The questions will be forwarded to the witness for his response. I ask you,
Okay.
Chair Powell, please respond as promptly as you possibly can. And with that, this hearing is adjourned.
All right, bow tie. Let's get on out of here. All right, guys, so let me know what you guys thought of that meeting. It's finally over. That thing took so long. Don't go anywhere. Listen, we are going to day trade today. We are going to get funded in a $300,000 funded account. Okay, we're going to get funded in a $300,000 account. The market has mostly reacted positively. Check out Apex's funded account program. Listen, if you want to day trade, we're going to go day trade. Right now, you shouldn't have to go anywhere. It should immediately bring you to the stream. If it doesn't, for whatever reason, I'm going to post the link in chat. And yeah, guys, just kind of a interesting thing here. Remember, so we're going to try to get funded. Don't day trade by putting up thousands of dollars and risking that. Almost all day traders lose money. It makes absolutely no sense. Instead, try Apex. They give you a demo. The base one's only $25,000 in funding. It's like $30. If you pass it, you get $25K in funding. If you fail it, you're only out $30. And then once you pass it, you can build up profit, keep your first $25,000 and 90% after that, and then you can fund it with those profits if you're profitable, but it severely limits your risk. We're going to go day trade on that today, but if you want to check it out before we leave, here's the link. Great way to help support the channel. Remember to use promo code. You get 71% off. Remember to use promo code BT or triple BBB at checkout. It'll give you the 71% off. There's the link. And yeah, again, we're going to go over there. Oh, wait, did I post the wrong link? Let me think. I might have. Okay, no, I posted the right one. All right, guys, listen. As soon as we close the stream down, it's going to bring you there. If for whatever reason it doesn't, go to this link. We'll see you guys over there. Let me know what you guys think. Here's the link to the stream we're about to do right here. Again, as soon as we close the stream, it should bring you to this new stream that we got going on in the background. Let me make sure we are. Okay, yeah, we're good. All right, we're going to start that stream up right now. Wait. Yep, we're going to start that stream up right now. I'll see you guys over there.